to Steve here.
Great. Thank you, Ed. I'd like to welcome everyone this morning to the 4th Annual International Conference on Housing Risk. On behalf of Ed and Joan, we're looking forward to a very stimulating day and a half of presentations, discussion, and informal conversation. The topic of the conference, housing risk, is obviously a very important one. The housing crash and the subsequent financial crisis nearly brought down the global financial system. I was at the Fed at the time, so unfortunately I had a front row seat to that debacle. And really the unstated theme of the work that we do here at AI and the International Center on Housing Risk and of this conference is that one of the key causes of both the housing crash and the financial crisis was really the failure to appreciate the buildup of risk that had taken place over a period of roughly a decade in both the housing market and the mortgage market. And the objective here, and in the work we do in the center, is to really shine a light on those risks in a very transparent, objective, and rigorous manner. So I think there are 3 features of this conference that are unique and really constitute strengths of the conference. The first is we really are focused on a single important topic, and that is housing risk. This isn't a general purpose conference about housing. And I think that focus really helps to move the agenda forward. The second is the diversity of participants. It's very unique to have a conference that includes people from the industry, from academia, from financial institutions, from think tanks, and from the government. Most of the conferences that I go to are largely academics talking to one another rather than sharing and cross-pollinating ideas with policymakers and with people in the industry. And this conference, I think, really is unique in that we do that. And the final unique feature, I think, of the conference is the continuity. This is our 4th annual conference devoted to this theme. I see a number of familiar faces, and I think it's a strength that we're building a community of people who are working in various ways to reestablish a culture of rigorous risk measurement and assessment. So with that, I'll turn the mic over to Joan.
Thank you, Steve. Hi, I'm Joan Trice. I'm CEO of Altera Group, and I host a group called the Collateral Risk Network. And that network is comprised of 500 chief appraisers from financial institutions, from appraisal management companies. There are appraisers in the group. There are regulators in the group. And this is how I came to know Ed and hence this conference, so that we can have a very high-level conversation inside the Beltway here with policymakers. So while we're sitting in a think tank today and we're thinking very hard about all these things and listening to lots of experts, hopefully what we'll walk away from at the end is talking about rethinking. And when I say rethink, I mean let's actually sweat, roll up our sleeves and do a little work, and not just write some papers, but let's have an action plan and put some verbs into the great ideas that we come out of this conference with. Ed?
Thank you, Joan. Thank you, Steve. Let me add my welcome. Steve mentioned the continuity that we have. Another facet of that continuity is I went back and looked at August 8th, 2012, which was the first day of the first conference. And in my opening remarks, I said, as we look back on the boom and the bust, it is clear that the appraisal process failed to distinguish between price and value. Determining the price at which a property may be sold or refinanced is quite different from providing a value analysis that assists lenders in determining the maximum amount that may be prudently lent on that property. Market value based on the most recent comparable sales failed to provide a sufficient basis for making a lending decision. Relevant market fundamentals evaluated over a sufficient time period must constitute a necessary component of the appraisal process. That we'll find is going to be one of the touchstones for this year's conference. We'll actually going to have moved the ball forward in a number of respects with the presentations that will be made today and tomorrow. We're pleased that the AEI-CRN conferences on housing risk have provided a venue to present research on this important topic. And many in this room have made important contributions to this body of work that continues, and for that we're in your debt. I want to particularly thank three individuals that weren't able to attend as their contributions have been quite significant. One is Bob Dorsey, who founder of FNC, and we have Ying Langmeyer from FNC here today, but Bob retired from FNC a couple of months ago and is now not attending events like this, but he's been one of the touchstones both intellectually and FNC has been a major provider of data to the research of our housing center. Noreen Bryden of Marshall Swift CoreLogic has been another individual that has contributed mightily to the effort and again has been a major contributor of data to our land study work. And Reiner Lux of Hypesert, who had a conflict, and he's been at all the other conferences, and is, of course, along with Andreas, who's here from Germany, have been the intellectual touchstone for the concept of mortgage lending value, a concept that's been in Germany for many, many years, and as I've discovered, was one that was developed in the United States back in the 30s. A couple of housekeeping items. We've added Jack Horton to panel 4 later today, and so there's a handout. And by the way, all the handouts are either in the anteroom to this room, and there's some additional handouts behind that large post near the coffee. I would ask that you remember to save the date. We've actually set the date for next year's conference, which is October 5th and 6th, 2016. And it'll be in our new facility. We're moving in about 3 months over to Massachusetts Avenue and 18th Street. And that'll be the location of next year's conference. You have on your table a couple of items. There's this handout that there's a stack of. It's two-sided, 50 years of housing policy failure, how housing policies make homes unaffordable, and wealth building for the 21st century on the other side, a synopsis, and this is a longer version of both of those booklet that if you flip it this way, you have that, and if you flip it that way, you have this. And so those booklets are also on your table. Anyone like any extra copies, just let us know. And I'd like to finally thank Leela, Ryan, Urbashi, Katie, and the entire conference staff and catering staff for making this conference work as smoothly and doing all the planning that makes it a successful conference. I want to thank them. And with that, let the 4th Annual Conference on Housing Risk begin with panel number 1. Just give us a minute to reorient the panel, and we're ready to start. Thank you.
All right, well, we'll get started with our first panel, which is on measuring mortgage risk. Before I introduce the panelists and we get into the presentations, let me just mention that we are live streaming this event. Those who are not in the room who would like to see the event, it's available at the AEI website. And those who are doing the live stream, if you have questions, you should email them to Leila Lukacs during the presentation, and we'll try to include your questions in the Q&A period. Leila's email address is lilla.lukacs@aei.org. All right, well, with that housekeeping out of the way, let me briefly introduce our three distinguished panelists. We have full bios in the conference material, so I'm not going to read the long and distinguished bios for each, but just give a brief introduction. Our first speaker will be Ted Durant, who is Vice President of Analytic Services at Mortgage Guarantee Insurance Corporation, the largest provider of private mortgage insurance. Second speaker will be Sam Cater, who is currently the Vice President of Research and the Deputy Chief Economist at CoreLogic, and previously was Senior Economist at Fannie Mae and an economist at the National Association of Realtors. And to my right, and the third speaker is someone who really, for this group, requires no introduction, Ed Pinto, my colleague here at AEI, co-director with me of the International Center on Housing Risk, someone who I have had the privilege of working with closely on a daily basis for 3 years, and who I learn things from every day. So with that, why don't I turn things over to Ted for his presentation. We're going to try to stick to about 15 minutes on each of the presentations, so we have a substantial amount of time for Q&A afterwards.
All right. Well, thanks, Stephen. Thanks, Ed and Joan, for continuing this conference. Thanks for inviting me back. I guess I didn't insult too many people last time. So Joan talked about putting some of these ideas in action, and I'm glad to be the first speaker because I get to tell you about putting some of these ideas into action. Yes. I think so. Everybody can hear, right? Back row. Okay. Several years ago, our mortgage insurance industry decided that one of the things to do following the crisis was to take a look at the way we're capitalized and think about a more risk-sensitive capital model. Apparently, forwards is backwards. Now it's not responding at all. Where do I need to point it? The right arrow button, right? That's all right. So what's the motivation here? Entering the crisis, the mortgage insurance industry was generally capitalized what we called a 25-to-1 risk-to-capital ratio standard. Our risk is measured what we call risk in force. Very simple calculation. If we're covering a 90 loan-to-value ratio loan, we typically have 25% coverage on it. So take 25% of the loan amount, that's our risk in force, and we were required to, as a minimum, hold capital to 4% of that. We also had a counter-cyclical feature of our capitalization, which is our contingency reserve, in which we're required to take 50% of every premium dollar we earn and hold it for 10 years in a reserve added to our statutory capital to determine our level of capitalization. There's another calculation called the minimum policyholder position, slightly more risk sensitive than the RTC, but it resulted in roughly the same kinds of requirements. We also had rating agency ratings, and going into the crisis, Freddie and Fannie's criteria for being an eligible mortgage insurance company relied heavily on those ratings. And just as an example, Standard & Poor's generally rated MI companies around AA. Some of them were rated AAA. And their standard was a 10-year forecast of cash flows, which put us through a stress that amounted to about a 15% claim incidence over 10 years. And to a AAA level, you had to have 100% of the resources needed to pay all the claims in that stress. The AA level, they said 75 to 100%, so the midpoint kind of 85%. The level of capital that required was generally in the 16 to 17 to 1 range. I will note that what we just went through, we're a year away from being able to say what, as of the end of 2006, a 10-year stress actually was. We're going to comfortably exceed that 15% claim incidence. So the stress actually was greater than what S&P used to say was a AAA stress. They're saying now that that was a maybe double B stress. So they've kind of changed their mind on what level of stress we just endured. I will also note that the MI industry has covered about $50 billion in claims. The collection rate on those claims is a little over 96%. So we actually exceeded what S&P expected us to be, and the GSEs expected us to be capitalized to. Regardless of, we did survive, we also recognize that a capital requirement that's not sufficiently risk sensitive creates problems, particularly when you look at the kind of business that was being done, the kind of economic conditions we faced in the early 2000s. So we decided this capital model needs fixing. So the industry engaged Oliver Wyman to help us figure out what kind of model should we create. And out of this came the desire to create actually a loan level forecasting model. And so this is the nerdy part for the economist modelers like me. This is a state transition model. It should look pretty familiar to like CoreLogic, who build these kinds of models. A fairly simplified set of state transitions. The default state is 180 days past due, a relatively serious level of default. Obviously, there's a lot of stuff that goes on between a loan being current and getting to 180 days. Because we're doing this as a capital model, trying to set a stress level, and over a 10-year period, we look at a fairly serious level of default as our first stage, and then from that default stage you can potentially cure or go into a what we call a claim status. So that's where we actually pay an MI claim. And then of course for many of those statuses there's a cancellation event, which for an MI company is a little different than what most bankers or mortgage bankers think of as a mortgage prepaying. There are other reasons why a mortgage insurance policy would cancel. Primarily Homeowners Protection Act borrowers, when they reach 78% LTV, that we automatically cancel the coverage. So it's a 10-year forecast. Home prices, interest rates are the two obvious important things that you're thinking about economically in the environment, trying to project out. So we developed this loan level model, and our state regulators, the NAIC, right at the same time as we were beginning to develop it, said, we're interested in rewriting our Model Act for mortgage insurance and bringing some changes to the way you're regulated. A key feature of that, we're thinking you guys need to be brought under our risk-based capital framework. Back when the insurance regulators created their risk-based capital framework, they exempted the mortgage insurance companies, the title insurance companies, and financial guarantee from it, largely because we're different, it's complicated, and they had enough on their plate at the time. So now we're becoming part of that. In order to take the loan level model and put it into practice as a risk-based capital kind of framework, we said, well, let's try to simplify it, make it a little more transparent, make it the kind of thing that we can show those results to, say, a community banker and have them understand how we're capitalized, why we're capitalized to that level. And so we started thinking about creating kind of a grid-based system, and right about that time, Freddie and Fannie handed over to us the first draft of PMIERs, the private mortgage insurer eligibility rules that they had just created. And sure enough, it was a bunch of grids. The primary ones are based on the loan-to-value ratio and the credit score. And we said, well, that looks familiar. So we actually lined ours up. The loan-to-value cuts, the credit score cuts, we actually lined up with theirs specifically to make sure they would be comparable. So we have a set of base claim incidence tables based on LTV credit score and, of course, status, loans that are performing versus loans that are non-performing. And in this case, non-performing begins, as with any normal MI company analysis, at 60 days past due. So performing and non-performing is the first big cut, and within the performing loans, loan-to-value ratio and credit score are obviously important drivers. And then, like the GSE's eligibility rules, we have loan level factors that are additions to the expected claim incidence. They actually can lower it as well. For example, faster amortization. So the wealth building home loan would actually get a reduced claim expectation because of the more rapid amortization. What else? There's also a seasoning factor, but only for current loans or performing loans. Non-performing loans don't get that seasoning factor. So then there's another set of grids. Unlike PMIERs, there's a recognition of future premium as a claims-paying resource, and we're trying to get at how much do you need in capital beyond what you already have in the ongoing collection of premium. So similarly, we have loan-to-value ratio and credit score tables that create, that give you a multiple, so it's the number of years you expect to collect premium on those loans. So that's the claim incidence, the premium. There's also a loss severity set of calculations that's based off of the coverage level. I talked earlier about 25% coverage on a 90 LTV loan. That coverage level helps determine what the expected severities would be. So we have this set of tables. The numbers in those tables are derived from the loan level model. So we built the loan level model, got it calibrated, and then filled out these tables using that model and some hypothetical loan portfolios and said, well, here's how the tables should be populated. An important aspect of the grid-based model that's different from the loan level model is we used the grid-based model to establish capital at the time the loans are originated. And once the loan's been originated, we know what the capital is going to be for the life of that loan, depending, of course, on does it go delinquent or not. But it's a very important aspect of our business, that forward visibility into what the capital requirements are going to be, because we price the loan before we insure it. And once we've priced it and once we've insured it, we can't change that price down the road. So very important for us that we know the capital at the time we're doing the pricing. All right, so we get back to this is a 10-year forecast, and a very important aspect, of course, is what our home price is going to do. And we wanted the capital to be sensitive to the economic environment. So I described we have these tables of loan-to-value ratio, credit score. We also need the model to be sensitive to the economic environment. Is there a housing bubble going on? Is mortgage lending kind of crazy? These are things that increase the risk for us. They increase the loss expectations. For home prices, we're using work by Smith & Wire, who are researchers at FHFA. They've done some really good work on developing a capital model based on home prices relative to some long-term trend. We've modified their methodology a little bit because in their original specification, home prices just grew at a theoretical constant rate over time. Real home prices were expected to grow at some constant rate. That constant rate varied by market. We wanted the model to be a little more sensitive to some underlying economic factor that would help explain home price movements a little better. We don't necessarily expect home prices to always go up on a real basis over time. There are important factors why they may go up or down, and the factor we chose is per capita income. Basically, we model home prices as a function of per capita income. That establishes the trend line, the trough, which is the extent to which home prices will fall below the trend. Because we're working generally with large nationally diversified portfolios, and we now have a really severe national crisis to look at, we use the worst national decline as the way we estimate the trough. Smith & Wire and some others at FHFA have done more subsequent work on how to identify those troughs. We had a timing issue. We had to write this into statutory language for NAIC to be able to adopt. And we also wanted to keep it a little simpler. Another simplification, we're doing this at the census division level. Again, working with generally large, diversified companies that have broad national exposure. We felt the census division was the best trade-off of bringing in some kind of regional sensitivity, but also not making this thing too complicated. So one of the things Scott and Jesse came back to us about was, well, if you do this at higher geographic aggregations, there's some idiosyncratic risk you have to account for, and it's around the nonlinearity of the relationship of the factor to the risk, more technical, nerdy stuff. The upshot is we've had to add a calibration factor that says you've got to multiply the expected claims by some amount to get to what the actual claim incidence would be. So that's how we're dealing with home prices. It's very effective. Show you in a sec. In order to apply this to the grid, so when we do this at the loan level, we're just projecting 10 years. We've got home prices at a certain level, and we're going forward 10 years. They're going to fall to the trough, and then they're going to come back up. The grid-based approach, because we're doing this at the time of origination, we divide markets into 4 categories based on where home prices are relative to the trend today at the time we're originating the loan. So we have A through D markets. An A market, we project down 10%. A D market, we project down 35%. So we have a separate set of grids for each of those origination periods. All right, so what does this look like in practice? Here are some lines that should look very familiar to people who've worked with Smith & Meyer and their folks on this. The black line that you see there is the trend that's estimated from the relationship between home prices and per capita income. The blue line is the actual path of home prices, and the green is that trough that we expect in a downturn home prices could go down to. And you'll see this is a particular census division, and you see the blue line shows that home prices actually got about halfway between the trend and the trough line. Didn't go down in this census division in the last crisis as much as they potentially could have. There are other census divisions where they actually went down a little lower than that trough. Somebody who's diversified geographically, the overall result is about the right amount of decline. All right, ripping through this stuff quickly. Sorry. Underwriting standards is another key one. The way most modelers deal with this question of how do I get my model to fit the loans originated in 2006 and 2007, they throw up their hands and they attach a dummy variable and say, well, I'm just going to tag these loans and say this is a 2006 loan. And they kind of give up on the attempt to explain why those loans performed worse than we would otherwise have expected. So this is now within the industry referred to as the Ted Durant factor. This is something I came up with to try to explain these things. And it's a very simple, just average number of risk factors per loan. And I look at broadly across the country. I started doing this, of course, on MGIC's own data. Ideally, you do it with every loan originated, right? You take CoreLogic data or Freddie Fannie data and say, within the entire lending industry, and I think your mortgage risk index you're developing, Ed, is very much along these same lines. The problem is I need to go back to 1995 with it in order to fit my model to explain this stuff. But it's a very powerful indicator of what's going to happen to default risk in a book of originated loans. The way this has been implemented in the capital model we're creating is it's one of the right-hand independent variables into the equations that churn out default and prepayment likelihoods. My own work, I prefer to take the home price part, home prices relative to trend, and this underwriting risk level, and use those both to categorize markets. So when I talked earlier about A through D markets, I prefer to combine the two aspects of home prices and what I call the insanity index to determine what kind of a market is this. Give you an idea of how effective this is. I probably don't need to explain this chart. The black line is the insanity index. The blue vertical bars are the distribution of the loans in the population of data that was used to estimate the industry capital model. Obviously, a lot of business written back in the 2006 kind of time frame. The insanity index really peaks in 2007. No surprise. The horizontal axis, you probably can't read those numbers, and you probably don't need to, right? 2007 is pretty obvious in there. All right, so what does a countercyclical capital model look like? Here's the bottom line. I've had to remove the vertical axis numbers, so this isn't entirely public yet, so the actual results of it have not been shared publicly. And as a publicly held company, I have to be very careful about what I put out there. But the black line is what the loan level model produces. The orange line is what the grid-based model produces. And this is for current loans, not for defaulted loans. But you can see the obvious peak in 2007, the rapid buildup from 2005 to 2007, and then the gradual fall off. And this is on the entire set of in-force business. If you actually did this by origination year, it would be far more dramatic. The level of capital required on loans originated in 2007. At MGIC, 43% of our insured business in 2007 was zero down, 100 LTV lending. So give you an idea of, at a time when home prices were vastly overvalued and the insanity index was high, partly because of that 100 LTV segment, you can imagine how much capital that would require. So that is where we're at with countercyclical capital.
Thanks, Ted. Good morning. I'm delighted to be with you. I'd like to thank Steve and Ed for the invite. So I'm going to cover the way we look at mortgage risk at CoreLogic, and here's a summary of the deck that I'm going to present. First of all, overall mortgage performance is improving, and it's improved quite a bit. It's a little bit of a good news, bad news story as I go through this. But so overall mortgage performance is improving, but we have ways to go. Underwriting is tighter relative to the early 2000s and the late 1990s, and that's going to be my sort of key reference point as I go back in time, because that's the furthest that I can go back. But as you'll see later, and I'm sure Ed will talk about that, in fact, underwriting is not that tight when you go further back. So keep that in mind as I'm talking. My frame of reference is the late 90s or early 2000s. Serious delinquency rates for recent originations are at 20-year lows. That's sort of the good news part of the presentation. The bad news is that the legacy loans from 03 to 08 are still a major, major risk. And I'm not sure if that's getting enough attention. Second, home prices have become unaffordable again. And lastly, home price volatility is very high, or higher, quite a bit higher, and so are home price correlations. I feel like there's not enough work on that last point right there. So let's begin with sort of a quick primer on what's happening in the mortgage performance space. In the upper left-hand corner, I've got serious delinquency rates back to January of 2000. Just a little bit about the data. This data covers about 35 to 36 million loans outstanding. It covers about 70 to 75% of all loans. When we look at serious delinquency rates, they're running at about 3.5% today. Sort of in normal times, they're running at about 1.5%. Clearly way down from the peak, but still more than twice the level of the early to mid 2000s. In the upper right-hand corner, I've got distressed sale share. This is REO sales plus short sales divided by total sales. Historically, the distressed sales share was running about 2% in the early 2000s and even in the late 90s. It's running out a little bit under 10%. It's about 9.5%. So again, big improvement, but still multiples over normal time periods. In the lower left-hand corner, I've got the negative equity share. We define negative equity as we do this at the property level for 49 to 50 million loans outstanding in the U.S., and we look at the value for the property and the total amount of debt, the first lien and any subsequent second liens. And if the value of the liens is greater than the value of the property, you're in a negative equity position. And the line that we've plotted there is the negative equity share. We started doing this in 08 and 09, slightly changed the methodology, so I can't show you that much more than what I've got. In late 2009, early 2010, it was around about 25 or 26 percent of all mortgaged borrowers were upside down. Since then, it's declined. It's now running at about 9%, but you can clearly see, just like the other charts, we still have a ways to go before we get back to a normal level of about 1 to 2%. And then lastly, foreclosure starts, they were running in the 25,000 range about 10 years ago. Peaked in the 230, 240 range, and they're now down to about 50K, still multiples above. I'm going to come back to this point because that's where a lot of the legacy stuff is coming through and the foreclosure starts. So why is mortgage performance improving? There are several answers. There's the improvement in the economy, the job market, et cetera. But of course, the other reason is that there's in home prices. But of course, the other reason is that the improvement in underwriting. So on this chart, I've plotted the average FICO score in the green line historically. This is for purchase loans, and it's sort of consistently was rising in the early to mid 2000s, and it continued to rise through the crisis. I've also plotted the percentiles because I feel like averages don't matter anymore, or medians for that matter. So I've plotted the 99th percentile. It's up in the 800 range, no surprise. But what's most interesting about this chart is the first percentile. So from the bottom, this is for purchase loans, and that was running in the 470, 480 range in the early 2000s, and began to slowly increase. But you can see big increase through the crisis, and is now running in the 620 to 630 range. That's where the credit has been cut off and sort of the tightest relative to the early 2000s. Of course, there are other ways to look at credit besides just FICO. And so here I've created this sort of spider chart where I look at the 6 major dimensions we've identified as indicators of credit risk. And they are credit scores less than 640, LTV is about above 95%, DTI is above 43, low and no doc, arm share, broker share. And the way you read this chart is that the early 2000s, this is 2000, 2001, is the red line. So we made everything for these 6 dimensions. We indexed 2000 to 100, and the current is the blue line inside, and shows how underwriting has gotten tighter in every single dimension, but especially in the credit score dimension, low doc, no doc, and broker share dimensions. Some of these cutoffs are arbitrary, so we could have used, instead of using LTV 95, we could have used 90, and if that's the case, then that blue line would actually be right on top of the red line. And if we used 85%, it would be the same. And so to get around that, we created an underwriting index that uses these 6 components, but is a loan level index, and we use principal components. It's a statistical technique that reduces dimensionality. So we take these 6 factors, to think of them as sort of the 6 factors that can inflate or deflate the balloon. And when we run those, and we create an index on the next chart, so we've created our own insanity index, except my marketing folks don't let me use colorful language like that. So ours is just called the Housing Credit Index. So we indexed that to 100 in the early 2000s. You can see it fell, meaning it got tighter through the early 2000s recession, and then it really loosened through the before in 03 through about 05, stayed at a high level, and then tightened. And over the last 5 years, it's been fairly flat. In our data, there's been sort of a pretty strong meme that underwriting is loosening. We don't see it in our data, and I don't see it when I look at even not just in aggregate perspective, but even the individual line items. So if I look at just FHA alone, or conventional conforming, or jumbo, or seconds. This is actually just for first liens. We're going to create a second lien index similar to this. So a little bit about the resulting performance on the next chart. So here I've plotted the sort of the early payment default, and it's the serious delinquency rate. It's the 90-day plus delinquency rate, at 5 months after 5 months of origination. The reason I use 5 months is it was the latest data I had for 2015, and I wanted to show 2015. And so it's pretty early payment default. If you're seriously delinquent after 5 months, that's pretty bad. And I've done this for many, I've done it for the market as a whole and many different risk strata. Here I've concentrated on the SDQ for borrowers with FICO scores between 640 and 650, so right at that subprime cutoff. And as you can clearly see for 2015, we're running at about 20-year lows. What's sort of fascinating about this is looking back at the 2000 recession, which was a fairly mild recession by any standard. Yet you had a fairly elevated delinquency rate, which shows just sort of how fragile the market is, even in a sort of mild recession environment. On the next chart, I've plotted the serious delinquency rate, and this time I went further out in time. I went after 24 months after origination, and instead of looking at FICO, I looked at the 80 to 85% LTV bucket, and we get the same exact picture. It's actually even a little bit better when we go a little bit further out from a vintage perspective. Instead of going out 5 months, we went 24 months with this one. What's also interesting about this is sort of the same point I made before, which are the two red bars. 2000 was just, that particular year, because of the recession, was a fairly poor performing year. But what's also interesting is you can clearly see the ramp up, well before 06, sequentially 04 and 05, and the worsening performance. Now to switch to overall delinquency rates. So here I'm looking at, so I showed 90-day delinquency rates. Here I'm showing the current to 30-day transition rate. So this is the percentage of loans that are moving from current to 30-day delinquent status. It's sort of the earliest sort of warning sign that we can see in the data. And I've plotted nationally back to 2001. Our data gets thinner when you look at the late 90s, but it was running in that 1.2 to 1.3 range in the late 90s. And as you can clearly see, over the most recent time period, it's the lowest over the last 15 years, and actually probably more like 17 or 18 years if I'd shown the late 1990s. I looked at this same data for every state in the U.S., and most states in the U.S. look just like this. I looked at, even concentrated and looked at Texas and North Dakota. I even looked at specific oil markets. So I looked at Houston, Tulsa, Oklahoma City, Midland, Odessa, Bakersfield, California. I think those are the 6 or 7 most oil concentrated markets, and they all show the same thing. So then I also looked at the most overvalued markets. Some of them are the same markets, so Houston would be one, Austin, D.C., Miami. I don't remember what the other 5th one was. I also looked at San Francisco, same pattern. I looked at some metros in some of the sort of the poorest states, some markets in Mississippi and New Mexico and West Virginia, and you get the same fairly consistent pattern. On this chart, I've plotted the cash sales share. So the whole time we've been talking about mortgages, what we also forget is that cash sales are elevated, and this, in a sense, reduces risk, because most likely the person selling the home is someone that had a mortgage, and now that the next person or entity that's buying the home is using cash, and so that shrinks the pool of mortgages and the risk with it as well. So that's sort of the good news piece of the presentation. Here's the bad news, which is that the legacy loans are still an issue. So here I've plotted the percentage of loans that have ever been 60 days or more delinquent but are still active. So for one reason or another, they went 60 days delinquent. They either cured or modified, and they're still active. And as you can see, for the line that excludes modifications, that's running at about 9% or so. Very high, down from the peak, but not down that much. And then the line that includes modifications is running at about 12%. So we've got 4 or 5 million loans out there that are sort of that have been scratched or a little bit dented, right? And so that worries me. And the reason that worries me is the next chart. And here I've earlier showed a similar chart to this where I showed the new foreclosure starts. Here I break it out by the year that that loan was originated. So if you look at the most recent time period, the majority of loans that are where foreclosures are being initiated, even as late as June of 2015, the bulk of them are still from 03 to 08. There's very little from pre-2003 and very little from post-2009 forward, though that's growing, not a surprise. And so if I look at the next chart here, I've broken down two of the lines that I just showed. First is the pre-2003. What's sort of fascinating about this line, and this is sort of the percentage of new foreclosures by the year it was originated. So as of June 2015, roughly 10% of new foreclosures started are from loans that are at least 12 years old. And what's interesting about this chart, and I thought about breaking this out in more detail, but that share is actually rising. It's hard to tell on there, but it's over the past year and a half, it's risen from 8% to 10%. So that's a little bit of a warning sign, but it tells you something about the persistence of this, but it's a pretty small share, so not a big deal. The bigger share, or the biggest issue, is the legacy loans. And so if you look at 03 to 08 loans, they're still accounting for over 60% of new foreclosures. And so what I worry about is if we hit the next recession, the last recession ended in June of 2009, so we're 6 years in. The typical post-war recession is 5.5, 6 years. So we're sort of there. It's been a slow recovery, so I would expect that the expansion would last a little longer. But as the expansion gets older in the sort of tooth, there are potential issues that can always derail it. So that's one thing I worry about. Lastly, I want to talk a little bit about home prices. So home prices have become unaffordable. I like to look at home price, price to rent ratios or price to income ratios versus affordability ratios, just because the very low rate environment, I think, distorts things. And so I think it's clear that the low rate environment has been capitalized into higher asset prices, many different prices, real estate being one of them. So here I've plotted the price to rent ratio back to 1976, and if you take out the insanity years, it's by far higher than any other time period. And if you think about the late 80s, that was a fairly overvalued market. And if you sort of have to really understand where we are today, you have to I almost sometimes draw these charts and delete what happened between 04 and 06 just because it distorts the way you look at things. And so if you sort of erase that giant mountain, you really realize that the market's quite a bit overvalued today. And so that's one warning side. It's especially overvalued on the lower end. Over the last 30 years, lower end prices have appreciated at twice the rate that upper end home prices have appreciated. Here I've plotted low end prices, which I define as 75% of the median and below. This is a repeat sales index. And you can clearly see over the last 3.5 years or so, it's been running in the 8 to 12% range or so, and it was beginning to decelerate up until late 2014, early 2015, when you had the cut in the FHA premium, and immediately FHA purchase endorsements went from something like 45K a month to about 85 to 90K a month, and those are primarily first-time home buyers who are looking to buy sort of starter homes. And you can see there's been a re-acceleration in prices since then. No surprise, you increase demand, supply is very tight, so you get the response in the price. Last two charts quickly. This last chart here is second to last chart is home price volatility, which is I've defined as just a standard deviation of the percent change from a year ago, and I'm looking at a rolling 3-year window. And I've tried different windows. Depending on the window you use, you'll get different results. But bottom line, volatility, moved around between 85 and about 2005, but was basically running in the 1 to 4% range. You can see sort of the volatility in the late 90s with that little spike, and then obviously the huge spike with the crisis. Volatility is improving, but it remains elevated. Now the interpretation of this changes with the window. When I shrink that window and I look at only price changes over the past year, today home price volatility is back to where it was in the sort of mid 90s to the very early 2000s. So home prices have stabilized when you look at just the past 1 year. But what kind of worries me, and it's what's driving the volatility, is that home price cross correlations have increased quite a bit. So if we focus on the top chart, I've got two charts here. I looked at home price cross correlations for 10 large markets: Boston, Chicago, Dallas, Denver, Vegas, Miami, New York City, San Francisco, Seattle, and DC. And the top chart shows the cross correlations by decade. So in the 80s and 90s, and the early 2000s, the correlations were about 10 to 20%. If you look at 06 to 012 when home prices were following, everything became correlated, right? That's part of the problem. And so the correlation rate went way up in a down environment. What's interesting is since 2013, when home prices really began to accelerate, home price cross correlations are running at 2 to 3 times the level historically. And that's a big deal because in the past, when I worked at Fannie, one of the reasons we thought home prices were not going to decline was you had a geographically weighted basket. Well, that doesn't matter anymore when you get high correlations. And then just for fun, I put the actual correlations on the bottom, and Denver seemed to be the least correlated on average to most other markets, and DC, for some reason, seems to be the most correlated, and there's probably a bad joke in there somewhere. And with that, I'll take you to your favorite slide. This is our information on our Twitter blog. I got two Twitters, our official Twitter and my unofficial Twitter that has sports and other stuff. Thank you.
Thanks, Em. Before we turn to Ed, I wanted to just ask a clarifying question about the underwriting measures that you presented. Do they apply to purchase and refi loans or just purchases?
Yes, so that index is for purchase and refi. We've got different flavors. So I've got a purchase and refi index, and actually, I'm glad you brought that up. I should have talked about that because we've had questions about the downtrend of sort of over the last year or so on that chart, which is on page 6, and that's just the shift in the mix. So if I look at purchase, it's flat. But we've got different versions of these. So the nice thing about this, since it's all loan level, I can run this, by geography, by different segments, loan segments, FHA, subprime, jumbo, and we've done that before. And within each of the loan segments, when we've done it on the purchase side, they all went up. FHA went up the least, though we don't capture some things like the down payment assistance as part of this, so that's probably why it doesn't go up as much. And no surprise, private label went up more than anyone.
All right, thanks. We'll turn to Ed now.
Thanks, Steve. So I'm going to move along here. Here we go. So I'm going to talk about the National Mortgage Risk Index, which we introduced about 2 years ago, and is one of the flagship products of the International Center on Housing Risk. What we determined was that the housing crisis largely stemmed from a failure to understand the buildup of housing risk. Mortgage risk, house price risk, capital adequacy. We've already touched on many of those topics so far this morning. National home indices and delinquency rates are not leading indicators. If you look at Sam's slide, you see delinquency rates were incredibly low until house prices started crashing. It didn't tell you anything in terms of the future. And house prices were going up until they stopped going up and started coming down. When you disaggregate the data, you might be able to get into some additional early warning, but large national indexes don't tell you very much. And so we decided to address this problem by providing objective and transparent risk measures. We publish those monthly. We have a briefing call every month. We track particularly the housing cycle in California and Texas metros. We'll be expanding those over time. We're going to be adding collateral risk indices. Steve's going to be talking about that in the next panel to some extent. The definition of low-risk loans. We define a low-risk loan as one with a default propensity using the same 180-day definition of 6% or less. We use the stress event of 2007, and it's based on Freddie Mac data for plain vanilla loans. Does not mean they're low risk, it just means they're plain vanilla, meaning 30-year fixed rate, fully amortizing, fully documented, owner-occupied loans. But doesn't mean they're low risk, as we'll see in a moment. We developed this approach from the original QRM proposal that was proposed under Dodd-Frank by 6 federal agencies. We also compared it to FHA's underwriting standards in its first 20 years and its default experience over that 20-year period. Both yielded average stress default rates of about 3%, and this was consistent then with a 6%. If a 3% is the average, and there are loans that have numbers that almost round to zero, and there are lots of loans down there in those categories, you end up, if the average is 3, then you end up with 6 is roughly the max. We then use 6 to 12 to be medium and above 12 to be high risk. The next slide basically calibrates that over time. At various points in time. It's very difficult going back before certain dates because of lack of data, but we've uncovered a lot of information that allows us to at least make estimates on this. The NMRI captures the interplay of changes in 3 types of leverage, LTV and loan term. Income, so that's property leverage, LTV and loan term, income, DTI, ARMs, fixed rate, and the term of the fixed rate, and credit, FICO score. We have other factors that we then lay over that. The composite index is substantially above 1990, but is not approaching the 2007 level. The Fannie Freddie index is somewhat above the 1990 level. The FHA index is extremely high and is not actually that much lower than where it was during their peak, except the FHA market share is multiples, 10, 12 times what it was back in 2007. We only look at purchase loans. We have the ability to do refinance loans, but we've been focusing on purchase. Eventually we have about 12 or 13 million refinance loans that we need to get to. But we haven't been able to do that yet. The VA index is less than half the level of FHA, and that's attributable to a number of factors, but one of the main ones is the use of residual income. There are other factors, plus the overall risk level of FHA loans tends to be somewhat lower than in terms of DTIs, and credit scores tend to be somewhat lower, so those get weighted in our index. The next slide goes through credit conditions, 1990 to 2013, 14. Again, this is our attempt to try to bracket these time periods. Again, tracking down this data is very difficult, and so a lot of it's based on just things that I have in my files of a random sample from Fannie Mae back in 1990 to 1992, other information that we have about the way loans were originated back in those days, et cetera, and then we build up these types of numbers. It's very difficult, and Sam and I have had this discussion, trying to figure out what 2000 looked like because there wasn't loan level data on all of the loans, and even that FICO scores were missing on very large portions of the loans. So it's very difficult to get both a complete census and a distribution within that census if you're missing both the loans themselves and then the data on those loans. Next slide, stress default rates. Again, as I mentioned, plain vanilla does not mean low risk. Very low risk loans with these characteristics have a well under 1% or under 1%. We have buckets that are down at the 0.25% level. So even with a 30 to 40% house price decline, we had a lot of loans that had virtually no defaults. Of course, they were all very low LTV, very high FICO, and relatively low debt to incomes. On the opposite end of the spectrum, you have a lot of very high risk loans that tend to have FICOs in the 620, 639. Again, they're not down to the 580. If you go down there, these numbers go up from here. CLTVs above 95, total debt to income above 50. Assuming full documentation, and you have default rates in the 46% level under stress. Important note on our risk index, we have virtually a complete census of the agency loans. 98% of all agency loans are in our index, and we have 99% of the data fields filled out for that 98%. So we have a virtual completed census of agency business. Agency business in the purchase owner-occupied market, 90% of the loans. So we effectively have 90% of the volume of loans that represent home purchase owner occupancy. And we follow a lot of the risk-based and bucket approach and grid approach that was mentioned earlier, that Ted mentioned, and so a lot of these things you're seeing consistency. Next chart goes through the NMRI for home purchase loans. It shows what that trend is. There is some seasonality in these things. One of the advantages of having loan level data with a complete census and doing it monthly is you see patterns that weren't really apparent ever before about seasonality. That shows up. So to get rid of that, in the next slide, we show how the NMRI changes from 12 months earlier. And so it's constantly going up. And so what this is saying, particularly since mid-2014, it's been going up by 0.75 points a year. The score is around 12, and so it's been going up 0.75 a year. So over 2 years, you're going up 1.5 on 12, and in 3 years, if it continues, you're going up 2.25 roughly, compounded. And so this is like the frog in the water. And so that's one of the things we think is beneficial from the approach, but we're able to sort of disaggregate some of the seasonality. The next slide shows first-time and repeat homebuyer mortgage risk indexes. First-time buyer index is head and shoulders above the repeat buyer index. You see the repeat buyer index the red line is more stable, going up very gently. The first-time buyer index generally has been going up fairly smartly over the course of our history. Risk shares, one of our basic premises is that you need to have the preponderance of loans be low risk in order to have a stable housing market. It's leverage, and we'll talk about this a lot more over the course of the 2 days. It's leverage that actually creates this instability. And so if you have low risk loans, you now have an anchor of stability that if they're spread across the entire country and they're spread through a lot of neighborhoods, you now create an anchor. We lose that when we have 40% of the loans being high risk and only 37% of the loans being low risk. Next is agency origination shares. Big takeaway here is FHA's shares gone up a lot. Sam already mentioned that in terms of the change in premium. We'll talk about exactly how that impacted the market. Suffices to say, FHA is nearing 30%. The next slide goes through the risk overlap between the GSEs and FHA. This is very important because the way federal housing policy works is it pits Fannie and Freddie against FHA, and they compete with each other. It's nonsensical as a federal policy, but that is our policy, and the main policy engine for that is the affordable housing goals, which basically require FHA or Fannie and Freddie go after basically the same loans that FHA's core business. And so we see the overlap if we score the GSE loans in red and spread them across our risk index and the FHA loans in blue. We see the overlap is in the 8 to 20% score range, really 8 to 16% score range. And then if we look at the bottom panel, we see the shift that occurred since the lowering of the premium. This changed the competitive dynamic between Fannie and Freddie and FHA, and we see that where they're fighting over is rate this group that is between 8 and 20% score. They're not fighting over the very low risk loans, and they're not fighting over the relatively high risk loans. So FHA's efforts to, quote, expand accessibility, which is how it was portrayed, didn't actually happen. They're really just poaching each other, the business from each other. And right now, FHA is winning big time compared to Fannie and Freddie. Fannie and Freddie are responding to that. And so we'll be seeing that play out over the next months and years. The next chart goes through agency loan count. We put these red dots in here to show a little more easily where the current month is in the previous year, the same month and the year before that. So you can actually see the seasonality. There's a tremendous amount of seasonality going on here in the home buying. This is all home purchases. And again, this represents 90% of the loans that are done each month and that are guaranteed by the agencies. The other 10% are done by the private sector, non-agency guaranteed. And we see that this year has been a big boost in volume. That red dot has moved up quite a bit over the previous 2 years. We see it as even a bigger increase in first-time home buyer. We use the first-time home buyer definition that the federal government uses and is reported by the agencies, the 5 agencies, and that yields a somewhat higher number than the NAR. We'll talk about that in a moment, but our numbers are based on first-time home buyers defined by the federal agencies. The next slide sort of complements what Sam's low-end price growth acceleration. What we're measuring here is house price change for first-time home buyers March to September, disaggregated by the GSEs, VA, green, and FHA blue, and then comparing what happened before the premium change, which was announced in January. All of our loans are measured based on their first payment date, which is a uniform way of measuring the start of a loan, and therefore March ended up being is the equivalent of a January origination would be a March 1st payment date. February origination would be April. So the change took effect late in January, so February origination date would be our April time period. And what you see is that on the red bars, there's very little difference between 2013-14 versus 2015. You see the same thing in the green bars. You see a big difference for FHA. The reduction in premium added about 7% in buying power, and we see that much of that got used up buying a more expensive house. We can't actually disaggregate the difference between price, higher price, and a larger house, different quantity of house, but we know that they bought more house. This is consistent with the earlier slide, which showed the poaching was going on in the middle. The next few slides will go through very quickly. The percentage of loans with DTIs above 43. 43, of course, is the QM limit, but the agencies are exempt from that limit, and so we see 26% of the loans are above. FHA, nearly 50% of their loans are above 43. The next slide shows DTIs of 5% or less. Again, we've got a composite at 57%. Fannie and Freddie are at 30%. FICO score, we see what the median FICO scores are. Bottom line is we don't think credit is particularly tight. It's very hard to say credit's tight when 55% of the people are putting 5% down or less. It's very hard to say credit is tight when 70% of first-time home buyers are putting down 5% or less, and then the DTIs, et cetera. Yes, credit is somewhat more tighter on FICOs, but again, if you go back to the early 90s, they're not quite as tight as they appear to be by comparing it to, say, 2000 or 2005. The next slide shows the FICO distributions and MRIs for purchase loans between the GSEs, red and blue FHA. There's a barbell effect here. So they're really running two separate businesses. Where they intersect is where the barbell sort of on the either side of the bar in the middle. And that's, again, where the competition is. What this chart, the bottom panel shows is that they're not largely compensating for the increasing risk. As you move down FICO score, the risk score that we assign keeps going up. If they were compensating for risk, you'd end up with something flat. The next slide does the same thing for DTIs. This is a very important slide because it shows that FHA has DTIs as high as 57%, and the GSEs have some as high as 50%. If you look at the blue, you'll see that FHA is pretty indifferent, up to 57%. That is an incredibly high pre-tax DTI. And that means that if house prices continue going up, you can just keep moving out the DTI curve, and there's no friction against that. If interest rates go up, the same thing happens. When we had 2836 or 3338 as general limitations with some exceptions, that created a friction, and that would tamp down the growth in house prices and stop it. We don't have that friction anymore, which gets to some of the things that Sam was talking about. The role of leverage during a housing boom, you can read this. The bottom line is any housing boom has to be driven by leverage. It doesn't get driven any other way. 10-year Treasury rate, this goes back 150 years. We will get back to a return mean reversion. At some point, that mean reversion, who knows where it is on a 10-year Treasury rate, but it's probably at least somewhere in the 5.5% to 7.5% range, which means you're looking at mortgage rates at somewhere down the road, could be 10 years, but somewhere at perhaps 7% to 9%. That's what normal is. And again, we've seen this over 150 years. It has to happen again. It's just a question. We don't know when. I would point out that the last time we had quantitative easing was in World War II up to 1951. It was called the interest rate peg back then. And that's what this slide talks about. And so we've actually had this happen before. And once the interest rate peg was ended, interest rates started going up fairly substantially, mortgage rates included, and that led to a big increase in interest rates in the 50s and 60s. It also led to a big increase in leverage to offset that increase as they didn't manipulate DTIs back then. What they manipulated were down payments were going down. They were already fairly substantial. They went to very low levels, and loan terms ballooned out to roughly 30 years. This next slide shows the increase in seller's market, increasing leverage in a seller's market. This is a very important concept. If you look at the increase in real house prices and you juxtapose it against a seller's market, the blue, you'll see that the house prices are increasing in real terms relative to after adjustment for inflation during these blue periods. We're in the midst of a very strong rebound in real house prices. There's a lot of research that documents why this happens, going back to the 40s and 50s. That was long lost, and I'll be talking about that a little bit more tomorrow. The next slide looks at this somewhat similar situation, but this time using nominal prices to an income ratio, just a very simple relationship, and again shows that normal is around something under 3%, which is not really unusual for the United States. We have a lot of land. It's relatively easy to build, as Wendell Cox will talk about later, except in areas that have a lot of land constraints. And that drives up house prices a lot, and also leverage applied under a fixed supply, as Sam said, drives up house prices a lot. And we see that going on here. We are at a ratio that's relatively high today compared to history, and that, again, is cause for concern. The next slide, basically, I call the flame stitch slide that looks somewhat like what happens with a pressure cooker. If you close all the valves, the pressure goes up. Well, what happens when you apply a lot of leverage to a seller's market, you get very low incidence of price declines, which you see in this period where the red drops to virtually zero. When eventually you get to a point where it has to end and the lid blows off, we saw for the first time, at least in 4 generations, the incidence among 51 metros go up to virtually 100% in terms of price decline. The home price volatility is the next slide for 51 large metropolitan areas. Big takeaway is, one, California is the mother of all volatility, closely followed by Florida. There are other volatile metros. Out of the 51, there were a bunch of low ones in terms of stable volatility, but there are a lot of very high volatility areas in the country. There's substantial variation across neighborhoods within cities. There's a lot of dispersion of house price change. And when you're buying a house, particularly low income, you're buying one house and you're investing in that one house. There's a lot of risk associated with that. Next slide, first-time home buyer purchase loans shows seasonality that goes on here, largely relates to schools and other things like that. And so we see a seasonal trend. Again, the red dots show change year over year. And so we've had an increase in first-time home buyer percentage. The green dotted line is what the NAR reports. If you look at the last 4 months or so, you'll see, up, down 3 percentage points, up 3 percentage points, or up 4 percentage points, down 3 percentage points. It's all over the map, and you see none of that is really going on when you have a complete census. And it's the problem with a lot of the data that's reported in the NAR's cases. It's based on a very, very tiny survey that itself changes month to month. So it's like 1,000 or 1,500 individuals reporting. Finishing up on the shift from banks to non-banks, focusing on focusing on FHA. There's been a huge shift from nearly 70% bank share, large bank share, down to under 25% over the span of a couple, 3 years. The risk index, the banks are the only ones that are really declining in risk. They're stepping away. The rest of them over time have been increasing risk. The recent decline is again due to the shift that's been taking place between FHA poaching. The next to last slide shows FHA large lender market share versus non-banks, so large banks, non-banks. On the left side, you see it's almost all green with some gray. On the right side, you see it's some gray with the reds and the oranges. Red and orange are higher risk, green is lower risk. And so you see that the banks have much lower risk, and you also see that the non-banks, it's much more diversified in terms of the number. The last slide is an effort to look at change in credit standards by lender type in the overall market. The Fed publishes a survey every month. It's got, again, a lot of noise in it. What this shows is that by looking at the total composite, we've got an easing going on year over year, but there's actually little change for the GSEs. There's actually tightening in some cases and little change, but because of the mix shift to FHA, the overall trend is easing. With that, we'll turn it back to Steve.
Thanks very much, Ed. So I'm going to use my prerogative as the session chair to ask a couple of questions before we open up to Q&A. First one for Ted, and then a single question that I'll ask for both Sam and Ed. Ted, if I understood your methodology correctly, you assess the house price risk relative to the national trough, how far prices fell in the last housing cycle at the national level. But as Ed's chart showed, there's a tremendous amount of variation in how far prices fell across metro areas, and also tremendous variation within metro areas. So do you feel like the coarseness of the calibration is exposing you to risk if the loans that you're insuring are not spread like peanut butter across the country?
Yeah. So generally, our portfolios are spread out across the country. The loan level model and the grid-based model work differently. Talk about the loan level model, which is this 10-year projection. So we're marking the property values to market using the metro level home price index. So the grid-based model, it's all at origination. The loan level model, we're actually saying, well, from today, and I've got a 5-year-old loan, they've got 5 years worth of appreciation, I'm marking the property value to market using the metropolitan area level. I'm projecting home prices at the census division level from where home prices are today relative to their trend to a trough that's defined by nationally the worst decline relative to trend. So basically it's 13% below the trend line. The trend line and where I am relative to that trend line are set at the census division level. So I'm not using an overall national home price decline. I'm saying the decline goes to the trough level. The trough level to the trend is based on this national 13%, but I can easily have a census division where prices are right at trend, and that's going to be roughly 13% decline versus a market that's 20% above trend. You're talking a 30-40% decline.
Okay, thank you. And then the question for Sam and Ed. My takeaway from your presentations is that the two of you actually disagree about how tight lending standards are today relative to the early 2000s. So I'm trying to pick a standardized comparison date relative to today. My sense from Sam, from your underwriting index, is that standards today are tighter than they were in the early 2000s, and not just a little bit tighter, but substantially. And I take it from Ed's table, I think it was slide 5, that showed credit conditions along a number of different dimensions today versus the early 2000s, that conclusion is far from clear based on the data that he has. And so I'd like the two of you to talk about this, because I think this is a very important question where most of the discussions tend not to really reach a conclusion.
So yeah, when we look at the 6 factors, they're all tighter. The factor that is the tightest is FICO. What's interesting is even if we go beyond 2000, and the data gets thin, and Ed's exactly right, especially because not only does the number of loans shrink, but the share that have missing data becomes an issue. But for the ones that are there, and in the past I've looked to see if they're missing if they have, for the ones that have missing risk characteristics, where I do have risk characteristics, I look at them to see if those are different than the loans that have a FICO, and generally the answer is no. So if they're missing the FICO share or some other risk characteristic, I don't see risk embedded in other dimensions. So when I look at the data even a little bit further back into the late 90s, it's definitely tighter, and it's tighter in all those dimensions. But again, this relative to the earlier time periods, so in the 80s and 70s. No denying that. In fact, I did an analysis about a year and a half ago where I looked at foreclosure rates from the 50s using a couple old sources, an old FDIC paper, for both conventional and for FHA foreclosure rates. And I just built a simple model, and I looked at incomes, unemployment, savings rate, inflation. There was one other factor, and I don't remember what it was, but leverage by far and away blew away every other variable. What was interesting is inflation came through as statistically significant in the 70s and 80s, which was a sort of a reminder that it plays a role in all this, and it's a hedge. But yeah, in our data, it's definitely tighter than the early 2000s. I mean, I think we'd probably have to talk in detail to figure out where the differences are.
So yes, if you look at the slide 5, and I've got some estimates for 2000 versus 2013-14, and DTIs are about the same. FICO is definitely tighter, but median FICO as opposed to average, and averages tend to be lower than medians on FICOs. But the median FICO I show is around 700, and you showed at 660 or 670, somewhere in there. Again, an average might be more like 690 in my case. And then when you get below 640, there is a big drop off. But LTVs are actually, I show as CLTVs higher today than they were back in 2000, and particularly very high LTVs, CLTVs. Low doc, no docs are nil today, but they weren't that prevalent in 2000, and they weren't that excessive in terms of the fraud factor. There's some work you did on that. So it wasn't that big a factor. Low docs are, if there's no fraud built in, then what they're saying their income is, if it actually is that, it should perform like a documented loan. That didn't happen starting in 2003, 2004, as Sam has demonstrated. So some of these other, interest rates are a lot lower. And so The problem that I have is we've looked at, and I forget what years it was, 2008, 2009, DTI is something that is a big missing item. Back in 2000, it was almost entirely missing. I mean, it's hugely missing. When we looked at 2008, 2009, looking at CoreLogic data, we found that the missing DTIs had much higher, substantially higher risk factors associated with them than the ones that weren't missing. And a lot of them were missing. I think at that point it was 50% or something approaching that. And so that's one thing. When you look back in 2000, I think 50 or 60%, I forget the exact number, of FICOs are missing. I mean, there's a huge percentage of FICOs missing. And they're almost all the DTIs missing. And so you're dealing with numbers that get very thin, and then the mix is all changing. And so you have a lot of movement here that makes it difficult to actually figure out what's going on. So I've built up from some other data sources like what FHFA has published and FHA and some other things, and then tried to fill in from that based on what we actually do know based on large samples, large censuses of loans. I would say back on the change, and it's mentioned in here, there was a big shift in foreclosures that occurred in the late 50s, and it was largely due to two events. One was the introduction of the 30-year fixed-rate loan, which only became commonplace starting in about 1955 and was very widespread by the late 50s, early 60s, particularly for FHA and VA. It didn't become prevalent in the private lending sector until the late 60s, early 70s. And corresponding with that was low down payment loans. Less than 10%. Those became very prevalent starting in mid to late 50s. And so FHA's foreclosure levels were 8 times in 1964 what they were in the average of the 1950s. And so that, to me, is a demarcation point. This leverage explosion that took place is what really put us on the path to making foreclosures very prevalent. It was isolated to FHA largely. It didn't spread to the conventional market until we really got to 1992 under this affordable housing goals, which really forced Fannie and Freddie into competition, and then that spread throughout the entire market.
Just one quick comment that I just came up with as you were speaking. Are you looking at jumbos and portfolio stuff as part of your work? Because the two universes that we're looking at could be different in that dimension. Because
we're looking at the LLMA.
So that'll have some of that. Yeah. Okay. Yep.
So if I could hop in. So I can actually tell you a fair amount about every loan we've insured since 1957. So actually I have less of a thin data problem. And there's a very big difference between missing a DTI because somebody didn't write it down and missing a DTI because when the loan was originated, the lender said, I don't need to know your income. Those are two very different issues, and loans where you're missing the DTI because they didn't ask, those perform terribly, right? They perform like 60 DTI loans. Another quick observation, there's been some talk about 2000, the notice of the spike in defaults and correlating that with recession. Anybody remember in the capital markets what happened in 2001? There was a lot of subprime lending in private label securitization going on in 99, 2000 that stopped dead in the water in 2001. Long-term capital management blew up, right? The whole private label thing stopped. And then it started ginning up again in 2003, 2004, 2005, right? So looking at 2000 as, well, that's a normal year, I think is a big mistake. There's another historical thing you need to look at, which is, or two. One is in 1994, Freddie Mac published a letter to all of their seller servicers saying, thou shalt use FICO scores. And another is right about the same time, really 97, 98, DU and LP were released to lenders. And the combination of the relying on credit scores and the reliance on automated underwriting systems for determining eligibility and approval status for loans has radically changed the mix of these risk factors. If you look at the papers published by Freddie and Fannie on their automated underwriting systems, what they feature, right? The feature they talk about is, you know, this person who's 45 DTI is actually a good risk. And that's what they advertise as the benefit of automated underwriting systems. So I think we really like to go back to kind of the mid-90s to say, when was the last time we had something like normal, sensible, conservative kinds of underwriting guidelines, particularly around things like DTI, which used to be ruled by you had to have a sensible limit rather than saying, well, we're going to trade it off against these other compensating factors, and I'm going to let this model statistically determine, well, this loan's okay.
I'd add one other risk factor, which is the change in the capital gains law in 1997. That's when you saw the average appreciation rate sort of tick up above normal, and to me, that's sort of the root of the home price bubble began in 1998.
Great. Well, thanks very much. We'll now go to questions from the floor. We have about 25 minutes. Leela has the mic, and we'll come around. My only request is that you actually state a question. Okay, Penny. Next.
I have questions for everybody, but I'll start with Ted. On the my question is around your use of per capita income, and it makes me wonder, with all the publicity around the disparity of income, how do you look at the home buying public versus the estate buying public? If you look at per capita income, it's skewed as those two diverge, right?
I guess I'm not sure in what sense you mean per capita income is skewed. We look at it at a geographic level, saying for an entire metropolitan area or for an entire census division.
Right, but if the underlying data is diverging, so the rich are getting richer, the median income or the middle income is getting poorer, your per capita is still looking the same. But it's two different populations, one who buy houses and one who buy estates. How are you measuring that differently, or how are you identifying that?
We're not. I
Okay.
question the premise that the data I look at suggests that things aren't quite the way you're describing.
Okay.
So, in the end, you're really just saying the overall, we're also looking at the overall level of home prices, right? I'm not looking at individual houses, I'm saying the overall level of prices in this market. And, it's based on the fundamental premise that the value of housing has to be related to what people have for resources to be able to spend on it. And we can only
Right.
look at it in the aggregate. So,
Let
Okay.
me try to add something to that. I was just looking at median or real household wealth by quintile. And so I looked at the second quintile, which is your 40 to 80% of median, roughly, which is your lower end home buying public. Since 1986, real income for that quintile is up 2% in cumulative in 30 years. That's stagnation. When you look at I think it was the fourth quintile, I think was the one I compared it to, which is your, not quite your estate, but the upper end of the Fannie Freddie, 417. It was up, I forget, 17% or whatever it was. It was, swamped the 2%. I think that's the point you're asking about.
So if you constantly measure the middle,
Yeah.
it's not looking any different, but it's aggregating in two different places.
And I think what we found is the combination of these disparities in income growth combined with the volatility at the low end is really creating huge risk. And then you have the correlation that Sam talked about. And so you have a correlated market that didn't exist before. And the reason you have a correlated market, I think, is because of this chart here, is if you keep adding leverage during this boom time, and you create this boom during the seller's market, you're going to have a correlate. You're going to have all the prices going up, more or less, or a lot of the prices going up, and then you're going to create this correlation, and then you've got this disparity that's going on.
And I'll just add one quick piece. I think what's interesting about the income disparities is, we hear about student debt all the time. And I think the one piece you have to worry about there is the folks that take on student debt but don't get the benefit, they don't graduate, so that's one piece. I'm not worried about grad students or so much undergrads. But if you look at, and Pew's come out with data on this, if you look at those that have less than a high school degree, and I'm trying to remember what the share was, but it was at least 40% or so, their incomes are falling. And they've been falling the last few decades. And so for me, when I look at student debt, I mean, I know that wasn't your question, but when I think about that, I think student debt to me is not as big a deal. It's really the folks that are not getting an education and their incomes, and what are you going to do about them from a policy perspective?
Okay, I think we'll go next to a question from this side of the room. Maybe the gentleman in the very back.
Well, first off, I want to comment the fact that you said, but just because they don't graduate, they don't gain from it. Now, they might still gain from being there, even though they don't graduate. I think that's extremely important to note. But also, I think what has to be looked at is, again, I keep pushing the fact of how much is the Fed money in the market, and how is that benefiting and supplementing, the situation, and has it really moved at all from that?
What was the question? Do you want to take it?
I can take the first part. So my comment was about sort of the differences in income. When you look, there's a big difference between folks that graduate their income, the level and the growth, and those that do not. And that's the big bifurcating sort of point. And then you get the other, we need to get two others, those with grad degrees and then those that are less than an associate's degree. So I think that was my comment. I don't know if that clarifies it some or not. But.
And was the second part of your question about the effect of Fed policy on house prices? I wasn't sure I heard everything.
Well, it's not just the Fed policy, but the QE4, and we probably have another one coming, what they've been buying up so much and that risk underneath, because are they really, on the secondary markets, are they really checking the values on them? Or is the bubble coming again?
Well, I'm of the opinion that we have another boom developing. It's not necessarily a bubble yet, but there's certainly a boom, as evidenced by this one, both of these charts and the one earlier. It as long as we have a seller's market and you keep interest rates very low and or you keep leverage growing, that tends to feed on the seller's market. The seller's market is there are roughly less than 6 months of inventory on a national basis of existing homes relative to the pace of sales of those homes. And we've looked at that, and there's a very high correlation to when house prices are going up in real terms versus when you have these sellers markets, extended sellers markets, and they tend to last, at least based on the history we're able to go back to, a pretty long time. They don't just change 1 month and then back, and they tend to keep going up or keep going down, much like house prices tend to, nationally tend to keep going up or before they go down. They have momentum, and so we're seeing those same things. I would say, the problem is this leverage issue. And relying on leverage to so-called increase affordability, it's not happening. It's actually creating unaffordability. We had affordability back in, before 1992, before the affordable housing goals. 2.8 was the ratio of house prices to median income, median house price to median income. It started going up, in the later years in the 90s, and eventually got up to, four times nationally. And we're still at an inflated level. That's the problem, not the solution, and that's one of the things that we do a lot of work on.
I just want to add a little finer point to what you just said on the supply. So the month supply today is about 5.5 months for existing homes and new homes, but it's actually tighter than that because we've looked at the month supply by price tier, and if you go out at 150 to 200% of the median price, so 1.5 to twice the median price, there's plenty of supply there. The month supply is like 7 or 8 months. When you go on the very, very bottom end, so less than 50% of the price distribution, there's actually plenty of supply there too, because those are homes that are in very poor shape that most folks don't want. When you look at the month supply right in the middle, so from about the 75th percentile to about 120th, 125th percentile, the month supply there is in the 4 to 3.5. And I've done sort of a Phillips curve for housing, and the incremental changes in home prices the response to changes in the month's supply is much higher as you get closer to the bottom, just like we would from an inflation unemployment rate perspective. And so I would argue that supply is even tighter than what the official metrics convey them to be.
So
Just wanted to get
Just wanted to weigh in a little on this area of the question of the relationship of home prices to interest rates and affordability. This seems to be an area where economists check their training at the door and abandon sort of the fundamentals that, Finance 101, the value of an asset is independent of the value of the cost of the financing, right? So, the effect of interest rates on home prices should not be, interest rates are cheaper, therefore people are going to pay more for the house, although there is that effect. The reality is interest rates are the cost of spending today versus spending tomorrow. Low interest rates encourage people to spend money today instead of saving it and spending it tomorrow. Low interest rates on the investment side mean low cap rates. That increases the values people ascribe to a set of cash flows. So that's the impact on home prices, and it impacts the valuation of rental properties and therefore the rents that have to be acquired. They're subtler things, and it's not as easy to explain as, hey, the borrower's monthly payment is lower, but that's the real effect that's going on.
Yeah, let me add to something Sam said. So the policymakers, and you can look at the Fed, you can look at FHA. So FHA says we're going to drop premiums 50 basis points. That was the equivalent, roughly, of a 50 basis point drop in interest rate. But what they didn't look at was at that point in time, we were already 25, 26 months into a seller's market. And so what were you going to do when you increase demand and keep supply roughly constant, particularly on the low middle end? You're going to get higher prices. I mean, it's really economics 101, but you never hear that discussed.
Okay, next question, maybe the woman here.
Hi, my name is Li Yang. Thanks for your presentation. I think for all this affordable housing, I just wonder if you have verified the data rather than using the data that's put in the book. What I mean is verify the data on the book rather than just use the existing data that wherever who give it to you. And because I wonder, let's say if you are using the credit rating, if you are using the people's income or employment, but even if a person get employment, full employment, and in a high salary level, they still cannot have a home. Even if they have a home, they will be under foreclosure, eviction, and that would affect their family assets, and then that would affect their future children's potential to buy a home or house, and they affect all our credit ratings. So would you be able to say this panel or in later panels would investigate this, or anywhere they can address this type of issues?
So I think that the question was, is there a way for us to kind of check the data in terms of what was being given to us versus what it actually is? Is that sort of your question? The current.
To build a house is based on the competitive market rather than subsidize a developer, while developer take the asset away from potential homeowners or existing homeowners or their future generations' assets, minor account, whatever it is. So that is all related. But what we are saying, often they are using whoever put on the book. The agency didn't even say they had to verify that. And the Department of Justice didn't even say they had to be prosecuted. So I just wonder if we have a verified data based on the homeowners or based on the homelessness, they give you a complaint or they give you their voice to be heard.
Yeah, so I mean,
Why don't we try to address some of this?
yeah, I mean, so some of the data that we get is from we have two main ways of getting data, or actually more than that, but those are the two main ones are we get data provided to us by lenders There's no way for us to sort of verify what they sent other than checking it against other data sets, which we do. But there's one, or external data sets, but there's one way we can verify it against other internal data sets, which is pretty good, and that's the public record. So even though there might be missing data that's supplied to us on let's say a CLTV or something like that, some of that we can check in the public record, and you can't hide the public record. That's actually what's interesting. We had several very large banks come to us in a panic in 2008 and say, I've got a bunch of firsts and I don't know how many second liens I've got against it, right? And so in the data that they send to us, we can't tell either, but in the public record, everything's recorded. And so you just look at the property and then you can look at all the liens recorded against it. So that's one way we can address some of the issues that I think you were trying to raise.
All right, why don't we go to our next question? This side of the room, gentleman here with his hand up.
Thank you, gentlemen. Good morning. Really, just a quick two-part question. First, for Mr. Pinto, does as you're probably aware, FHA in their mortgagee letter 1402 released new manual underwriting guidelines which allow lenders to underwrite up to a 50% total debt to income ratio above what was the historical 43, provided there are certain compensating factors. Mike, as a banker that's working with borrowers and consumers every day, I'm curious if the risk index takes that into account for those loans where total scorecard in the automated underwriting is not approving them. And then the second question for the entire panel is your views or perspectives on Fannie Mae's new Home Ready product, which looks like a return to the old My Community lending standards. I think the Orange County Register had a story last week describing it as home ready for foreclosure, actually. So I'm curious as to your viewpoints. Thank you.
So on the first question, our index is based on what is released by Ginnie Mae, who gets the data from FHA, et cetera, for those three agencies. It does not include whether it's manually underwritten. It does not include some of the compensating factors, whatever they may be, such as reserves. I don't know that that's a huge factor for FHA. It includes the things we have. And that's what we show in that one chart that says when they get above 43, they're not using compensating factors that we can see that have been significant in the past for predicting default. We also show that they routinely go above 50. On your other question, I tend to agree with that. There was actually 3 different versions of this going back to 1992 or so. I forget the name of the program then, and then it was changed to another name, and then it was changed to this Home Ready. It's kind of like NEGAM loans, graduated payment arms became coffee loans, became pick-a-pay. You change the names to protect the guilty to some extent. I would only add that one of the flavors of the day is border income. That's where you rent your basement or whatever, and that's supposed to count as income. I went back to my files for 1993, and I found for whatever that program was called back in 1993, and I found a variance request to include border income in 1993 by Fannie Mae, granted to Acorn. And so I think we are getting into, if you can't change, if you don't want the DTIs to go up, change the definition of I in DTI. We've done that in the past by changing the definition of V in value. We're now changing the definition of I in DTI.
Any other comments on that one? Okay. Next question, Morris.
So a quick question. I think I understand the NMRI. It asks the thought experiment, if we were to have a 2007 through 2010 event again, what would the default rate be of the pool? And then we can ask, is that default rate less than 6% or some standard that we're happy with? So this came up earlier, and I wanted to make sure I understood it. We're comparing that to Sam's slide 6, which is a housing credit index. Maybe there wasn't enough time in the presentation, but could you go what is the housing credit index? How is it constructed, and what is it intending to measure? Because maybe the NMRI is just measuring something differently than the housing credit index.
So I'll go ahead and begin. So I think we're ultimately trying to measure the same thing, but it's just sort of different methodologies. And it's not just the two of us, but for example, Urban Institute's come out with their own index. MBA's come out with their own index. And at least when we've compared, I haven't done a detailed comparison to yours yet, Ed, and so I should. But when I've looked at ours compared to Urban and MBA, the results are similar, even though the methodologies are very different. But in terms of what we're doing, so ours is a loan level indicator, and we look at the 6 factors that I mentioned before, which are credit scores, LTVs, DTIs, low and no doc share, ARM shares, and broker, as kind of the 6 major factors that we look at. And we use a technique called principal components. And what it does is it takes all these different dimensions that are moving in different ways and reduces them into one or several dimensions that we can combine. And so here we measure that credit expansion or contraction in those 6 dimensions using that technique. But there is no sort of it's not a standard statistical technique in the sense we're not trying to predict anything, that's what's sort of unusual about the technique that we chose. There's no sort of left-hand side variable to it, right? It's just showing the movements in these dimensions, whether it's going up, out or in over time. But it's not sort of a standard model where it's trying to predict the default rate. But I have in the past compared that line to some of the charts that I showed you before, where I show the early SDQ rates, whether it's after 5 or 6 months or after 24 months. And the correlation is very high, because what's interesting about sort of this is one point I'd probably disagree with you, Ed, is yes, delinquency rates are backward looking, but I think if you look at from a vintage perspective, it gets you a pretty good look, because if you look back, for example, on my slide 7 where I look at SDQ after 5 months, each of these vintages have its sort of own fingerprint. And you can clearly see there that 04 higher than or worsening risk than 03, 05 worsening risk than 04, and in fact 05 was a shade lower than 2000, which was a recession year, which should have been a huge warning sign, even 5 months after they were originated in 05, that they're performing marginally worse than a recession year. And in 2005, low unemployment rate, strong job growth, strong economy, very strong home price growth. That shouldn't be happening. That tells you something's wrong. So is that enough detail, or if not, I can talk to you afterwards if you want.
Yeah, maybe afterwards, so we can get to more questions. Alex?
Thank you. Alex Pollock of AEI. Ted, I'd like to ask you about your very intriguing last slide on the countercyclical capital ratio, which you teasingly left off the values on the y-axis. But you can see, it looks like, that the capital requirement was about 3 times, or would have been about 3 times, say in 1907, what it would be today, for example. Just from that.
Orders of
from that
magnitude,
slide.
yes,
Orders
roughly
of
that.
magnitude, more or less 3.
And one of the key factors that's being included is the 25 to 1 is being retained. So our minimum capital level will bottom out at 4%.
I have 2 questions about that. One, what is your speculation if such a system had been in place in 2007, where the system was now saying to the insurers, you got to have 3 times as much capital as inlets in good times or good years? What would the effects of that have been?
Sure.
And secondly, if you apply the same logic to Fannie and Freddie, what would their capital requirements be?
Well, I'm going to leave that to Smith and Wire, who've already done that calculation as part of their work. Your first question, needless to say, when we presented this model to the folks at Treasury and FIO, they asked exactly that question. So what would you guys do? We essentially have 3 levers we can push. One is, of course, pricing, right? If there's more capital required, then it should be more expensive. Another lever is guidelines. We can try to eliminate business in certain areas where that capital level is getting too high and concentrate in levels where the capital amount is lower. And the last one, of course, is raise more capital. And I think if you replay the years 2004 through 2007, and I'll speak specifically for MGIC, we dividended out of our writing company to our parent company and returned to shareholders, largely through dividends and mostly through share repurchases, a substantial amount of capital. That if you look at what was going on in 2005 and what would have been required of us in terms of capital, the marginal capital for the business you're writing, clearly our industry would not have been shedding capital. We'd have potentially, like in a year like 2005, how cheap it was to raise capital. It could well have been raising capital instead of shedding it in 2005. So I think all three of those levers I would point to as reasonable responses. An important aspect of it, though, is, and in particular, what if Freddie and Fannie are subject to the same, and in particular, what if all the participants are subject to the same kind of counter-cyclical capital regime? Well, the way this is being implemented is NAIC, the Organization of State Regulators, every 90 days is going to publish the changes to the market ratings and the changes in that insanity index, right? The very publication of those items and the movement from an A market to a B market or increasing a notch the level of underwriting insanity is a very important market signal. And that was something I think they were quite focused on, the importance of that market signaling and the potential for this to prevent ever getting to a D market again, right? If you're gradually making credit availability more limited or more expensive, as these conditions are building, the whole purpose of it is to prevent the bubble from happening in the first place.
Okay, well, we're out of time at this point. Let me thank the three panelists for great presentations and great Q&A. And we'll take a 15-minute break and reconvene at 10:25.
Thank you, Sam. Pleasure. Thanks, Ted. Hey, I want to, you can, see, yeah, we should call this the effect right here. I think 8513. There are some differences in the
Can everyone please take their seats? Thank you very much. We're going to start the second panel. Keep the show on time.
Nice to meet you. Nice to meet you too.
Well, we're very pleased to have a distinguished panel and a less distinguished moderator run our second panel on measuring intrinsic value. So what I'm going to do here is I'm going to give each speaker 40 minutes, and then we will open up the floor to questions afterwards. So you could ask, what are we doing? What does it mean to measure intrinsic value, and why do we care about that? And so let me give you my take on this and why this is important. In the previous session, we talked about risk factors, and one of the key risk factors was the loan-to-value ratio, and we put that loan-to-value ratio into buckets: 80, 90, 95, 75, et cetera. I think the question that wasn't asked is an 80 loan-to-value ratio a safe bucket at all points in time? And the way to get at that is, the other way to question that is, was an 80 loan-to-value ratio a safe bucket in 2006? Or was it much less safe than an 80 loan-to-value ratio loan made in 2010? So I think we have to be aware that the way that we bucket risk factors depends on where we are in the cycle, in a housing cycle, and therefore we have to start being serious about measuring where we are in a housing cycle. That's very, very difficult. That's a very, very difficult task. And so what we're going to do now is hear two different approaches about how to do that, or how to at least think about doing that. And since it's difficult, we're going to allocate a lot of time to talking about it. So our first panelist, you've heard enough from me. We're now down to zero marginal benefit from my contribution. So our first panelist is Rick Palacios Jr., and he's the Director of Research at John Burns Real Estate Consulting. And Rick, you've got 40 minutes. Thank you very much.
Okay. So first off, thanks for having me. I know John was here last year, so hopefully I live up to expectations. Just a little background about our firm. So we're headquartered out in Orange County, California. Got about 20 offices spread across the country. And so we're really an independent provider of housing research and consulting services. Our client base includes a lot of the big public home builders, as well as some of the larger private home builders. Same goes for building product manufacturers, distributors, single-family rental operators, mortgage insurers, land developers. So it's really anybody that touches housing. And then we also have a lot of institutional investor clients that trade housing that pay for our research. So just kind of a little background on us. So this is really an overview of the presentation I'm going to give today. It's about 30 or so slides. And I wanted to start off with kind of some high-level macro information on how we're looking at the cycle, where we are right now, and our thesis. Then getting into some of the more MSA and regional color that we provide. Third part of it will be dipping into our intrinsic home value index, which is kind of the point of this panel, but I wanted to kind of tease it a little bit. And then the last part of the presentation will just kind of boil it all down into how we summarize risk for every major market really across the country. And I'm only going to give it 3 or 4 examples, so I won't bore you with 50 or 60. So this first slide is really, as we kind of got into this very painful downturn and slow recovery, we were really trying to set this kind of anchor for what is this cycle like. It's obviously very different from anything we've ever seen in terms of history from a U.S. perspective. And so, interestingly enough, we looked at some of the very, very painful downturns in Texas as well as Southern California. And so we found, when we looked at a lot of the very housing-specific metrics, home prices, single-family permit activity, even jobs for the most part, that the duration of the pain and then the upturn was very similar. So this first slide shows single-family permit activity, and the orange line is Houston, Texas. And what we've done is we've set the index 100, the starting point, to really the peak in that cycle. So that's the case for Houston. the Southern California cycle is 1988 is the peak, and then the U.S. cycle is 2005 is the peak. And again, this is single-family permanent activity. So what you see when you look at this chart is a very similar pattern of about 3 to 4 years of year-over-year declines, so a lot of pain. Then you see about another 3 to 4 years of kind of flattish growth, and then there's a slow upturn. And so right now, from a U.S. perspective, we're in year 10 of the recovery thus far. And if you look at the other lines there, the Southern California example, as well as the Houston cycle, again, very, very painful housing cycles, very similar in terms of the trajectory. And so this is something that helps us as we kind of think about the go forward and how we think about our forecasts. The next slide here shows, again, the three same anchors, or two anchors, Houston and Southern California, but this is for home prices. And so you'll see again that there is a very similar trend in terms of 4 to 5 years of pain, and those are basically price declines across all of these examples, followed by 3 to 4 years of price appreciation. Obviously in Southern California, prices spiked after year 9 or 10, so it's a little bit different from how we're thinking about this U.S. recovery. Texas, Houston specifically, was a little bit more similar in how we're thinking about this recovery. You can see the dashed line blue is how we're modeling out home prices going forward, and we model out to 2018. So this next slide breaks down our home price appreciation forecasts, and we do our own in-house proprietary index. We call it our Burns Home Value Index. And so this chart shows the annual change in home prices at the national level going back to 2001. So you can see there, blue, obviously positive appreciation. Red, that was the pain during the downturn. We've seen some solid price appreciation starting in 2012. And our current forecast is that we'll see about 4% price appreciation next year, followed by 3% in 17, 2% in 18. We've had quite a bit of price appreciation, and so that obviously factors into our thesis going forward. The other thing, too, is, and I think this is kind of echoing what the first panel talked about a little bit, is just that we are getting concerned about affordability being stretched. It's not the case in every market, and I'll get to that later on, but it is definitely the case in some of the coastal markets, some of the Texas markets, some of the Florida markets. So that's one thing that we're feeding into our thesis, is that as affordability gets stretched, obviously we don't think prices can continue to run. And the one thing that we really try to hone in on and communicate to our home builder clients is that a 1% increase in the fixed rate mortgage really leads to a 12% increase in your mortgage payment. So you can see how 1% doesn't sound crazy, but it's actually a 12% bump in your mortgage payment. And at the end of the day, that's essentially what drives the consumer's ability to afford that home. So I just wanted to put this slide in here because visually it allows you to realize just how long this cycle of lower and lower and lower rates has been. It's about 35 years, and as I was kind of looking at it, I realized that I was born in 1981, which is when rates peaked there, about 17%. And for my entire lifetime, rates have just been steadily declining. We think that that's going to reverse. We don't think that rates are going to rise at 100 or 200 basis points annual clip. We think they're going to rise more along the lines of a 20 to 30 basis points clip and not even surpass 5% going out to 2018. And so I know that sounds very, very low, but I want to give you a little background on how we think about our mortgage rate forecasts. So these are our two very macro, very important drivers in terms of forecasts for housing. And so the first chart there on the left is our 30-year fixed rate mortgage forecast, and this is the annual average for the year. So again, it looks very low, but one of the things that we did this year, because we didn't like the way that our rate forecast was panning out in prior years, is we switched from a consensus of what economists are thinking to a purely bond market, what is being priced in the forward yield curve. And so we did this in January of 15, when the majority of economists were forecasting 4.5, 5, probably even higher than that for 15. Switched over to, well, let's see what the bond market's pricing in. Bond market was pricing in about 3.9% for the annual average of 15. And it's turned out that forecast has been much, much better for us. Now, I don't know about the long-term projections. I don't know if maybe the 3 or 4 years out, what the bond market's pricing in is as good, but I definitely think the short-term projections have been more in line with what has happened versus economists. And we're economists too, so I lump our original forecast in there too. But that's really how we're thinking about mortgage rates going forward. And again, that's what's happening with the 10-year Treasury. We layer on the 170 basis point spread historically for mortgage rates. It's how we get to our mortgage rate forecast. And so if you look at the chart on the right, that is our job growth forecast. And again, this is at the U.S. level. And so for the most part, we're not calling for a recession. And a lot of people see this chart and they think, wow, that's not very solid job growth. That's a recession. But it's not a recession. It's just a pullback. And I'm going to get into kind of where we are at in the cycle in terms of the duration and how we're thinking along those lines. But not a recession, just a pullback in job growth. So this chart right here shows the annual rate of job growth, again, at the U.S. level, going back to the early 1960s. And so what I want to point out is that if you fast forward to the right there in the chart, you can see that from a job growth perspective, we're 6 years now into the recovery. And again, I think this kind of echoes some of the stuff that was talked about on the first panel. That's pretty long when you think about the historical duration of a recovery. And so we have to kind of feed that into our thesis from a macro housing perspective as we get into the outer years of this recovery, 16, 17, and 18. And so the other thing that I found interesting when looking at this chart is that if you look at the recoveries in terms of job growth from the 60s all the way up through the 80s, the peak in annual job growth exceeds each prior recovery going from the 60s up into the early 80s. And that is essentially reversed if you look at the job recoveries from the early 80s to now. The anomaly is this recovery. We actually have exceeded the prior recovery in terms of job growth. I think that's just because of the vast pain associated with this downturn. But I just thought that was kind of an interesting thing to point out. And for the most part, we think that pattern is going to continue. So a lot of things happening with the labor force. Demographics are definitely a headwind there as well. And I think if you just think about things from a fundamental technology perspective and efficiency and productivity, there's just not necessarily as many jobs to go around these days versus it could have taken 10 people to do something 5-10 years ago. Now it takes one person to do one of those tasks. So that factors into our thesis as well. So I love this chart because it really just provides a snapshot of the duration of recoveries going back to the 50s. And so a quick way of kind of explaining this is that if you look at the first bar, it shows essentially how the recovery that started in 1991 lasted 10 years. The recovery that started in 1961 lasted almost 9 years. So that's how you explain each of those bars. And the historical average of an economic recovery is about 5.5 years. And even though the recovery hasn't been phenomenal thus far, we're now getting past into the 6th year of the recovery. So again, that kind of feeds into our thesis on when we see job growth starting to pull back. 2017 would actually mark the 8th year of the recovery. So if the recovery continues on through 2017, we're going to get stretched to being the second or third strongest recovery going back to the 1950s in terms of duration. So that was kind of an overview of our macro thesis, and there's a lot of other nuts and bolts going into there, but I didn't want to bore you with everything we're thinking about these days. But really what our clients pay us for, in addition to kind of our macro thesis on housing, is what's going on in really every single major housing market across the country. Like I said, we've got a research side of our business. That's the side that I head up. And then we've also got a consulting side of our business. And these are our offices spread across the country doing feasibility studies for home builders in all kinds of markets: Atlanta, Charlotte, Florida markets, Texas markets, really just kind of spread across the country. So we really think we have an edge in terms of the qualitative color that's coming out, kind of boots on the ground. And that feeds into our quantitative research as well, specifically our forecasts. And so what this map shows is how we're rating every single major housing market across the country right now. We go through this very exhaustive process where we get on a call, our analysts, as well as our consultants that are out in the field, and we go through, okay, what are you seeing in Atlanta right now? What's happening? What are builders doing? What's happening on the resale side? And then we've got our analysts desktop looking at probably 50 or so charts on supply, demand, affordability, and we're kind of tying all that together, making sure that one person's not missing what's happening on the ground, the other's not missing what's happening in terms of the data side. And so after all of that, every month we come up with a rating on the market going from very cold all the way to white hot. And warm would be that kind of middle ground, normal type of sales environment, normal type of pricing environment. And so what you see when you look at this map is that for the most part, we're seeing warm conditions across the country. However, in the Northeast and Midwest, most of the markets are currently cold, so basically underperforming. There's a lot of different components to that. One being that we just have not seen a solid job recovery in a lot of these markets, not much consumer confidence. If you're a home builder, you don't have much pricing edge, a lot of competition. So that feeds into our cold rating there. If you look at the West Coast, that's where you'll see some of those red dots, Seattle, Portland, San Francisco. So these are some of the very, very hot markets where we're seeing just fantastic fundamentals, even though we are starting to get concerned on the risk side, specifically affordability, and I'll get into that a little bit more. Other cold markets that are underperforming right now, Houston, which is no surprise given what's going on in energy. So in addition to this kind of metro level analysis and color that we try to provide, we like to roll it up on a regional level because a lot of our clients, specifically our private equity clients, don't maybe necessarily care about the granularity of Orange County or Tampa. They've got an investment that covers maybe the Southeast region, so they just want to kind of pay attention to that, or maybe they're heavy in Texas, spread across the entire state. So that's the goal really of this slide. Again, this is a monthly process that we go through where we're taking into consideration a variety of variables: job growth, resale volume, resale supply, new home supply, price appreciation, affordability, the qualitative color channel checks that I talked about with our consultants. And we essentially roll all up and rank these regions. 10 regions across the country. You guys can kind of see what the acronyms mean there. But what I will point out, it's very interesting how you can rewind back to February of 15 and see Texas there ranking as #1, best performing region according to our analysis at that point. And it has steadily declined to where it's now ranking 8th out of 10 down there with the Midwest and Northeast. Again, we all know what's going on with energy, but that's kind of the value add that this type of breakdown provides. Again, the hot markets doing pretty well, though getting a bit concerned on the pricing side and affordability are those tech markets. So Northern California there ranks at the top, and the Northwest. So that's the Bay Area, that's Seattle, and even Portland as well now. So just speaking a little bit about the risks, one of the things that we've noticed, and I talked about the Northeast and the Midwest where we have seen that kind of job pullback, there's been a pretty big spike in layoff announcements. Challenger puts out this monthly report where they aggregate that data. I think it's the only source out there as far as I know. And when we roll up the data and provide it on a state level, what we noticed is that there is a lot of job layoffs going on, obviously with Texas, the Northeast, the Midwest. I think what's happening is that, this is all in the press. If you read the Journal every day, I think there's an article. Strong dollar, commodity slump, slowdown abroad, really hurting those economies that are dependent on manufacturing, energy, mining. The stat that stood out as we pulled in this data was that job cuts year to date, just through September, have already exceeded full year job cuts for last year. So we haven't even gotten to Q4. So that was one of the things that stood out to us as we were kind of pulling together our research last month. And so we're thinking about risks all the time. This is just a brief overview of, I guess, some of the regions and how we're thinking about risks. So obviously industry specific, oil, a lot of pain in Houston, starting to see some of that in Denver as well, even though it doesn't have as much exposure. The defense sector, obviously here in DC, impacting consumer confidence, what's going to happen there. To a lesser extent, San Diego as well. Those tech markets that are very, very frothy right now, according to us, San Francisco Bay Area, Seattle, even Austin as well. And then agriculture, the drought impact in California, specifically Central California, is having an impact on jobs there. And then we also think with the downward trend in commodity prices, specifically ag-related, you're starting to see a little bit of pain in the Midwest. Foreign investors, heavy in markets in California, Florida, as well as Arizona markets. A lot of Canadians like to come down. But given what's happened in those economies, a lot of them dipping into recession, we all know what's going on in China with the slowdown, we've started to notice a pullback across a lot of housing markets that are dependent on those forward buyers. So a lot of risk, a lot of data points, a lot of analysis. Again, we try not to overwhelm the client base. We try to kind of boil it down as concisely as we can. And so one of those tools that we provide is our housing cycle risk index. And so a lot of information in this slide, but at a high level, what our housing cycle risk index does is it layers in a variety of supply, demand, and affordability metrics across every single market that we care about, housing specific across the country. This chart here shows only the top 20 markets really from a new home volume perspective. And so when we built this index, what we found is that it is actually a very good leading indicator for prices, both on the upside and the downside, about 1 to 2 years out. And it's a subjective model as well, in that we've weighted different inputs accordingly for various markets. So in a market like Orange County, where affordability is very, very important, we're weighting that a little bit more with our housing cycle risk index. And an A on this would essentially mean risk levels are very, very low. A C would mean risk levels are along the lines of a normal historical risk. And then you get into the F, and I think we all can figure out what that means. You don't want to be in that market. So when you look across this, you see, well, really, most markets are performing at what we would consider relatively low risk levels. A lot of Bs in there. You've got markets like Charlotte, Atlanta, Tampa, where we think there is still a decent amount of recovery left with respect to housing. Then you look at some of the markets like Houston, again, which I've spoken about a little bit. Fundamentals are really starting to fall off a cliff there. Risk levels getting very, very elevated. And then other markets like Austin and Orange County, not there yet, but what's driving that, and we think that it probably is going to get into territory where risk is elevated, is that it's that affordability component. Prices are just getting so out of whack on a variety of metrics, and I'll get into kind of how we think about affordability, but that's what's driving that. So talking a lot about affordability, I think a lot of people don't really realize how far home prices have run with respect to where they peaked at in the last cycle. And so what this chart shows is across a lot of the major markets throughout the country, what have prices done from a peak to trough perspective, and then kind of where are we at now. And so a lot of data in here, a lot of percentages, but I think if you focus on the right side of the chart, where you look at markets that are already above prior peak, it's pretty alarming. So markets like Houston, prices are already 24% above prior peak. Denver, 23% above prior peak. Dallas, 22%. So I could go on and on. There's a lot of markets that prices have already gotten way above what the prior cycle peak was. Then you look over to the left, and these, again, most of these markets that where prices haven't got to prior peak tie to some of the markets that we don't see risk levels elevated yet. So a market like Vegas still almost has about 60% price appreciation left to get back to prior peak levels. Similar percentages for Orlando, Miami, Riverside. These are markets that just saw a ton of pain during the last downturn. So now trying to kind of segue into affordability and then later our intrinsic home value index. I just wanted to point out that prices are appreciating at a pretty solid clip across most of the country. This again is our Burns home value index, and it shows what the year-over-year rate of home price appreciation is right now across 20 of the largest markets. You'll notice that those markets up at the top, a lot of tech exposure. So Denver, even though most people don't think about it, actually is starting to get a little bit, I shouldn't say a lot, but a decent amount of tech jobs. A lot of people moving there from tech-focused markets where you could say maybe the Bay Area, Seattle, moving to Denver because provides that kind of similar quality of life, a lot of tech jobs. And so we're noticing this really big spike in price appreciation in markets like Denver. San Jose is up there, Austin as well, and Seattle pretty close. So double-digit home price appreciation, obviously not sustainable pretty alarming for the most part. The interesting thing, too, is that the rate of home price appreciation is actually re-accelerating in several of these markets. So I think that's also something that doesn't get that much press attention. So markets like Denver, a year ago, home prices were rising at about a 9% annual clip. And you can see in this chart, we're now running about 15%. San Jose was running about 9% a year ago in terms of home price appreciation, now running at a 12% clip. So that's a pretty interesting stat that I don't think gets much attention. So now going into affordability and really how we think about it, there's a variety of ways to think about affordability. You can do it on a price, 15 minutes, okay, I'm good. A price to income ratio perspective. And again, this is our top 20 markets. We don't think this is the best way to look at it because it doesn't take into account what rates are doing. But if you want to paint a picture of prices getting out of whack, this is definitely a very easy way to do it. The blue bar there is the current price to income ratio, and the green bar there is the historical average for all of these markets. And what you'll notice is that the blue bar exceeds the green bar in every single market. Markets in California obviously getting way out of whack on a price to income perspective. Even in markets like Tampa, this metric is actually crossed over its historical average. And so another way that people like to look at it is on a payment to income ratio perspective. So, because obviously rates drive affordability, so we think this is a better way of looking at it. Again, looking at those top 20 markets, you can see that most markets are below the historical average from a payment to income perspective. But even with 3.9% mortgage rates, we're seeing markets like Houston, Denver, Austin, San Diego, and then those California markets where the payment to income ratio has already gotten out of whack and crossed above its historical average. So those are two of the more traditional ways of kind of gauging affordability and how that's trending in markets. You can see that one story tells a completely different story from the other for the most part. And so that's part of the reason why we came up with what we call our intrinsic home value index. So high level, really what this index does is it kind of tells you where home prices should be trending based on long-term normal fundamentals. And I'll get into really the core assumptions in this intrinsic home value index that we do. You really have to say, well, what do you think normal means? What are normal mortgage rates? Obviously, that's a huge assumption in the model. And then number two is, well, what's a normal housing cost to income ratio assumption? So these are the two levers that you can play with for the most part. Our mortgage rate assumption for normal is 6%. And I think you saw in that chart that I mentioned that showed 35 years of falling interest rates. We don't think that's going to continue. And so we think that a normal assumption for mortgage rates going forward, and just kind of over time from an intrinsic perspective, is 6%. And if your assumption is that interest rates should be 5%, then obviously you're not going to get as many markets that are beyond their intrinsic value as we are with a 6% assumption. And that's a universal assumption across all markets. Obviously, it's interest rates. The second assumption that's in this is the housing cost to income ratio assumption. And this is MSA, metro level specific, because the normal housing cost to income ratio in a Texas market is probably in the mid-20s versus a normal housing cost to income ratio in the Bay Area is up in the 50% ballpark. So obviously, every market is different. And what we've done too is that because our thesis is that housing is just going to get more expensive and more expensive going forward from a housing cost to income perspective, is that we've dialed up what we think normal is about 50 basis points for every single metro across the country. And then we've even dialed it up even more for our, say, California markets, where we know it's very, very supply constrained. People continue to want to live there. Housing will only get more expensive. So for markets like Los Angeles and San Francisco, we've adjusted what we think is a normal housing cost to income ratio up by 250 basis points. So there's that type of kind of lever pulling here and there for various markets across the country. So I'm gonna give you a couple examples. I'm gonna try and blow through these because I think I probably have about 7 or 8 minutes left, maybe. So this is our intrinsic home value index for Houston. And so again, the normal assumption here, long-term trends, is that rates should be around 6% and that a housing cost to income ratio in Houston should be about 26%. And so when you then layer in what are prices right now, you get to a point where home prices are 19% above what we would consider to be the intrinsic value in that market. And this isn't meant to be an alarming thing, because we all know that prices can run for a long time above intrinsic value as well as below intrinsic value. But we just see it as a very good long-term informational tool that our clients can use when they're thinking about their investments. And just to give a few more market examples, San Jose, again, how I was going back to how that second assumption on housing cost to income ratios, much higher in that market. So in San Jose, we think a normal housing cost to income ratio would be about 50%. Again, using our 6% normal mortgage rate assumption, you get to a point where today home prices are 24% above what we would consider to be the intrinsic value in that market. Same thought process for DC. Home prices today 5% above, so not really totally out of whack, but 5% above what we would consider the intrinsic value in that market, based off of 6% mortgage rate, long-term norm, 27.5% housing cost to income ratio. And I'm going to jump past this one for the sake of time. So when you look across the country, because again, we do this intrinsic value index across all major markets, assuming normal means 6% mortgage rates, and then assuming normal housing cost to income ratios in all these markets, you can see there's a lot of red across the map, and that's basically telling you that the majority of markets are already overvalued from an intrinsic perspective. The only markets that are fairly valued, you'll see, are those yellow markets, and there's one market that is undervalued, and that's Chicago. Chicago has just had a really, really painful downturn, and recovery has been non-existent. So that's what's painting that picture for Chicago. Do I have about 2 more minutes, or?
You have until 11:08.
Okay, all right. So, a lot of information, a lot of different proprietary indices that we provide to help kind of communicate what the heck is going on in housing across the country. And so what I've tried to do is boil down how we're thinking about risk in various markets as just kind of an example for these last 3 slides. So, a lot of colors, so I apologize for that. But this is essentially Houston. This is how we're thinking about Houston right now, all in one slide. And so, overall, market conditions are cold. That's that first dial on the left there. This is the process I walked you guys through early on in the deck, where we get on the phone with our consultants, we're looking at all the data, we're factoring in the qualitative color they're hearing in their feasibility studies. How do you think the market is performing right now? So that's that dial there. You can see September, October, cold conditions in Houston. You go over to the right and you see our housing cycle risk index in those first 2 bars. So where are risk levels now? Green would be very low, red is very high. So currently risk levels are getting a bit more elevated than what we would consider to be normal risk levels. The third bar there breaks down the components of our housing cycle risk index. So that's demand, supply, and affordability. You can see that affordability and demand about average, supply below average. We are noticing a big spike in supply levels in Houston. So that's what drives our housing cycle risk index. And then the third bar to the right there captures our intrinsic home value index. So green would be underpriced, red is overpriced. That 19% ties with the slide I just presented on Houston, our intrinsic home value index. So home values today, 19% above what we would consider to be the intrinsic value. And I won't go into San Jose and DC just for the sake of time. But if you guys have any questions, y'all have the presentation too. So, reach out, any questions, more than happy to answer. That's it.
Well, let's ask. We'll have a section for Q&A. So, Rick, if you're done, let's go straight to Steve's presentation. So let me introduce Steve very briefly. I should introduce the panel. Rick, this is Steve. Steve, this is Rick. That's an old joke. I apologize for that. So Steve was my former boss at the Federal Reserve Board, and he was an excellent boss. But he's since moved on and to better things, and now he's with Ed, the director of housing and housing risk research at AEI, and is also has an appointment at UCLA. And Steve's going to talk about research that we're doing. So, Steve, you've got 40 minutes.
Great. Thanks, Morris. Thanks, first, for that very generous introduction. So the research that I'll be presenting is joint work with Morris, with Ed, and with Sankar Boka at FNC Inc. Suffice it to say, the views that are expressed in this research presentation don't represent those of the institutions that we're associated with. Let me just get the slides to the right place.
I should have done that, sorry.
No, that's okay. One thing I should say before I get started, there's some very detailed granular maps that I'll be showing as part of my presentation. If you're not close to one of the big screens, I would suggest that you take out the slide deck and look at it at your seat, because you won't be able to see a lot of the detail from far away from the screen. So the research that I'm going to talk about in terms of methodology is very complementary to what Rick presented, and also very different in one important way. Rick's research is great, and we're big users of it in the Housing Center here at AEI, because it amalgamates a tremendous amount of information, on-the-ground information, data, et cetera, into very intuitive, easy to understand conclusions. But it's the breadth that's really fantastic. What I'm doing is drilling down with incredible detail on one of the factors that is important for assessing collateral risk, and that's land valuation. So in that sense, what we're doing is both complementary and different. So just as an introduction, really one of the key lessons from the financial crisis is that we needed better information than we had about risk in housing and mortgage markets. And indeed, that's, thanks. It's hard to see the slides. Am I on the right one? Thanks. Okay. And that's really one of the themes, the central theme of this conference. What I'm going to present today is quantifying that risk in one important dimension, collateral risk looking at land values. We focus on land values because this research and a lot of prior research, some of which Morris has done independently, has shown that the land value, the land part of the house, is the risky part of the housing bundle. It's not the structure, it's the land. So you have to really focus on land to get a sense of whether valuations make sense. What we're doing in this research paper is estimating land value at the property level for detached single-family homes in 10 representative metro areas in the United States. And we take the data back to the year 2000 to characterize, excuse me, the boom-bust cycle in those metropolitan areas at a very fine level of geography. The data set includes about 9 million individual properties, which is orders of magnitude bigger than any of the prior studies of land. Turning to the next slide, the key takeaways. We find, first of all, that land prices are more volatile than house prices. This isn't a surprise. This is consistent with every prior study of land valuation that has been done. The only exception is for metro areas that have very stable markets. In our data set, an example of that would be Oklahoma City, where house prices didn't rise a lot, land prices didn't rise a lot, house prices were fairly stable on the downside, as were land prices. But in the markets that had a boom-bust cycle, it was the land that was really doing the boom. What's new in this study, by turning on the microscope at the individual metro area level, we're able to see that the volatility of land prices was greatest in the zip codes that started out with very inexpensive land and a low share of value that the land accounted for. The land share of value jumped the most in those zips during the boom, and importantly, we found that the extent to which the land share rose was a useful predictor of what happened to house prices during the bust. And that was true even when you had information that you were taking account of what happened to house prices on the way up. Looking independently at what happened to land had information that was not in the house prices. So overall, this provides, I think, a rationale for focusing on land for assessing house price risk. So this slide shows the metropolitan areas that are in the data set. There are 10, as I mentioned. They are chosen to be broadly representative of U.S. housing markets. We have 3 on the East Coast, Boston, Washington, D.C., and Miami, 3 in the West, Los Angeles, Phoenix, and Seattle, and 4 in the interior part of the country. 2 are larger markets, Chicago and Detroit, and 2 that are somewhat smaller markets, Memphis and Oklahoma City. Today for the presentation, I'm going to focus on Los Angeles to illustrate the results, and then as I get to the latter part of my presentation, I'm going to circle back to the general conclusions that can be drawn from all 10 metros. So before I go to LA, let me just talk a bit about the sample that we have. Actually, sample is the wrong word, the data set that we have for each of the metropolitan areas. As I mentioned, in total, we have about 9 million single-family properties. Los Angeles is by far the largest part of our data set with nearly 3 million properties. Relative to the census of detached single-family homes in each of these metro areas, we have a very large part of the market in every one of the metro areas, ranging from a minimum of 88% of the total census count of the properties, up to a little over 100% in Oklahoma City. Now, the 104% for Oklahoma City, you can ask, well, how can you have more than the census? And I think the answer is that we don't know for absolutely sure whether some of the properties in our data set are detached or whether they're townhouses. And so there are some small number of townhouses that are in the data set because we can't tell that for every property with 100% certainty. So all of these census coverage ratios are probably overstated by a few percentage points, but nonetheless, the coverage is pretty close to census rather than being a sample. We use the geographic definition of zip groups rather than zip codes. Some of the zip codes have very few properties, so where an individual zip code has fewer than 1,000 detached single-family homes, we amalgamate it with surrounding zips so that the group of those zips has at least 1,000, so that we don't have a small sample issue in any of the individual zip groups. This is a snapshot of some of the key economic and demographic characteristics in the 4 counties that comprise our data set for the LA metro area. The first thing to note is that this is a very populous area. The total population of the 4 counties is about 18 million people. Roughly 6% of total US population is in the metro area that I'll highlight for the study. LA County alone has 10 million people. Of the 4 counties, Orange County has the highest income and education levels and the lowest Black and Hispanic shares of the 4 counties. And I'll come back to how some of these characteristics are correlated with the results that we see. At the other end, San Bernardino County has the lowest income and education, highest Black and Hispanic share. Riverside is quite similar in many respects to San Bernardino, but it also has some very affluent areas, think Palm Springs, for example, that skew some of the median numbers upward. LA County is both huge and very diverse. In the aggregate, its profile looks like Riverside, most like Riverside on income and the Black Hispanic share, but it's closer to Orange County in terms of education. And we'll see that diversity in the results. So just a couple of minutes on the data and the methodology, and then we're going to get to a lot of pictures, so bear with me for just a couple of minutes while we walk through some of the necessary preliminaries. So the data that we use are really of 2 sorts. The first is property level data for the 9 million properties that I mentioned. We have information about the house characteristics, how many bedrooms, bathrooms, lot size, et cetera, exactly where it is in terms of latitude and longitude coordinates, when it was built, what it sold for over its history, and it's an estimate of its very recent value that we take from either FNC or Zillow, depending on the data source that we use for the particular property. We also have an estimate of what it would cost to build that house as a new house that we obtained from Marshall and Swift, which is part of the CoreLogic universe. In addition, we have zip code level data that we use to create time series for the houses that are in each of the zips, house price indices from FNC and Zillow, and construction cost indices from Marshall Swift. So the heart of the method really is estimating the land value for each of these houses. And this, I have to say, is very far from straightforward. This is now the third year that we've been working on this project. We've dug a number of dry holes before we got to where we are. And I think where we are now is the best methodology that can be used to obtain land values, despite the fact that it's still far from perfect. This is a very difficult exercise in the absence of explicit available data on land values for houses, which generally are not available because there aren't very many land-only transactions. So what do? We create what we call a market-based stake in the ground for every house. And that stake in the ground is an estimate at a particular point in time of the total value of that property broken into the land component and the structure component. And so how do we do that? Well, we estimate the land component from the sales prices of new homes in that house's zip, then subtract off the estimated reconstruction cost of that house as new. So we have the sale price of the house minus the reconstruction cost for the structure. The difference is an estimate of land, whereby what we mean by land is a shorthand for all the amenities that are built into the valuation that reflect the value of being at that location. This stake in the ground is, for the most part, near the very beginning of our sample period, and then we roll everything forward. So for most of the zips, the stake in the ground's in 2000, 2001. For some zips, there aren't very many housing transactions, there are not very many new home sales, places that are already well developed in center city areas. And there we have to move the stake in the ground a little forward to bring in more transactions. So once we have the stake in the ground, we then move forward and backward all three of the values for that property: the total house value, the land value, and the structure value, using the house price index for the zip that I mentioned and the construction cost index for the zip. And then we aggregate the results for each of the houses in a given zip across those houses, and we get zip level averages. That's the broad overview of the methodology. There are a lot of details. We have a paper on this, but at this point I think it'd be most productive to go to some pictures. So this is where, if you have the handout in front of you and you're not close to a screen, it would be useful to look at the handout. So this is the four-county LA metro area that we're talking about: LA County, Orange County, San Bernardino, and Riverside. What's not clear from this little picture is how big the land area is here. From west to east across this picture is about 200 miles. So this is a huge land area. San Bernardino County alone has a land area that's greater than 9 states. So the fact that San Bernardino and Riverside take up so much of the picture means that we're going to have some zoom-in slides after this to look more carefully at LA County and Orange County, which look very small on this scale. Before we do that, just looking at the whole LA metro area, this is a picture of house prices by each of the zip groups, where the light color is the lowest zip level average for house prices and the dark is the highest. That's going to be the color scheme we use throughout the maps. You can see that the house prices are generally low in Riverside and San Bernardino. The only exception is that central area in Riverside, which is essentially the desert resort areas, Palm Springs and the like. The house prices are generally high in Orange County, and LA County is a mix. So if you turn the page, this is the zoom-in slide of the same information, just looking at LA County and Orange County alone. And you can see in LA County, there's a high price band of houses that runs from Malibu in the west, this is basically in the center of the picture, to Pasadena in the east, and then runs down the coast. So it's kind of a T with a slightly angled bottom part. Then there are two general areas that have relatively low prices. The first is South Central LA, which is the kind of circular area with the light shading. This is a heavily minority area, large black population. This is where some of the riots have been in LA. And then the northern part of the county, which is actually much more like the Central Valley and is kind of disconnected from the central area of Los Angeles. The next slide shows our estimates of land value per square foot using that value standardized to a quarter-acre lot everywhere. The reason we standardize on a quarter-acre lot is that the land values per square foot depend a lot on how big the lot is. So very large lots tend to have low land prices per square foot, even if they're in very favorable locations, because most of the land is not devoted to the house itself. It's kind of peripheral area around the house that can't be used to build a second house and is of some value. You know, you can walk your dog on the land and you can avoid having to see in your neighbor's house, but it's not as valuable as having another house. So we standardize all the calculations for the land value on a quarter acre. And what you can see is that the pattern of land values is very, very close to mirroring what you saw for house prices. Not a surprise. Land is a large component of house prices, and it's a major part of the reason that house prices vary across areas. The next picture is the zoom-in version of the land price per square foot, again focusing on LA County and Orange County. In Orange County, the land prices per square foot are almost universally high. In LA County, there is more variation, and the land prices range from roughly 0 per square foot in the areas that are the most lightly shaded to about $1 million per square foot. I'm sorry, not per square foot, per quarter acre. Per quarter acre. That would be amazing. In the places that are most expensive. These values are for the year 2000. We did a similar map for 2013, which is the final year in our sample, and those super high-priced areas that were $1 million a quarter acre in 2000 were about $2.5 million per quarter acre in 2013. So there's been a lot of price appreciation. So now we're going to turn to what happened over the cycle at the zip code level. This picture shows the house price increases, again broken into quintiles. And you can see that there was a lot of variation. The largest house price increases, again shown with the darkest shading, were in the parts of Riverside, San Bernardino that are closest to the core LA metro area. They were also large in South Central LA and in northern LA County. And conversely, the increases were somewhat smaller in Orange County and parts of LA County. So here's the zoom in again, so you can see the variation. Now, I should say when I say smaller, we're talking about a big boom everywhere. It's just how big the boom was. The lightest shaded quintile had house price increases at a minimum at a zip level that were 80%. The dark shaded regions had house price increases at a minimum that were 224%. So all the numbers are big. It's just a question of how big. And you can see that in LA County, there was a lot of variation with, as I mentioned, the largest increases in South Central LA and the northern fringe. Now let's look at the downside in the market. So I just call this the bloodbath slide because it looks almost entirely red. That's because the zips in Riverside, San Bernardino occupy so much land area. But in those areas, the ones that are shaded the darkest, which is essentially all of Riverside and San Bernardino, the price declines, house price declines from 2006 to 2012 ranged from 54% to 70%. It was just a massive loss of value. In LA and Orange County, there are pockets where there was much, much less loss of value. And again, going to the zoom in slide on the next page. The places where house prices just crashed were this northern fringe area, which is really more agricultural, more tied to the Central Valley. Land was initially cheap in south central LA. The band of affluence that runs from Malibu across to Pasadena, it was like a pinprick. I mean, I'm being a little bit facetious, but the declines were much, much smaller. And actually, in some of the zip codes in Santa Monica, prices actually rose over this period. So there was tremendous diversity across this metro area. As a point of comparison, this is a picture of that same price decline chart for the DC metro area, where Washington, D.C. is, of course, in the center, and then the surrounding Maryland and Virginia counties are around it. The county on the right-hand edge is Prince George's County. For the D.C. area, it's a relatively low-income county, although by national standards, it's not low-income. And it's a very large majority black county. So what you can see is that the bloodbath in the D.C. area was heavily concentrated in Prince George's County. It's a bit like the Riverside San Bernardino of the Washington area. The other thing that's noticeable is that the other large house price declines tended to be in the distant areas from the center of the city. So the exurbs either in Maryland or in Virginia also got hit very hard. That's a pattern that we can see as well in the LA metro area. So now I'm going to aggregate all these hundreds of zip groups into 5 different quintiles to illustrate the broader patterns that are in those maps. So what I've done is to aggregate the 390 so zip groups in the LA metro area into 5 quintiles based on the initial land price for that zip, because there's a very strong correlation between the level of land prices and the level of the land share at the start of this analysis and what happened after that. So that's what this picture does. Each line shows what happened to land prices in each one of those 5 land price quintiles. The black line shows the highest land price quintile. This is places like Santa Monica. And the red line at the bottom, the solid red line, shows the lowest land price quintiles. This is like some of the poorer areas of Riverside and San Bernardino. And you can see that there is a complete monotonic mapping, where the places where land prices were high to begin with, the affluent areas, they had a pretty big run-up, but then a pretty mild decline. The places where land started cheap, they had an enormous run-up and then just a complete collapse of value. The next slide shows what the numbers are, what the percentages are behind the lines that I just showed you. So the red bars are the increases in land prices that just quantify what you saw on the prior picture. The blue is the increase in house price, and the green is the increase in construction costs. So you can see how land price increases dwarfed the house price increases, particularly in the places where land started cheap. I mean, the numbers are, well over 1,000% in the lowest quintile. I don't put any real stock in the 1,800%. On a different methodology, maybe it would be 800% or 1,200, but the numbers are huge. And house prices increased a lot, roughly 200%, and there was a lot less variation across the quintiles than for land prices. Thanks. When you go now to the downside in the next slide, you see basically the same pattern holding in reverse. The biggest declines were in the quintile where land prices started cheap, and much less decline in the places where land started expensive. Another dimension of the same phenomenon is what happened to land shares, and this is really what I think is the canary in the coal mine in terms of having predictive information that we can use not only to look back at history, but also on a going forward basis to track where markets may be getting overvalued. So this shows what happened to the land share of property value in each of the 5 quintiles. For the top quintile, which is the places where land was expensive, the land shares started at about 60%. They moved up, they moved down some, and they're now between 65 and 70%. The movements were fairly mild. In contrast, the red line shows the places where land was the cheapest. The share started at about 10%, rose to 60%, dropped down basically to 0, and then has recovered some. So the thing to keep in mind is, in trying to evaluate what this tells us about house prices, is why would a place where land was only worth 10% of the house value at one point, why would that land ever be worth 60% of the house value in any kind of rational equilibrium, sustainable, in a sustainable way? And the answer is, in this case, it wasn't rational and wasn't sustainable. But one needs to look for fundamentals to see whether there's a reason for it. But generally speaking, going from 10% to 60% is not a sustainable move. This scatter plot shows all of the LA area zip groups individually, plotted showing how much the land share rose in each of those zips from 2000 to 2006 in percentage points, and on the vertical axis, how much house prices fell subsequently in those zips. And there's a strong downward relationship with a pretty high R-squared just on this one factor alone that shows the places where the land share rose a lot, the ones on the right-hand edge, had the largest house price decline. So there is predictive value here. And I haven't shown regression results, but that predictive value remains even when you include what happened to house prices on the upside as one of the explanatory variables in the regression. So now let me bring this back to our 10 metros in my remaining 10 minutes or so. What we've done is to classify in this table the 10 metros depending on the type of boom-bust cycle that they had. And we're classifying the boom-bust cycle based on what happened to the land share in those metros in the lowest land price quintile, the one that I said was the canary in the coal mine. On that basis, 4 of the metro areas could be classified as having a strong boom and then a bust. LA, Miami, Phoenix, and Washington, D.C., all of them had very large increases in the share of the land share of value in that lowest price quintile between 2000 and 2006. They had very large house price increases and then house price busts. The next group in blue is the group of cities that had a boom-bust cycle, but it wasn't as large. We call them the moderate boom-bust group, which is Boston, Chicago, and Seattle. Land shares rose a lot, but not as much as in the first group. House prices rose a lot, but again, not as much in the first group, and the same is true for how far house prices fell. The next group is just the stable group, Oklahoma City. This is the one truly stable metropolitan area in our sample. Nothing happened to the land share. It started at 20%. It stayed at 20%. And 20% is, historically speaking, kind of a norm for the land share value in the areas where land is relatively cheap, normally the places where farmland conversion is taking place. And that's where Oklahoma City was and where it stayed. 2 of the markets were declining markets. Detroit and Phoenix, the land share actually fell from 2000 to 2006 during the period where in the rest of the country it was a boom, and house prices on net in real terms are way now below where they were in 2000. The next slide just summarizes the predictive value across all of these 10 metros for what happened to the land share in terms of its ability to predict what happened to house prices after the boom. And the yeses mean that the land share increase, just as we saw for Los Angeles, had significant predictive value for how far house prices fell in that metro area after the boom. And those significance levels are very, very high. All of the metro areas with a boom-bust, except Chicago, have this pattern. And Chicago is different, I think, echoing what Rick had mentioned. Chicago really is has much softer fundamentals than all of these other boom-bust cities. And it really has done badly since the boom. And so in Chicago, what's happened is that prices have just been soft, and the land shares remain soft in every one of the quintiles. So there's no differentiation between the places where land was started cheap and land became expensive. So it's a contrast to the other boom-bust metros. And then at the bottom of the table, Oklahoma City, no predictive value. No surprise, there was no boom or bust. And Detroit and Memphis, it's a mixed pattern. So in terms of what I've shown you, it's all based on one methodology. So we need to do some robustness checking to make sure that it's not a reflection of just choosing to do things in a particular way. So one robustness test that we've already done is instead of choosing the stake in the ground at the beginning of the sample and rolling everything forward using the zip level indices to the present day, let's choose a stake in the ground in the middle of the sample, roll forward and back. Does it make any difference? Some of the specific numbers change, but none of the key results are any different. What we're doing now, but don't have complete results for, is actually using all of the estimated land values in our data set, not just from a stake in the ground year, but for every one of the houses that's sold as a new house, we have an estimated land value, and putting those as a data set into a hedonic regression framework to see what kind of land price profile it traces out over the 13 years of our sample. This is still work in progress. It's a little bit tricky because the set of new homes that were built in the latter part of the sample in many metropolitan areas is small, so we have to have small sample issues that we have to deal with. So this is still ongoing work. Sorry. Last two slides. So what's next? Well, at this point, I think we've pretty thoroughly documented what happened to house prices and land prices at a fine level of geography in these 10 metros. But we haven't done much work yet to explain why we saw what we do see, why the pattern showed up. So we need to bring into this analysis the fundamental factors that should be determining house values and land values, income, employment, rents, et cetera, as well as what was happening to mortgage lending, and in particular the high-risk elements of mortgage lending at a fine level of geography. That's next. We also want to extend these results forward to the current day. Currently, they end in about 2014 for most of the metros, and update them on a regular quarterly basis so they can serve as a real-time indicator of hotspots across the country. And finally, we're working on the very beginnings of a completely different and in many ways much, much easier methodology for estimating land value. And at this point, we don't know if it's going to work or not. But a number of appraisals contain estimates from the so-called cost approach that have data estimates from the appraiser on the site value and the depreciated cost of the structure. We have a data set from FNC currently with about 500,000 of these appraisal values of land, which we're going to analyze to see if they show patterns that are similar to what we see from the methodology I presented today. If they do, this is important because the work that I'm presenting today, it's extremely labor intensive. There's a ton of data cleaning that goes into it. It's not feasible to expand this much further in terms of metro areas beyond what we've already done. But if the appraisal data allow us to estimate land values without doing any of this very detailed work, that would allow us to expand to a lot more metro areas than we have right now. So let me just summarize and close then. So in summary, we estimated residential land values in 10 metro areas at a fine level geography using a huge data set. We found, as in the prior literature, that land prices are more volatile than house prices in every metro that actually had a boom and a bust. And within the metros, the land price swing was the most severe in places where land was initially cheap and the land share was low. And you know, I think at least part of the explanation that we're going to find is that those are the places where marginal buyers that had been shut out because of affordability issues from buying elsewhere were buying as the boom went on, using a lot of subprime credit, a lot of leverage, and probably were overextended so that once the cycle turned, they were in severe trouble. So the areas geographically where this happened were in the distant areas where land was cheap and you could get a lot of house for your dollar, and the lower income and heavily black and Hispanic areas regardless of where they were. Moreover, the large increase in the land share turned out to be a useful predictor of how big the house price crash was going to be. And overall, I think the results highlight the value of looking at land valuation as a factor in determining valuation for housing generally. Thanks.
Thanks, Steve. So before we open it up to questions, I'm going to use my moderator prerogative to ask what I think are two difficult questions, one for each of the panelists. So I'll start with Rick. So one of the metrics that we all like to talk about is something like a price to income ratio. Either it shows up in a measure called affordability, or in an econometric sense, it tells us maybe prices are high relative to where we think they should be, based if there's a relationship between income and rents. But typically in those models, we always use either average income or median income in a metro area. And so the question I'd like to ask, it's kind of a two-part question. First is, are we using the wrong income measure? Should we be talking about who the marginal buyers are and what their income is? And of course, that matters when you have a subprime boom and you have many more lower income people entering the market. And it matters a lot when you have large investors from overseas that may have very, very different income and wealth profiles from who the domestic buyers are. So that's part A for Rick. Remember the Rodney Dangerfield movie, Back to School, where his econ professor asked one question with 27 parts? Yeah, so this only has 2 parts. So that was part A. And part B is just about income. We talk about different levels of price to income ratio, different norms. Somehow we just take that as given, and maybe that's the wrong thing. Like, are we really comfortable with the fact that San Francisco has a much higher sustainable price to income ratio than Pittsburgh? Is that something we're willing to just say, okay, that's the way it is because that's the way that it's been? So those are your 2-part questions.
Yeah, those are really good questions. No, I totally agree that price to income is not the correct way to go about doing it. We find that a lot of our clients like to reference that data point, and so it's one of the reasons that we analyze it across MSAs, metros. What I will say is, for digging into kind of the granularity of income levels spread throughout an MSA and kind of that buyer profile, that is essentially what we do when a client asks us. I mean, this could be a land developer, this could be a home builder, and they know what they're building to price-wise, and they also want to get an idea of what percentage of people in this MSA, and then drill down to the zip code, actually have the income to qualify. And if X percent have it if I price at 500,000, and that X percent is higher than Y percent if I price at 600,000, I mean, those are the kind of exercises that we go through when it comes to more of a deep dive consulting assignment versus some of the slides that I presented are at the MSA level on a price to income ratio perspective. I think that kind of answered your part 1, right? Okay. I don't like price to income. We do it at a more granular level. Now, segueing into the second part, that's kind of the reason why we like to look at things from a payment to income perspective, because it takes obviously into consideration what's happening in terms of interest rates. And then the third part of that, the last part is why we came up with our intrinsic home value index, because I mean, we do think that housing cost to income ratios are fundamentally higher in certain markets than they are in other markets. And so to your point on San Francisco, you know, we looked at the data over several decades, and normal housing cost to income ratio is 50% plus, and we think that's only going to get higher unless tech goes away, unless people don't want to live in a nice area. And I don't foresee that happening. So I think that touches on, I mean, I'm not saying that it's good that housing cost income ratios are that nuts in those markets, but it is what it is. And we have to kind of think about it along those lines. And we actually think they're going to go higher over the long term, and we model that into our intrinsic value index.
Steve, do you want to touch on that before I ask you your difficult question?
Maybe I can draw out my touching on so that I don't get to the difficult question. But no, I agree that the simple measures are not adequate, and you do have to look at the distribution of income, particularly when you think about marginal home buyers. As you get into a boom, the marginal home buyers are generally below the median because the median person already owns a home. So you do need to be careful about how much income there really is among the marginal buyers to support the purchases.
Okay, I've been saving up this question. I'm very proud of it. So I think everyone in the room, well, I won't speak for everyone, many of the people in the room would think that the CRA and other government policies were founded with good intentions. Historically, minorities maybe had been discriminated against or underserved, and for whatever reason, the federal government said we have to stop this. But now we have research on land values. And what we've learned is that land is less risky in affluent areas, and it's substantially and significantly more risky in poor areas, Hispanic areas, black areas. What that means is that if you're thinking about sustainable lending, that sustainable loan-to-value ratios are much higher in affluent areas than they are in poor areas. Or restated, for any given loan-to-value ratio, interest rates that truly accurately price default risk should be lower in affluent areas and higher in poor areas. Does that mean that we have to undo the CRA if we want to talk about sustainable lending? Does that mean that we have to tolerate potentially differences in interest rates across groups of people for the same loan-to-value ratios? How do we square this circle?
So
That's a tough one.
that is a tough one. That's a controversial question. I think we're actually going to talk more about that in some of our later panels.
Thank you for not giving me that question.
I'll just say a few words. I agree with what you just said. I think that the housing policies that we've pursued in this country for a long time, not just in the past decade or two, but going further back, that have promoted home ownership among the populations that you're talking about through risky lending, while well-intentioned, have not worked out. I mean, we can see that from the fact that the overall home ownership rate has not risen on net from where it was in 1960. Went up a lot during the boom. Those 8 or 9 percentage points of increase during the boom were so wrong-headed that they almost tanked the global financial system, and now we're basically back to where we were 50 years ago. Plus, when you look at the data on wealth holdings by households in the quintile a little bit below the median, which is kind of the target population for these policies, wealth holdings have not gone up at all, and actually have gone down in real terms over 2 decades. So the path that we're on has been failing. I personally think, and I know Ed agrees, we work together on this a lot, that the answer is a complete reorientation of how we do mortgage lending to more financially fragile populations.
So I'll chime in. I thought this was a softball, but which it is. So I've been very privileged to work with Ed and Steve on lots of these issues, all of these issues, and my conclusion from all of this is that well-intentioned changes to federal policy and changes to incentives provided to lenders have caused the destabilization and the volatility of land prices for the poor. So I think you could argue it's federal policy that has made this land more risky, and that if we just had sensible federal policy and sensible and permanent policies that didn't change depending on which administration was in, that maybe this land would look less risky and we could lend against it. So that would be my takeaway from this, and I realize I'm not a panelist. I probably wasn't allowed to conjecture an opinion. But okay, I broke the rules. I'm sorry for that. But we have time for questions. So we have 2 microphones. over there. And Steve started with Penny last time, so I will follow his lead. Penny, go ahead.
So I can say I don't agree with you. And here's why. Because I think, and this is my question to everybody, if you think about it this way, how far off am I? I think the policies were well-intentioned, but they were also based on the assumption that there were certain constants in the market. And so if you constantly used LTV as a proxy for collateral risk, but the components of that LTV kept changing, your policy could have been fine, but the loan amounts that were being lent were not based on a rational proxy. So I don't necessarily think it means that you need different pricing or that land is any riskier. I think the fact that we were using, as a lending industry, LTV as a sole proxy, and you have historical things like at least one of the GSEs saying land value doesn't matter, cost approach, forget it. Nobody was paying attention to what was happening to all that, or if they were, they weren't accounting for it, they were just using LTV. That the use of LTV is what caused the volatility in land value, not housing policy. That's my, what do you think about that?
So I was one. So when you both were talking about and policy specifically, I think what people forget is that it's not purely policy, and I think when certain policies were enacted, I don't think anybody envisioned the financial wizardry that would come over the next several decades. And so when you have collateralized debt obligations, when you have credit default swaps, when you have ninja loans and offloading stuff and securitizing it, I think that obviously is what magnifies the risk in policies that possibly could have, and I think they did have good intentions, but then when you get the capital markets involved, things can go haywire. So I think that's the other element that we need to pay very, very close attention to.
Detroit fell before capital markets got so creative.
Sorry?
Detroit fell before capital markets got so creative.
Yeah.
Why don't we talk
Wait, hold on. Let's get can we get a microphone, because we are webcasting to millions, and I want to make sure it's.
We hope.
Yeah, I just want to, by the way, I go back into the literally 60s. Why don't we talk about ownership sustainability instead of lending sustainability? Because what we're really talking about are people and not lending. Lending is almost a sideshow to me, and I've been a lender virtually all my professional career. But when you talk about this, you're talking about people who are fragile, families who are fragile, and we tend to think about the lender risk. Well, what about the risk to the owner and the family who get into these situations? And these situations started literally back in the 60s. Cities Destroyed by FHA was the name of one of the books written by the liberal side of the aisle. So that I just think our perspective by our very terminology is wrong.
I agree completely. And the whole approach should be sustainable home ownership. Put people in houses that they can afford, where they're going to make the payments, build up wealth, and stay in the house. I absolutely agree. I think Ed has a really startling statistic. I hope I get this right, that 1 in 8 of the FHA loans guaranteed since the 1970s has been foreclosed on. Is that correct? Yeah. So, I mean, that's a very damning statistic. And we're going to talk in some of the later panels about another approach to lending that we think of as promoting the sustainable home ownership that you're talking about.
No.
Ed, go ahead, please.
I just have a technical question for you, Rick. You've got this term housing cost to income ratio.
Yes.
Can you just disaggregate what are the components of housing cost very specifically? I mean, I know PITI.
Yep.
You know, did you go beyond that? And then what is your definition of income? Is it pre-tax, post-tax? You know, what disaggregate all of that a bit?
So income is pre-tax, and just like you said, it's payment, interest, tax, insurance. The way we look at it too, though, is that we don't do 100% of the median. We're not assuming median home price purchase, because for the most part, a lot of people are buying, especially on the new home side, which that's our client base for the most part, are buying sometimes below that. And so we actually assume, I believe it's 80% of the median resale purchase price in terms of kind of calculating out that payment assumption. I think that answered both of the questions that you had. I would like to, because I mean, one of the things that I think about too is that there are other things kind of blending into the payment that we're not able to kind of take into consideration. I think it's just capturing data points on that is very difficult for us to do it on a uniform basis across a lot of markets throughout the country. And so that's why we stick to a pretty straightforward assumption on a payment perspective, essentially what the housing cost is.
I think you had something like 50% in wherever.
San Francisco.
San Francisco.
Yep.
I'm just thinking that the data that we have on, which doesn't include jumbo loans, but I think those debt-to-income ratios are actually not super high relative to what the agencies are doing.
No, you're totally right.
But I don't think if we were looking at housing debt-to-income ratios, when we talk about our total debt-to-income ratios, you see putting FHA off to the side, the percentage of Fannie and Freddie above 50% on a total debt-to-income rounds to zero. It is zero. And therefore, if one were looking at San Francisco, which we can't get down to San Francisco, but since it's zero above 50, we can't possibly substantiate a median of 50. And so I'm just, of housing, and that's total debt ratio, not just housing, which we would expect to be 10 or 12 points below that. So I'm just wondering how your hypothesis relates to the reality that the actual numbers are nowhere near that, I don't think.
So when you say the actual numbers, you're talking about loans that are being
made at today, every month,
right,
which we report,
right,
and we use total debt-to-income ratio, which includes all the other debts in addition to housing.
Yep.
And so the median for Fannie and Freddie is 32, 33% total debt, which means the housing debt is something 10 points below that, 12 points below that, maybe the mid-20s, low 20s. And again, on a total debt ratio, zero of the Fannie Freddie loans are above 50,
right,
which means that their housing debt is something below 40. There aren't any above 40 probably. And so again, how do you get a San Francisco that has an average of 50 housing is kind of my question.
Yeah, and I think the other thing that we may be talking apples and oranges on is our intrinsic home value index. So that's us looking at and considering what we would think normal conditions are, factoring in mortgage rates, factoring in housing cost to income ratios. And so I believe it's that 50% stat that you're quoting is what we would consider normal levels to be, which then I think ties more to kind of how you're saying, well, wait, that's actually not crazy. So yeah, it's more in line with what normal is, and then that's how we kind of back into what we consider an intrinsic value for home prices.
So let me take oh, hands keep going up. I was going to say two more questions. Well, we'll take questions until we won't. So there was a question from a woman in the back in red. Yes. Wait for the microphone, please.
I have a question for Rick on your intrinsic home value. One of the assumptions of this normal condition is on the interest rate, which is assumed to be 6%. So I'm trying to do a little bit number crunching here to break this 6% down into interest rate components. So one which would be inflation, right? A good long-term inflation would be maybe Fed's inflation rate target, which would be around 2%. And then you have the real interest rate component, which if we assume a long-term or normal real GDP growth to be 3%, maybe economists would agree maybe 3% would be a good real rate. so which leaves 1% to be the risk premium. So that's my question. Does 1% risk premium over the cost of borrowing seem to be a good number for this normal condition?
So are you asking about our mortgage rate assumption? Are you asking if we bake in inflation, or are you saying that our assumption is wrong?
No. I just trying to.
Because either one is fine, and that's why actually we caveat with our intrinsic home value index that a lot of people think a 6% assumption for 30-year fixed rate mortgage is not right. And so if you assume that it's higher than that, well, then essentially you're saying that a lot of markets are even more overvalued than we are at a 6% normal assumption. If you're assuming a 4% long-term 30-year fixed rate mortgage, which I don't think is right because I don't see rates staying where they are for the long haul, then you can say, well, actually markets aren't overvalued because I think rates are going to be 4%. And then on the inflation thing, we're not baking in or making assumptions around inflation or anything along those lines. I think that might help with what you're asking.
Yeah, I'm really just trying to have a understanding of what's being priced into this 6%.
Yeah, I mean, I think maybe I'm just confused when you say what's priced in. I mean, that's our assumption just on what mortgage rates should be or will be over the long haul.
Right. So over the long haul, if you disaggregate this normal rate into inflation component, into real interest rate component, and then into risk premium for lenders. Mm-hmm. So I'm just trying to get understanding from these three perspectives for that 6% rate.
Yeah.
That's
Steve has
really
a few
what it
words
is.
in this too.
Could I chime in on the decomposition? So yeah, I think about things the same way you do. 6% seems like a pretty reasonable number to me. So start with the Fed's 2% inflation target. Of course, inflation has been below target for a long time, but let's assume it's going to get there. GDP growth, potential GDP growth at 3%, that'd be fantastic. But I think most estimates now are more like 2% because productivity growth is so slow. So the real rate probably, in my mind, would not be as high as the number that you quoted, which leaves more room for the risk premium to get you to about 6%.
Let's take two more questions let's start with two more questions and maybe a third. We'll go from the back forward. So I guess we'll take three more questions, but brief questions, the speed round of questions, please.
Yes, I'll make this real quick. For Rick, on your interest rate projections, are you all, in your methodology, also taking into account where the CBO is projecting increasing deficits between now and 2018, and along with that, the fact that now China and Japan look to be net sellers of our debt?
I'd like to say that we're thinking about those things. Specifically, we're thinking about the budget deficit and the long-term implications of that. To us, that's more of a kicking the can down the road thing, and so we can't bake that into our forecast right now. As soon as the needle moves on it, we will. But like I was saying in my presentation, we've found that the best predictor of mortgage rates is essentially looking at what the bond market is pricing in, what they are betting will happen, and you get that by looking at the forward yield curve on 10-year treasuries. We can see that along the horizon, layer on your mortgage spread assumption, which is typically 170 basis points. You can play around with that if you think there's going to be more risk priced into mortgage-backed securities. You can dial that spread up a little bit. But at the end of the day, that's the exercise that we go through. Our clients love it and hate it. They love it because it's been right for this year, but they hate it because as soon as the bond market moves, our assumptions change immediately. And so obviously if you're a home builder building through a 3 to 4 year horizon project and you see rates move from 4 to 5, which they haven't, but obviously that's going to cause you to lose some hair.
Okay, two more questions. Go ahead, in the olive shirt.
Drab green, thank you. That's the Marine Corps experience. First of all, just quickly, I'm working on a project perhaps to turn CRA into a profit center, both for the good of America and the for-profits. So if anybody is interested in that, I welcome them coming up to me. And my question is regarding FHA. is the glass 1/8 empty and 7/8 full?
Yeah, so that is often the alternative perspective, that yes, 1 in 8 people thought they were going to own a home and then got kicked out to the street. But I think our perspective is that we can do better and still put a lot of people into houses by making the lending more sustainable. So yes, 7/8 of the people didn't lose their houses, but we think there's a better route that means that nowhere close to 1/8 would, and still a lot of people can become homeowners.
Yeah, but 25% of the minorities probably lost their house, number one. And number two, about 50% of them probably had their credit rating screwed up, because that's just the people that got foreclosed on. It doesn't count the people who got delinquent, et cetera, et cetera, et cetera. But these are not evenly distributed, as we've just seen. They're very much concentrated in low income and minority areas.
All right, I'll take 2 more questions because the interest level keeps rising. So so you'll be second, and then go ahead with your question. Those will be the final 2 questions. Go ahead. Can you make sure to speak into the mic so we can all hear you?
Okay, my name is Li Yang. For home buildings or area development, I think their value is really depend whether it's in an urban area or rural area. Even within the metropolitan area, there's a lot of difference from one section to the other. Sometimes even a lot of difference just across the street. So I just wonder, a lot of the building or development is to have public subsidies. If you can say that, sometimes they abuse the public-private partnership. Usually it's not that concept. Sometimes they have a 100% or government fund all the project from research to the final product, and the eventual product is developers. And so they abuse all this and eminent domain. But my question is, if you want to say this land value, you subtract the total sale price minus the cost of building. So first you left out the profit. Second is do you explain whether that's a government contribution would be better off to give it to the public or homeowners directly rather than to give it to the developer, because once you give it to the developer, the whole price housing it will be going up, never be going down, so they will never achieve affordable housing. So I just wonder if you can address these type of things and then redirect our government policies. So if we want to have a government to spend a penny at all, give it to the poor or the younger buyers directly.
I'll say a few words. First, just on the technical question of what's in our land value estimate, the reconstruction cost estimate that we subtract off from the house price, that includes normal builder profit. So a normal level of profit is in there. Over the cycle, builder profits are going to vary, and that isn't taken account of in our land value estimate. So there's a certain amount of error from that source and from many other sources, but a normal level of profit is already accounted for. On the question of whether developers having land build at bids up prices, well, I think what really matters for prices are just the basics of economics, supply versus demand. And in a lot of areas, supply is very constrained. I mean, we see that now in terms of the inventory numbers that we're seeing. Home building is low. One has to go back and ask about government land use regulations that make it difficult to build as many houses as would provide more affordable housing. I think that would be a profitable avenue to explore.
Okay, one last question. A question in the back there. Get you a microphone first, please.
Yeah, this is 2 questions, one for each presenter. Rick, the map that was interesting to me showed a lot of the warm metro areas, kind of in California and Florida. There was a little in Texas and kind of the middle of the country, but they were much more concentrated in Florida and California. I wonder what extent international capital flows plays in that. If you could speak to that, if that's of interest, do you try to explicitly model that or not? And then for Steve, one of the questions I had is, in your research, do you account for variation of home ownership rates across these areas? That part of the reason why some of the wealthier neighborhoods might be more stable is because, well, the home ownership rate in those areas might be a little higher. And as you saw the changes, well, yeah, because in those lower income countries, those lower income areas, the home ownership rate is starting to rise. So I'm just wondering if that.
Mm-hmm.
So for that first part, we definitely do take into consideration foreign buyers and what type of activity we're seeing. If you look at the U.S. in aggregate, foreign buyers are actually only about 5% of total transactions. But when you drill into metro levels across the country, that percentage can ramp up drastically. And so we've already noticed a significant pullback in markets like Miami, even Orlando, and those are South American buyers, specifically coming from Brazil, given the economy is just feeling a ton of pain right now. Exchange rate versus the dollar, I think, is the worst all time recently. Other markets that we're starting to see this pullback as well on this map, you couldn't see it really, but Orange County, we just revised, or I shouldn't say revised, but we just adjusted down to a cold rating. And a lot of that is driven by what we're seeing in submarkets such as Irvine. A lot of foreign buyers in Irvine. In certain developments, you could see Asian buyers accounting for up to 80% of those transactions. Now, granted, a lot of those are people that are actually living in the States, second, third year generation. However, in some of those developments, we've seen that up to 25% of those transactions are foreign nationals coming from China. So that's the type of kind of granular qualitative color that we're constantly feeding into how we think about markets throughout the country.
So, Michael, your point about the home ownership rate and how it varies across localities, I think is a really good point. At this juncture, what we've done really is just descriptive. We've just tracked what the prices have been doing. We haven't done the analysis of what's been driving them, even though we have hypotheses that we think will show that leverage and the increased use of leverage in some of these lower income areas was a big issue. But that's still to come, and I think you have a good suggestion.
Great. Thank you to everyone and to Rick and to Steve for an excellent panel. Thank you very much.
Good job.
So we're going to break for lunch, and lunch is out here in the foyer where you registered, and then if you bring your lunch back in here. And why don't we say, Ed, if we started at 1 o'clock for your keynote, is that good? Is that a good time? So this will give you time to have lunch, and then I'll introduce Ed, and we'll have the keynote, and then that'll go for half hour, 40 minutes, and then we'll break for a couple minutes, and then start the next panel after that.
We can arrange.
But what I'd like to do is use that as a building block and say, where does this go? Where it goes is to think about markets and what are we trying to accomplish with regard to markets. And in particular, what I'm going to focus on is what I will call a market for mortgage credit risk. Right? So that'll be the theme here. What does it take to have a market for mortgage credit risk? And some of these presentations, some of these metrics that we have been listening to and learning about this morning can certainly be part of this. Final thing before I get started is I certainly welcome feedback on these remarks, whether it happens here in Q&A afterwards, or you can contact me at the Milken Institute, because to Joan's opening remarks at the start of the morning, I mean, ultimately, we want to take these thoughts and get to action that really helps to advance the housing market for the citizens of this country. So I look forward to your feedback. For those that are interested further, these remarks will be posted on the Milken Institute website later today. So let's get started. The last decade's financial crisis saw the evaporation of the private label market for mortgage-backed securities and the collapse of Fannie Mae and Freddie Mac. The resulting surge of taxpayer-backed financing of mortgages helped stem the crisis, but has left taxpayers the dominant holders of mortgage credit risk in a $10 trillion market. The good news is that lawmakers and the administration appear to be virtually unanimous in wanting to restore a prominent role for private capital in this market. More good news is that critical steps towards that end have been and are being taken. The bad news is that we are stuck with a host of policy disagreements about just how far the government should go down this path to get there. Besides this critical issue of housing finance, there are policy debates surrounding housing subsidies and whether government should tip the scale on homeownership opportunities. Today, what I'd like to do is contribute to the discussion of housing risk, my perspective on the progress being made to equip market participants with greater capacity to assess and prudently manage housing risk and the opportunities that are available to further that process. In the spirit of this conference's focus on collateral risk, I will focus on the appraisal as a particular example of how we need to rethink housing risk from the investor's point of view. Now, I take as given this audience's familiarity with the secondary mortgage market, but let me emphasize just a few points for context. In broadly rounded numbers, the average mortgage in the United States is $200,000. And the total mortgage debt outstanding for single-family homes is $10 trillion. The purpose and really the beauty of the secondary mortgage market is that it aggregates millions of $200,000 mortgages into securities of a size and predictability that institutional investors and money managers provide the bulk of this $10 trillion in financing. These investors have not, and as a practical matter cannot, review and approve the creditworthiness of the individual borrowers or the value of the homes. Instead, they rely upon the representations and warranties of the lenders and the security issuers that the loans have been underwritten to a prescribed set of standards, that the house has been properly appraised, and that the appraisal supports the valuation. In the mortgage-backed securities issued by Ginnie Mae, investors further rely upon the fact that the individual loans are all credit insured by a federal program such as FHA or VA, and on Ginnie Mae's guarantee of timely payment of principal and interest. This Ginnie guarantee carries the full faith and credit of the United States. In the mortgage-backed securities issued by Fannie Mae and Freddie Mac, investors further relied upon the corporate guarantees of those two companies to make timely payments of principal and interest. It was widely believed that investors also relied upon a so-called implied guarantee from the government that it would backstop Fannie and Freddie if needed. And that's exactly what happened in 2008 when the companies were placed in conservatorships. Since then, Fannie and Freddie mortgage-backed securities trade among investors confident in the ongoing support provided by the Treasury Department's stock purchase agreement with each firm. In the private label mortgage-backed securities market, investors lacked these government supports, so the securities typically were carved into numerous tranches to sort the mortgage pools into different credit risk classes. All this meant Fannie and Freddie, with roughly $5 trillion in security guarantees and mortgage investments, concentrated the credit risk from half the outstanding mortgage debt in the U.S. on their two balance sheets. Taxpayers implicitly and now explicitly backstop those guarantees. The government support in Ginnie has always been fully supported by taxpayers, and since the financial crisis, the private label market has shrunk to almost nothing and continues to struggle to regain a meaningful presence. It's in this environment that we find ourselves today. The effect is that underwriting, pricing, and managing of mortgage credit risk, once thought to be largely a private market function, is now largely dominated by the government. Yet since the early days of the crisis, we appear to have had broad political consensus that far too much housing risk is shouldered by taxpayers and that we want to shift much of it back to private market participants. Since the crisis, how far have we come in making this $10 trillion credit market more attractive to investors? What more is needed? Answering that question begins with envisioning a secondary mortgage market in a post-Fannie Mae and Freddie Mac world. It's not as hard as you think, and the work to get there is already underway. Fannie and Freddie issue mortgage-backed securities in which the borrower's down payment and any private mortgage insurance. Beyond that, Fannie and Freddie retained 100% of the mortgage credit risk. Pre-crisis, competition between these two firms led them to compete vigorously for market share, particularly from large lenders. As we learned, these lenders sold Fannie and Freddie a lot of poor quality production, which Fannie and Freddie failed to notice and respond to until it was too late. Back-end quality reviews at the time of delinquency meant years of poor production had accumulated on their books. We also learned that Fannie and Freddie allowed their underwriting standards to weaken, allowing riskier mortgages on their books than traditionally was the case. There are a lot of reasons behind this, but the bottom line is that management judgment allowed these weaker standards to take hold. In addition, the firms substantially underpriced credit risk and relied heavily on cross-subsidization, whereby stronger credit borrowers paid for the risk of weaker borrowers. From the investor's perspective, this world actually worked pretty good, till it didn't. In particular, capital markets created a to-be-announced market, or TBA market, that produced remarkable liquidity in these securities and allowed lenders to hedge their interest rate risk and borrowers to lock in their mortgage rate. But the TBA market appears to have relied upon participants' belief in the implied guarantee, and now a direct guarantee. Investors in Ginnie, Fannie, and Freddie securitized mortgages paid no attention to credit risk, as if it either didn't exist or Treasury would cover it if something went wrong. Investors' focus was on interest rate risk and the associated prepayment risk. In the private label market, the complicated tranching of mortgage pools contributed to a general belief that investors picked their risk-reward comfort point and that the senior tranche holders were essentially protected from any credit risk. Yet these non-standardized loans and security structures, with their opaque terms and unreliable documentation, collapsed in the crisis. So, if we want the country to have a liquid and robust secondary mortgage market, and if we want to shift mortgage credit risk away from taxpayer-supported entities to private capital markets, these are the problems we need to fix. In particular, we need a system that enables investors to develop a market in which all mortgage credit risk, or all but catastrophic mortgage credit risk, is routinely analyzed, priced, and traded by market participants. And we need a system that allows these investors to trade with the information needed to efficiently manage and price risk, and trade with the legal standards that gives them confidence in how their interests will be protected. Setting aside questions of housing subsidies, that's it. Rather than concentrate half of all mortgage credit risk on the balance sheets of Fannie Mae and Freddie Mac, the old model, we are seeking to create a normal market for expected and unexpected credit risk. This should result in the market pricing and management of this risk, just like we have for interest rate risk. Beyond that, we want to actually preserve a lot of what we have, including the benefits of the TBA market, accessibility to the secondary mortgage market for all mortgage originators, regardless of their charter or their size, liquidity in the mortgage market throughout the business cycle, and lending to credit-worthy borrowers of all income and wealth strata and across all geographies and local neighborhoods. So the question is, what does it take to create a market for mortgage credit risk? What do investors need to develop a liquid, robust market for mortgage credit risk that satisfies the conditions I just outlined? So I'll describe 6 elements that need to be addressed, that I think need to be addressed, in order to produce an orderly, efficient market in mortgage-backed securities, including for mortgage credit risk. You need to have data standards, disclosures, security uniformity, reliable reps and warrants, standardization around your credit risk transfer structures, and enforceability of contracts and investor protections. So I want to take each of these in turn. Data standards. In order to assess risk, credit markets need reliable data. Because Fannie and Freddie monopolize the holding of mortgage credit risk, they also monopolize the defining and warehousing of mortgage data. In May 2010, FHFA began to address this issue, announcing the start of the Uniform Mortgage Data Program, or UMDP. This is actually an umbrella for separate projects covering data submissions for loan originations, appraisals, and loan servicing. Now, the purpose of UMDP is to standardize mortgage-related data definitions in the entire mortgage market and standardize the technology used for electronic submission of these data. And this was done using the industry's standard-setting body, MISMO, or Mortgage Industry Standards Maintenance Organization. You know, FHFA said at the time it would take years to develop this, so let's get it started. 5 years later, in fact, much has been accomplished. For loan originations, the Uniform Loan Delivery Data Set, or what some of you know as ULDD, and the Uniform Closing Data Set, UCD, are up and running. They're also helping to form a broader set of industry standards. Let me give you a couple of examples. The Consumer Financial Protection Bureau recently announced changes to its to HMDA reporting. And in doing so, they attempted to align some of those reporting requirements with ULDD. Similarly, the Uniform Closing Data Set has just been modified so that it aligns with the CFPB's TILA-RESPA Integrated Disclosure, or TRID. These data sets create a uniform standard for defining and reporting mortgage loan and mortgage closing data. For appraisals, the Uniform Appraisal Data Set is up and running. It sets common definitions for appraisal data, and the Uniform Collateral Data Portal is also operating, and this serves as the technology system for the electronic submission of appraisals. Now, I'm going to return to appraisals shortly, but keep in mind the data developments in this space. Work has begun on mortgage servicing data, but progress on that front appears to have stalled. And this is unfortunate because ultimately we're going to need to have standardized language for collecting and reporting mortgage servicing information and what's going on when a mortgage becomes delinquent. Second element is disclosures, and I want to break this into 2 pieces. Start with loan level disclosures. As most of you know, pre-conservatorship, investors in Fannie Mae mortgage-backed securities received no loan level data, and investors in Freddie MBS received little. After all, the credit risk remained with Fannie and Freddie, so investors were not clamoring for it. For a post-conservatorship market in mortgage credit risk to function effectively, this MBS disclosure regime needs to change. Some work's already done. Over the past few years, at FHFA's direction, Fannie and Freddie have released a considerable volume of historical loan-level data on mortgage characteristics and performance. But a new disclosure regime should be able to rely on the standardized data and electronic reporting being created by the Uniform Mortgage Data Program. FHFA announced this as a goal several years ago, and hopefully we will begin to see the fruits of this effort as the agency's work on a common security and common securitization platform proceed. The progress made by FHFA in driving developments in the Fannie-Freddie market segment has the added potential of establishing standards, these are disclosure standards, that may be adapted by other segments of the mortgage market. This disclosure regime should provide investors with data on the borrower's credit characteristics, the terms of the mortgage, appraisal information describing the loan collateral, and monthly updates on payment performance, among other things. With standardized data terms and an appropriate disclosure regime, we will have democratized the assessment of mortgage credit risk. No longer will the critical loan-level data be isolated within Fannie and Freddie or available for inspection only to rating agencies. In the sort of disclosure regime I'm describing, anyone with a computer and a mortgage default model can make their own assessment of mortgage credit risk. While we may still experience a future price bubble, a market that has robust real-time disclosures and risk spread among investors should be able to temper the consequences of that kind of outcome. I want to say something about appraisals. In the spirit of this conference's focus on housing and collateral risk, let me expand a bit on appraisals. Our goal is to create a private market in mortgage credit risk. The borrower's ability to repay and hence the borrower's credit parameters, as I've said, should be part of the loan level disclosures to investors. They're critical indicators of default risk. But the collateral backing the mortgage loan and the risk parameters associated with that collateral should also be part of the disclosures to investors. Among the conditions that I believe are necessary for private investors to price and manage mortgage credit risk is confidence in the value of the collateral supporting the mortgage. Yet mortgage investors today lack this information. An appraisal report should provide the lender with an unbiased professional opinion of value to support the credit decision. Any assessment of mortgage credit risk depends upon an accurate assessment of collateral value and collateral risk, even though the collateral is not the primary basis for the credit decision. So here's the key question. In a world in which private markets have a meaningful first loss position, what can the appraisal report tell credit investors that enhances their knowledge and understanding of collateral value and its associated risks? Taking it a step further, how could that information enhance this private market's stability and soundness? Now, I suggest that a future disclosure regime for MBS could include appraisal data to assist in evaluating collateral risk. When the banks and thrifts used to originate mortgages and hold those mortgages on their portfolio, they had the appraisal. When Fannie and Freddie bought $5 trillion worth of mortgages to issue MBS and then they retained the credit risk, they had the appraisal. So now in a world in which we're asking investors to hold this risk, shouldn't they have access to this information? So in short, I believe that providing investors meaningful collateral data could strengthen the marketplace. This effort can build upon the appraisal data standardization and collection system that I described a few minutes ago. But it will also require rethinking the appraisal report itself, including what information is collected and for whom it's being collected. Suffice to say, I've offered some thoughts on this elsewhere. So suffice to say, I think the appraisal report itself needs to change, and we need to give serious consideration to how we modernize it to better reflect collateral risk. This could include replacing or supplementing the point estimate of value with a range and adding one or more measures of collateral risk or volatility. Unfortunately, this topic is going to be covered in depth more later in this conference. Let me turn to the third element for creating a market of mortgage credit risk, and that's security uniformity. FHFA is working on an updated mortgage-backed security structure that would initially be the same for Fannie Mae and Freddie Mac, and ultimately could be the framework for a common security issued by other securitizers. It's also directing work on a common securitization platform that will ultimately replace the proprietary and outdated securitization infrastructures of Fannie and Freddie. These efforts should be the foundation for a common security, mortgage-backed security, in a post-Fannie-Freddie world. The common securitization platform creates a single platform for manufacturing eligible MBS, which should add transparency, consistency, and liquidity to the MBS market. And while not required, this platform could also be a backbone for issuing private label mortgage-backed securities. The fourth element, reps and warrants. When a mortgage originator sells a mortgage to Fannie, Freddie, or some other securitizer, it represents and warrants that the loan has been originated in conformance with the security's underwriting standards. This allows for a more rapid securitization process, relieving the security issuer from undertaking a loan-by-loan re-underwriting of every mortgage. Unfortunately, Fannie and Freddie did not have a robust system of sampling deliveries to test for compliance. Rather, they typically waited until a loan went delinquent before such checking took place. This allowed a lot of loans to accumulate on their books just before the housing collapse that had not been inspected. As a result, the rep and warrant review process and the resulting putbacks were costly and time-consuming. So in 2012, FHFA announced it was directing Fannie and Freddie to overhaul their approach to reps and warrants. The first step was to move to an upfront quality control review rather than waiting until delinquency. And FHFA also called for waiving many of these reps after 3 years of timely payment. This new program continues to be worked on and continues to develop. Just earlier this month, Fannie and Freddie announced that at FHFA's direction, they were making additional enhancements to this new rep and warrant regime. With these changes, the companies are giving more certainty for identifying, classifying, and remediating origination defects. They are also setting a standard that can be adapted more broadly in the market. The fifth element, credit risk transfer. Credit risk transfers, or known by some as CRTs, is the shifting of mortgage credit risk away from Fannie and Freddie, and hence taxpayers, to private investors. And this is the transition process for building a market for mortgage credit risk. What began in 2013 as a series of experimental transactions has continued to grow. Eventually, it must lead to repeatable, regular transactions, which will lead to greater liquidity and trading in CRTs. All the elements I've been describing, data, disclosures, and so on, are inputs into this developing system. In the end, we should have a market for credit risk via CRTs and a market for interest rate risk, that is the funding market, each of which is deep and liquid and is tailored for their respective investors. The sixth and final element for establishing a market in mortgage credit risk may be the most important. After the complete meltdown of the private label market and years of enforcement actions, investors rightfully wonder if contractual rights will be protected in some future downturn. After all, investors will only invest in mortgage-related assets and take responsibility for managing mortgage credit risk if the terms are clear and enforceable. Without certainty of contractual rights and responsibilities, no market can exist. Many investors believe that their rights have been trampled in the enforcement actions taken since the crisis. Such investors will not return to this market until they're convinced that appropriate investor protections are in place. To that end, the work being done by the U.S. Treasury and the Structured Finance Industry Group is critical here. Together with FHFA's work on a common security, these combined efforts should produce security structures and contractual requirements that spell out the protections available to investors. This would include how contracts and reps and warrants will be enforced. Now, positive developments have already taken place, including the work on national mortgage servicing standards. A lot of thought has gone into the establishment of an investor advocate or deal agent or credit risk manager or whatever name you want to give that role. The basic point is to establish an agent who acts on investors' behalf to ensure mortgages are originated and serviced as represented in deal documents. Such a role would have some of the features that Fannie and Freddie have in what they call the master servicing of their guarantee book. Another component of investor protection is to have a reliable dispute resolution process, and this is also being examined by Treasury and SFIG. So to conclude, the essential step in transitioning from a Fannie-Freddie-centered secondary mortgage market to one where private capital manages the bulk of mortgage credit risk is to stand up a reliable market for mortgage credit risk. This is not a radical idea. It requires building infrastructures such as data standards and disclosures that did not previously exist because all that risk resided inside Fannie and Freddie. We must not lose sight of another key advantage to a competitive market relative to the Fannie-Freddie model. As we recently experienced, concentrating all that mortgage credit risk on two balance sheets is a recipe for systemic risk. In my view, no amount of regulation can effectively control that risk, especially given the degree to which political considerations play into housing. A competitive, transparent market would diversify the risk across countless investors and other market participants. It could also be developed in a way that results in far more skin in the game by loan originators than existed in the prior model. Now, while I focused my remarks on market structure, there will also be impediments to the market that require government action, and two quick examples are the need to reconsider certain bank capital rules appropriate for this new secondary market, and to consider various legal impediments to certain market participants, such as those that may inhibit real estate investment trusts from engaging in a certain part of this market. In sum, while Congress defers action on housing finance reform, the collective efforts of FHFA, Fannie, Freddie, and many others are in fact producing the 6 ingredients essential for a market and mortgage credit risk to develop. In the end, continued progress on these 6 elements will make the job for Congress that much easier and the final transition away from the conservatorships that much smoother. Ed, thanks for having me, and I think we got time. I'd be happy to take a few questions. Okay, yep, Steve.
I thought your comments were great and really laid out a very sensible program for a transition back to a private market. My question is, how much of this can be done without any involvement by the Congress?
Well, my basic point is that of these 6 things, all 6 of them are being developed without the Congress. But the Congress is necessary to draw the conservatorships to an end and to declare with some finality what the institutional and legal framework is going to be. But the fact that the critical elements for markets are being developed means that Congress, when it actually enacts housing finance reform, should not feel like it's taking a great leap into the dark. And that will be the case if, in fact, we have standardized data. If through the development, evolution of the common security and work of SFIG, we start to develop a regularized process and the systems to provide these disclosures. If we've got the rep and warrant regime in place, if we have worked through, without Congress, this isn't the kind of detail Congress gets into, if we've worked through what are the necessary ingredients to have reliable investor protections in place, then Congress can come in and say, okay, so these are the legal things that are needed. These are this is the transition path. This is how we will manage, the wind down of the conservatorships and the move to this world. But it becomes that much easier if we've in fact made all this progress on these market elements. And through things like credit risk transfers, we've already been demonstrating, the market demand for this and getting some sense of both the market appetite, the alternative structures that are out there, and the pricing of it. Yeah, thanks.
Yeah, my name is Li Yang. I think practically this involves a lot of data and security. But currently, a financial institution or major industry complex or government agencies, they don't maintain correct record, and there are a lot of false statements or false documents. So how are you going to ensure they do the right thing and the inspector do the right thing?
Yeah, so thank you. That's a good point. I mean, for this to work, you've got to have reliable data. And I think that what we are striving for is to make that data more reliable by creating a set of data standards for the mortgage market. I mean, let's just take something simple. Let me just focus on Fannie and Freddie. If you're a loan originator and and this is pre-conservatorship, right? So you're a loan originator and you're making loans, and some of them you're going to sell to Fannie and some of them you're going to sell to Freddie, right? To your point about data, you've got this loan. All right, this one's going to get sold to Fannie. And you're putting the file together and the electronic submission to send this thing off to Fannie. There's one set of data definitions and all these proprietary codes about the borrower, the property, and so forth that you had to fill out. The next loan is going to Freddie. It's a whole different system. Different data definitions, different proprietary codes, and so forth, right? Just that alone makes no sense. Right? And that contributed to what you're observing is that the data was not as reliable as it could be. What I'm saying is, why should those sort of things differ depending upon who the ultimate financer of the mortgage is going to be? Right? We ought to be able to have a single common set of standards. Look, we have for electricity, right? An underwriting lab says these are the standards. Why don't we have that in the mortgage market? Well, in fact, we're developing it now. It needs to continue to develop so that the data will be more reliable. Then you need to use technology and use industry standards for the electronic gathering and transmission of this data. And again, so you don't have a bunch of different proprietary systems you're feeding into. Make them an industry system. Do it with an open architecture so multiple vendors can build systems for you around that single industry technology, and so that when as technology or financial technology or IT technology changes, you can make those adjustments across the whole industry. I think if we take those kind of steps, then we'll have much more reliable data going forward, and we'll have the benefit of ultimately having not just better information, but we'll lower the cost of collecting it. Tom? Oh, whichever.
How pleased are you with the progress that's currently being made on the development of the single security and the common securitization platform? And do you sense that we've got two GSEs pulling in different directions on that development?
Yeah. Well, so let's start with the obvious. So I've been gone from FHFA for a year and a half now, so I have no, particular insight into, the internal developments of these things or what the current positioning of these two companies are with regard to these developments. I will say, FHFA just over the last several months has issued updated status reports on the development of each of these things. Currently, they seem to be prioritizing getting to a common security, is something that they want to get done. They've announced an initial set of timelines or expectations with regard to the common securitization platform. With regard to Fannie and Freddie, look, they've got their own internal challenges and opportunities and view of the future and so forth that come into play. But FHFA is the conservator, and FHFA should be directing where these things go, what the priorities are, and making sure that they get done if this is in fact what's going to be essential for us to have an operating market in a post-conservatorship world.
Test? Okay, yeah, thank you. So I'm actually have a question about the other side of the market, which is the financing side. Currently, a lot of MBS is financed by repo. And a claim by at least one famous economist is that the financial crisis was caused by a run on repo after Lehman's collapse. So in your opinion, do we have enough, has the repo market been changed enough or evolved sufficiently or been regulated enough that it'll be a stable source of funds for all of this credit risk?
Well, I mean, I'm not exactly sure how to go about answering that. I'm not a particular student of what's been going on with regard to regulating the repo market. But look, I mean, that private label market was very opaque with regard to sort of knowing what was truly baked in there. There was a lot of misrepresentation in the securities that were issued. That's obviously led to a lot of subsequent litigation. So I wouldn't sort of think about it just strictly in terms of repo financing, but more in terms of how well did this market work? What was the governance over the market, that would mitigate the kind of credit risk buildup that we had before, where you had misrepresentation of loans and a lack of investors really having the kind of insight into the actual risk of these mortgages that they had back then. I mean, you just think about the different presentations made here. If we had disclosures that had this data much more available and reliable, and had all kind of bright people like we're up here producing this stuff, I think the repo market would have worked differently. I mean, the market itself would have worked differently. So that's how I think about it. I mean, not in terms of the detail of where the financing coming from, but just that the information is more reliable and can be more readily assessed for risk and changes in risk. So that's kind of the level which I'm trying to think about it right now. Ted?
Yeah, Ed, given the tendency of markets, capital markets, financial markets especially, to seize up over uncertainty, and given that most of the mortgage credit risk stems from macroeconomic risk, once you've controlled for those loan level factors, all the transparency in the world isn't going to give people a better crystal ball about what's going to happen to home prices and how's that going to affect ultimate loss rates. So how do we get comfort that a capital market solution to holding mortgage credit risk is going to be any less vulnerable to a panic and a sudden seizing up and an inavailability of capital at the worst possible moment?
Yep. So, I mean, one of the things from your presentation this morning was talking about, how, as a mortgage insurance company, thinking about how much capital to apply and thinking it through in a stress environment. And so, what we should have is a market that, in fact, by having access to this data, should be able to assess that stress environment as well. But, one thing about all this is I don't think we should be running away from market signals, right? If a market says, you know, things are getting overheated, we need to pull back, we need to moderate, you know, that's actually what we look to markets for. Because if we don't have that, if we put this on the government, you know, because we don't want to have any disruption, then we're going to get what we just had. And so, look, there's a balance there, and not to, you know, I did not go into this, you know, but there, you know, part of the unresolved policy question in this is, so even if you assume that if you're willing to assume that I'm correct, that for these stable times, you know, something approaching a functioning credit market can develop, if you know, as you say, that periodically this market is going to be subject to macroeconomic disruptions that hit this credit market harder than the market for car loans, what should be the release valve or the safety net or whatever you want to describe it as that allows this thing to continue to function? And I think it's a legitimate question that policymakers need to consider. If you look at the various bills that are out there, there are, in fact, proposals about how that would be done, temporarily extending the depth of a backstop government guarantee is one, temporarily extending what it is Ginnie Mae could do is another. The idea of providing some temporary market support if the market's not willing to take credit risk for a limited period of time. But I think, to me, that's a question of sort of how do you structure this market with a safety valve, as opposed to saying that throughout the cycle we're going to have the taxpayer taking on this risk, which means that it's not really going to be getting properly assessed and priced. So I don't know if that's a satisfactory answer to your question, but that's I think that's how I think about it.
Thank you for your presentation. Two quick questions. Am I seeing reality this way? And a third quick question, hopefully. So Lou Ranieri, correct me, ostensibly the creator of the mortgage-backed security. I don't know if that's important, yes or no, but he's in private label securities, and it seems like he's getting a slow start. So maybe, is there some insight related to that? Second, as you said something about maybe REITs will be excluded from this market in the present legislation, the discussion there. The question about reality, as an example, the VA loan, which from the outside I look as the lender is guaranteed against the first 25% of loss, and then when these are securitized, they're sold for a 4 to 6% spread on a 30-day float, which seems to translate you can hedge that risk and get a 48 to 72% return, so which seems rather amazing. So the quick questions related to that is that a reality, what I'm seeing there? And is there something we can learn from the VA Ginnie market, either good and bad, and apply to Fannie and Freddie? And then isn't those type of spreads something that should, in theory, attract competition and drive down spreads for everybody's advantage?
It should over time. I mean, markets generally should work that way. Look, there's a lot to be learned from the VA Ginnie market that I think is more broadly applicable. It was briefly referenced in one of the earlier discussions today about residual income as a basis for underwriting. I think there's a lot to be taken from that should be ported over. Also, VA, unlike FHA, does leave some risk with the originating lender. So the lender has skin in the game in VA lending the way it does not in FHA lending. And as was reported here, VA loans performed a lot better than FHA loans. With regard to the private label market, there are a number of reasons why the private label market is slow to develop. I will offer just 2 or 3 contributing factors. One is that you've got a government-backed market that is still completely dominating this marketplace, right? As long as we have Fannie, Freddie, and FHA competing, for such a broad swath of this market, and they operate, with different economics than a private firm's going to do. That's an inhibiting characteristic. Another is that the interest rate and the interest rate environment, the way it is making some of this potential PLS market rather attractive for large banks to originate and hold these loans on their own portfolio. So less of a demand for wanting to offload it in securitization. And I think those two things contribute to the third, which is that the industry itself is still working on developing a more standardized PLS market for the future. All right. Thank you, everybody.
One of my colleagues, Alex Pollock, is fond of saying there's nothing new in finance. And two examples, one on the last question. Lou Ranieri, for good or ill, is called the father of mortgage-backed securities. The first U.S. mortgage-backed securities were called mortgage-backed bonds, and they were done in the teens and 1920s. They all collapsed by 1933, along with the private mortgage insurers that insured those securities. If you want more on that, you can look at the Alger Report, which was the commission that investigated that in 1933 and reported on that, along with the appraisal problems that they ran into. And speaking of appraisal problems, as what I heard sort of was the inauguration of a national system of real estate appraisal and the arranging and collection of dissemination through a government agency of statistical information to guide the mortgage market. This is the Committee on Banking and Currency, 73rd Congress, second session, May 16th, 1934. And so these ideas have been talked about for a long time. I would add one thing on this database is, and this is probably where maybe Congress needs to get involved, or certainly FHFA needs to get involved. Today, Fannie and Freddie largely control that data, with the exception of what they put out for the loan level detail that we use for our National Mortgage Risk Index, but they put out very little information from the appraisal database that they have created on a proprietary basis. They have no right to do that. It's just not right that they do that. That information should be made available to all, and both appraisers and the industry, as Ed outlined, but it certainly shouldn't be kept within the proprietary basis of Fannie and Freddie. That will just create more problems, in my opinion, down the road. So with that, we're going to move into the next panel, which is panel 3. A topic near and dear to Steve's and my heart, the wealth building home loan. So with that, I'll call up Joe and Jeff and Tom.
Good afternoon, ladies and gentlemen. My name is Tom Lamalfa. I have spent the last 38 years in mortgage finance, largely on the research side. And I was asked to moderate this panel, which will focus on the wealth builder home loan. Late last year, I was given an opportunity to watch the development of the product that Steve and Ed have designed. And the product piqued my interest, and in very little time, I was hooked on its wisdom. And to that end, I wrote an article in the February issue of Mortgage Banking Magazine about the product, and made the guesstimate that sometime in the next 5 years or so, it would account for 20 to 25% of aggregate production. I was convinced of that, again, given the way that the product was structured and my understanding of what the demographics were going forward, with a preponderance of minorities entering the housing market, and also because it was a product that seemed well designed for first-time homeowners. With that in mind, Ed has assembled a panel consisting of three people who have had a one or another role in the design of the product. Jeff Cooper from MGIC will be talking about the insurance possibilities on the product. Joe Ferris has had direct experience at his banks and has originated something in excess of $10 million worth of the product since, I think, last spring. And Ed, of course, is the conceptualizer and the designer with Steve of the product. Each of them has about 30 minutes to make a presentation, and we'll reserve maybe the last 15 or 20 minutes for Q&A from the audience. So with that, we'll start with Ed, and he can give an overview of it.
Thank you, Tom, for that introduction. First, given some of the comments that were made this morning at various points about savings and how one goes about doing that, I'm going to ask you to open up on the pamphlet that's on your table, if you can grab one, the one that says Wealth Building for the 21st Century. And if you go to page 7 and 8, you'll see two charts that look like this. And so I'll give you a few seconds to just grab that. What these charts show is what we call the life cycle of savings. And if you think of a household, and this is done for the median household in the United States in terms of income, age adjusted with some inflation factor. So as someone ages, the household head ages, their income tends to go up. I mean, those are the numbers we use based on census data, et cetera, until it peaks at around age 60 or so, and then it sort of levels off, drops off a tad, and then drops off a lot once they retire. And so there are three challenges that households face. One is saving for retirement, which used to be much more straightforward than it is today. You had your employer, in many cases, provide you with a defined benefit plan, and it was outside of your budget. It was just a fringe benefit, and therefore it didn't count, although you were paying for it in terms of foregone income. Presumably, it wasn't part of your taxable income directly. And then you had buying a house, saving for and buying a house, and then the next house and whatever over your life cycle, and then paying for your children's education. And as I mentioned earlier, the advent of the 30-year fixed rate loan, and it doesn't make a difference whether it's fixed or not, but the 30-year amortizing low down payment loan really threw all three of those things out of kilter. First of all, we've had a change from defined benefit to defined contribution. And we've talked a lot about DTI. DTI doesn't take, debt to income ratio doesn't take that into account at all. It's pre-tax. And therefore, if you're putting money away for retirement or not, it doesn't change what your debt to income is. And anybody here know a realtor who really cares about what you're saving for retirement when you buy that house? No, they don't care. They look and see, well, how much house can you buy? And it has nothing to do with your saving for retirement, no matter how much sense that makes. Secondly, if you start buying houses with 30-year terms at, say, age 30, and then you buy another house at age 37, and you refinance it, by the time you're 65, you still are in a lot of debt. And it was never really designed that that was the way this was supposed to work. But that's actually what we have today. And lastly, and this was an insight that Steve and I developed as we got into the cash flow of this, and what this showed us, and that is once you get to about age 53 or 54, it's not just having the house paid off that's important. It's having the cash flow to pay for your children's education that's important. You shouldn't have to even borrow against the equity. You should be able to just use the freed up cash flow from the shorter term loan. And so what this first chart shows is somebody who starts saving at age 24, which actually not enough people do. There is a match, which is fairly available, but could be broader. And at age 31 or so, age 30, they buy a house, which is about the median in this country for first-time home buyers. But they buy with a 30-year term, and they max out on that house relative to what they have left over, after saving some for retirement. And then they buy another house at age 37 after 7 years with another 30-year loan. One of the reasons is, boy, they haven't paid down very much, and so they really have to take out a high mortgage on that, and the 30-year loan helps them afford that high balance mortgage because they haven't gotten much equity. And then they start doing things with their children at age 51. They still have that mortgage. They're still paying the principal and interest, and so they have to borrow against their equity, and they're still adding to the 401k. And then finally at age 66, they've got $1 million and change, but about a third of it is in house, the rest of it is in 401k. But you're supposed to have 9.2 times your final income in 401k, and their final income was a little $121,000, and so they only have, I think it was 6 times. So they're short for a comfortable retirement. You can back this down to 80% of median, and you'll end up with somewhat, either lower income. You don't 9.2 times a lower income. You're going to end up at about the same spot proportionally. This is the wealth building approach. This example uses the 15-year loan. We'll be talking about 20-year loan in a minute. But this uses the 15-year loan and says, okay, you start saving for retirement at the same time, so the $27,000 is the same in both cases. But then at age 36, you don't buy the house with at age 30, you don't buy the house with the 30-year loan, you buy it with the 15-year loan. You buy a somewhat smaller house, but you use the wealth building approach, which allows you to buy a little bit more, but still not quite what you would have with the 30-year loan. But you build up a lot of equity in that next 6 or 7 years, and when you get ready to buy the next house at age 36, you're now able to put down a lot more money on that next house and actually take out a smaller loan, which allows you to continue with the 15-year loan. And now at age 51, you actually have, assuming you haven't refinanced it 4 times and extend, you now have your house paid off at age 51, and now your children are just about at the age when they're getting ready for post-high school, and you use that freed up cash flow to pay for that rather than having to borrow against the equity. Of course, they have to kick in some too, but this is the parental portion. And then once they're done with post-secondary, you take that extra cash flow and you continue to throw it in. Now you throw it into your 401k or whatever, your retirement, and you build that up. And so now you have this much larger number, about 55% larger number, which now puts you at, in your retirement portion, about 9.2 times what you last earned, and you own your house free and clear, which is not the case in the first example because you actually had to borrow against that and you took out the 30-year loan, but you had to borrow against it for the children's education. So now moving to the slides here. What is the wealth building home loan? It's a loan that we've designed to require little or no down payment with a relatively broad credit box. Has a monthly down payment nearly or as low as a 30-year fixed rate FHA loan. It can have a 15 or 20-year amortizing term. It can have a fixed rate for at least 7 years. You can have a longer fixed rate. Joe will talk about a 7-year fixed rate. You can have a 15-year. You can have a 20-year. Depending on how you mix those things up, you change the buying power a bit. But any step up, we believe, should have minimal payment shock. And one of the beauties of the wealth building home loan is when you do things with a shorter loan term, things that add a lot of risk in a 30-year loan don't add much risk in a 15 or 20-year loan. So if you had a 30-year loan that stepped up from 2% to 5% interest rate, you'd have a big payment shock at the end of 7 years. But if you do that same thing on a 15 or 20-year loan, you actually end up with a payment shock of about 13% instead of perhaps 30 or 32%. Much smaller one-time payment shock. Much lower foreclosure risk due to the faster amortization. That's been mentioned before. Common sense underwriting. We suggest residual income is a good thing to do, particularly at the higher debt ratios. And in the first 3 years, you have much of the payment on a 20-year term, 57% going of P&I going to principal, whereas on the 30-year loan, 68% goes to interest. And so Steve came up with this analogy. If you consider your income coming into your left pocket and your assets and your balance sheet being your right pocket, and you're making your P&I payment, and we're going to use $1,000. Well, if it's $1,000, $570 is going from your left pocket, in effect, to your right pocket, paying off that debt, creating an asset, and $430 is going out in interest. But if you have the 30-year loan, assuming the payment was the same, just for simplicity, you've got 68% going off in interest and only $320 coming into this other pocket. And so the little chart shows how that difference accumulates very rapidly over 5 years, which is, again, what reduces the credit risk substantially, but also allows you at the end of 5 years or 6 years or whatever to have the freedom to then, if you want to, you can continue paying off this loan, but if you'd rather move or whatever, your house needs are different, you can now have the down payment to buy the next house. I'm fond of saying that the concept behind the wealth building home loan is you use the mortgage toolbox. And what I mean by that is a lot of ideas that get developed in the mortgage space require a change in this or a change in that or a change in thinking, or it's complicated or whatever. And so everything here is sort of straight out of the standard toolbox: a 15-year loan, a 20-year loan, an interest rate buy down, a two-step. These are all things that are well known in the mortgage industry and the servicing structure and origination structure. So a 15 and 20-year loan is only considered expensive not because of the interest you pay. You're actually paying less interest. The expense is in the principal, which is going from your left pocket to your right pocket. So in many respects, it's forced savings. But we used 5 components to increase the buying power substantially over sort of a traditional 20-year loan. One is over a 30-year loan. One is that the 20-year loan has a lower interest rate than a 30-year loan just because it's shorter term. And a shorter term loan has less risk for the investor. Second, the use of residual income method, which could allow for some higher debt to income ratios in a safe manner. 3, lower annual credit risk expense, and due to a substantial reduction in the credit risk. 4, maximum LTV of 100%, which allows the repurposing of, say, a 3% down payment to fund a rate buy down, which then actually has some additional buying power advantage to it. And after 7 years, the bought down rate, as I said, steps up, and the one-time payment shock is relatively modest, and yet you again pick up buying power because you're able to get a lower interest rate with that 7-year rate rather than a 20-year rate. And if you added a modest targeted subsidy of a few points, you can increase the buying power a little bit more and get to something very close to FHA for low and moderate income borrowers. I'll come back to that in a moment. The loan comparison is on the next chart here, and it just shows a 30-year loan, a 15-year two-step, and a 20-year two-step, and how the incomes vary in buying power and how much equity you have over time and the payment shock. And so as I mentioned, this can be tailored specifically for low and moderate income borrowers using traditional underwriting. If you have a lender that qualifies for some of the exemptions under qualified mortgage, they can use traditional underwriting rather than the one-size-fits-all underwriting that QM requires. They can focus on 15 to 20-year terms and provide, with a 15-year term, rapid wealth building with somewhat lower buying power, or less rapid, but still pretty rapid wealth building with a relatively equivalent buying power. So you can trade off on the two things and balance those out. As I said, the two-step has limited payment shock even for a low and moderate income buyer. And modest subsidies may be used to increase the buying power. The market rate, again, can use traditional underwriting, focusing on the same terms and a lot of the same things. But again, it's a market rate. It doesn't require any subsidies. And Joe will talk about that as the lender that has originated the most of these as a market rate program. And the status, there are 3 market rate offerings to date, although Jeff may provide additional information on that. Androscoggin Bank, which led the way, Atlantic Coast Bank in Florida, and Weoki Credit Union in Oklahoma. Market reaction among those banks has been enthusiastic. Last year, if you were here, you heard Bruce Marks talking about NACA, Neighborhood Assistance Corporation of America, offering a CRA-eligible version through Bank of America and Citibank. Market reaction there has been enthusiastic. Over the first 20 or 25 years of NACA's history, they made 0 15-year loans. They never thought about doing a 15-year loan until we challenged them on the premise. And in a couple of months ago, their pipeline had about, I think, 20 or 25% of the pipeline was running 15-year loans, and they expect that's going to increase over time. There are about a dozen financial institutions around the country that are looking to launch this. There are 6 private mortgage insurers that offer to insure it, but MGIC, hence Jeff's presence here, has been the most active. We're in discussions with a number of federal home loan banks. We're talking to state housing finance agencies. There's been some interest from foundations. Press coverage has been widespread and very enthusiastic. If I could ask you to just go back to page 10 of this document, the Wealth Building Action Plan. I've already talked about the housing finance needs to be refocused on the twin goals of sustainable lending and wealth building. But secondly, and this gets again at one of the issues that came up, one of the questions that came up this morning in the second panel, the mortgage interest deduction could be restructured to provide a much more, a straighter, broader path to debt-free home ownership. Right now, by it being an interest deduction, it subsidizes debt. It subsidizes taking out 30-year loans. The longer the loan, the more interest you're going to pay over the life of the loan, the bigger the subsidy. That's crazy. Today's tax code, therefore, promotes this lifetime of indebtedness, and we've taken things to their logical extreme. And so we just have way too much debt. I would argue $10 trillion is just too much debt for our housing market to comfortably absorb in a stable fashion, given our history for these ups and downs. So the solution is twofold. One is reorient the deduction towards reliable wealth building and debt extinguishment, and you do that by saying, okay, you can take out a 30-year loan, but you're only going to get the interest deduction, let's say, of a 20-year loan. And initially, it doesn't make much difference, but the next year it's a little bit less, but it's more, lesser than on the 30-year loan. By the time you get to year 3, 4, and 5, for the reasons that the other chart showed, you're going to start tamping down that interest deduction. And so borrowers eventually are going to get the message and go, well, maybe I don't want to take out the 30-year loan. Maybe I should start taking out a 20-year loan because that's all I'm going to get the deduction for. And so we're going to stop subsidizing so much debt. At the same time, you can't allow people to keep re-upping. So if they buy the first home, why should we be subsidizing their second home, their third home? I mean, even a second home in addition to their primary residence, but I'm talking about the next primary residence and the next one after that, and all the refi and all the cash out. If we want to promote stable home ownership, let's focus on home ownership and stability. And then you can take some of the savings from this and use it to fund a low-income first-time home buyer or lift home tax credit, which would provide low-income, below 80% of area median home buyers, with a tax credit up to, say, 4 discount points if they don't have a 401k. And they could take that 4 discount points and have to use it for a 20-year or less loan. It doesn't have to be exactly a wealth building loan, but it has to be a shorter term loan. And they have to use it to buy down the rate, which has a lot of other advantages that we can get into if you're interested, but they can use it to buy down the rate, which helps on the affordability side, but also helps on the prepayment, slowing down prepayment speeds. And if they do have a 401k, they get an 8-point subsidy or credit that they use for the same purpose, and that's to help offset some of the cost of saving for retirement and give them an incentive to actually save for retirement while they're buying the house. And that would provide much more stable lending and wealth building on a combined basis, so you get this result, not that result. So with that, thank you.
Thank you, Ed. Joe, can you talk about your experience with the Wealth Builder and how you sold it?
After all that, I feel like I can just go home. It was a little over a year ago, 14 months, give or take. My boss sent me a link to an article on the Wealth Builder and said, take a look at this. And so I'm reading it. It had to do with Bruce Marks and NACA. And so I'm reading it, and I see where they're doing these loans at 0.5% interest rate, 0.75% for 15 years. And I'm thinking, well, there is no way we can do that as a bank. I mean, just can't give money away like that. But the concept, which we had elements of it already in our portfolio, intrigued me, so I did a little more research and contacted Ed, and he explained it to me a little more. So, yeah, it made sense that a 15-year mortgage is going to build equity much more rapidly. Question was, how do you do it in a capitalistic setting? We need to earn a profit. So how do you do that? As a small community bank, we're under $1 billion up in Maine. We have to earn our clients' trust every day by fostering their prosperity with smarter banking. So I had to really think about how we could take this concept and implement it in a way that would be applicable in everyday life, gain traction in the marketplace. It's easy for a bank, in fact, it's necessary for a bank to apply some funds to satisfy CRA requirements. Every bank is doing that. I wanted to come up with something that would not only satisfy the CRA requirements, but would be self-sustaining. Because with a lot of the CRA initiatives that banks take, it's maybe a one-time shot, and then it's gone. Then next year, you're wondering, what are we going to do this year for CRA? So with that, I came up with our version of the Wealth Builder Home Loan. So why is it called the Wealth Builder? Well, as Ed said, in the first 3 years of this mortgage, 77% of the payment goes towards the principal, as compared to a 30-year where only 32% goes to payment of principal. At the end of 3 years, and you really got to think about this, at the end of 3 years, a Wealth Builder home loan has more than twice the equity of a 30-year loan. Now that's amazing. That's real wealth right there. So let me push this button here. Point it back there. There we go. Okay. So the Wealth Builder is our innovative solution to building equity with a 15-year mortgage. And so what I did in talking with Ed, and I think Ed really liked the idea I came up with, is I said, I reached into that mortgage toolbox he was talking about, and I went back to the future and said, you know what? The way to do this is as a two-step. So that's what we came up with. It's consider this 2 loans in one. One for years 1 through 7, and then another loan for years 8 through 15. Got it, okay. So one of the great features of the Wealth Builder is we do not require a down payment. No, there's no money down, okay? What we do have is a very low interest rate to start. So the borrower pays points to get the lower rate. So we charge 3 points, and we start you off at a rate of 1.75%. Now, where I live, a lot of people don't even have the 3 points to pay. But everyone needs a home. Not everyone should necessarily have one, but everyone needs one. And had to figure out how we can accomplish this. So said, you know what, we can come up with something to finance the 3 points even for the people that need to do that. So this thing is not, there we go, okay. So what we have again is step one, pay 3 points at 175 for 7 years. Step two, the rate jumps to 5%. Now that seems like quite a jump, but at the end of 7 years, you have a tremendous amount of equity, so that balance has dropped. You believe you're at, you've paid off 43% of the principal after 7 years. So now when that payment adjusts at year number 8, you only have a payment shock of 13.2% after 7 years. Now, as Ed said, most people buy a home. As time goes on, their income increases. So this is not a payment shock that is too much for your system. And you have a seasoned homeowner at this point. Worst case scenario, if they really can't handle it, they can always refinance. The other option we have, option 2, which is you pay 3 points, but you have to finance them. So we elevate the rate to 2.125%. And then year number 8, it goes up to 5.375%. But we kick back $2,000 towards closing costs, which enables the client to get in at an affordable number. I did the math. It's still profitable for the bank. This is a profitable loan, and it works in the community. The payment shock, again, stays within the 13% range. So if you look at this chart, which we'd seen in one other format, there we go, you can see the difference in equity after years 1, 2, and 3. And at the end of 3 years, with an FHA loan, with your 3.5% down payment at today's rate, which is 4%, with the upfront MIP and so forth, compared to a wealth builder, at the end of 1 year, you have more equity in a wealth builder with no money down than you have with an FHA loan with 3.5% down. At the end of 3 years, you're almost at 20% equity in the property, compared to FHA, which is barely, not even 10% at that point. So how does that build wealth? Well, the obvious graph, you own the house in half the time. And you can see how quickly that balance declines with that graph. And then, oh, that went back. How do I get it back? This one. And how much interest does a borrower save? Well, in our calculations here, based on a $175,000 loan, saving over $80,000 in interest. Well, that's $80,000 you can put towards your children's education or towards your retirement. Is it going? There we go. Okay, so the meat and potatoes of this is there are other low down payment programs out there, as Ed and others have so eloquently stated. You know, Fannie, Freddie, FHA, they're all competing against each other to serve the same people. So we can come up with these great ideas, but if we can't get market traction, it doesn't go anywhere. So this is what the wealth builder that we designed, this is what it does. There's no requirement that you be a first-time home buyer. Most state agencies and Fannie Mae in their prior configuration required that you be a first-time home buyer. There's no geographic restrictions. Rural housing, you have to be in a rural designated area. There is no income ceiling to qualify. State housing agencies, Freddie Mac, rural housing, again, if you're making a certain percentage above median or what have you, are good credit risk, but you're ineligible for the loan. I don't think that helps anyone. So we don't have an income ceiling. There's no service requirement. You don't have to be in the military or have served in the forces. Our interest rate is lower than most, I think all, state housing agencies. And it's not subsidized by any special bonding or anything. It's a market-priced rate. Your buying power is about 89, 90% of a 30-year mortgage. Now, at the time I was working on this, FHA had not reduced their premium, so it was much closer. At that time, it was like 95%. Then FHA cut back on their premium. It's still a lot of buying power. Credit quality, so we've lowered the score. We're down to a 660 credit score, which I don't believe is giving away the bank to people that don't have a willingness to repay. Now, on the 15-year, there is no mortgage insurance at all. And best of all, the realtors love, the borrowers love, and even my underwriters and shippers and closers love. Not being a government loan, there's not all that extra paperwork. So it's more efficient in that regard. And then to compare on the worksheet. So you're a real borrower, you want to buy a property, and here's what you're faced with. So in the center, I have your FHA loan, which, you know, many people, we're hearing 30% or so, would now take. So to buy a $175,000 home, if you look at the very bottom, the cash needed to close is $10,519. Now, I ran this based on numbers in Maine that would be applicable for us there. And if you look, the payment is $940 a month for the principal, interest, and the PMI. So to the left of that, I have my 103% loan-to-value version of the Wealth Builder. And your payment is $1,170 a month. Your cash to close at the bottom is $2,027. Now, that's an $8,500 difference. Granted, the payment is a couple $100 more a month, which would seem like quite a bit. Under the assumption that your borrower actually has $10,000 to bring to the table to close an FHA loan, he's better off to take my 103% version, put that $8,000 in the bank, and supplement at $200 a month, which is about 40 months, to make his payment on the Wealth Builder. And now he's got 20% equity in the property. If he goes the FHA way, he's got hardly anything. Compared on the right-hand side, at the 100% financing, the payment is closer. It's at $1,106, so you're $170, give or take. And your cash to close is still less than an FHA loan. So this product has achieved tremendous marketplace acceptance in my home state, to the point that something that never happened to me in my 20-plus year history of lending, had a real estate office that we have zero affiliation with call me and ask me to come in and tell their realtors about the Wealth Builder home loan program. And when I was done, they were on the phone contacting clients that they had sold a home to in the last 1 and 2 years that had purchased their homes with RD and FHA loans to tell them they really needed to call Androscoggin Bank and refinance into a Wealth Builder. Because what the realtors see is that in a few years, they've got a step-up buyer. They have someone that can now sell, that has equity if they want to put down payment on the new home, or better yet, sells that property, takes that 20, 30, 40,000 in equity that they've built up, puts it in a retirement fund, bonds, whatever it is, takes another Wealth Builder, and uses it again. The realtors went crazy about this. So it works. I actually believe if I can make the right connections, which I'm hoping to make here, I could take this national, and I'm telling you, I could do $200 million, no questions asked. I could do $200 million on the Wealth Builder. It's been a great success. I'll leave it over to you.
Thank you, Joe. It's over to you, Jeffrey.
Great, thank you.
Talk about MGIC.
Well, I'm going to have to use my initiation here to figure out how to work the technology. So which one is it, the red button?
Keep going. Yeah, the red button.
The red button, okay. There we go.
Keep going. Or you can leave that one up. That's a good
Let's
one.
just talk with that one up. That's, I think the button is just a bit glitchy. There we go. Good. Good afternoon, and thanks. This is a great opportunity. I will say that before today's meeting, I knew that Steve and Ed were the spiritual advisors on this product. But after hearing Ed speak, I didn't realize how spiritual he was about this. So very revved up about this, and I think it's a great product too. In fact, I was nodding in agreement with your comment earlier that we really need to focus on the ownership aspect, and that's really what this product's all about. So what I'm going to do is I'm going to walk through how MGIC got involved in this and what we've done to date. You'll notice in the red text in the corner of the slide it says pilot phase. We're still technically in a pilot phase and reaching out to lenders nationwide to involve them in a pilot program. And I'll talk a little bit more detail as we get into this about how that's been going. But background, you know the background by now. From an MGIC standpoint, we were approached last fall by Ed, I think right after the conference where you had introduced this concept, and we immediately liked it. Being a mortgage insurance company who had some experiences with 100% LTV through the crisis, we obviously took great pause and had some concerns about that aspect, but we loved the borrower-centric wealth creative aspect of the loan. So we turned to our risk department and we asked them to take a look. And what we found is when we looked at 100 LTV loans originated from 2003 to 2007, pre-crisis, and when we indexed those, so let's say for index purposes, a value of 1 equals the overall default rate of 100 LTV loans with a 30-year, that were 30-year amortization term. And other controlling factors are, credit score. We looked at a minimum 660. We eliminated various property type risk, such as manufactured homes and condos. We neutralized for DTI as well. So we had, apples and apples, if you will, but this set of apples was a 30-year term, and this set was 20-year term or shorter. So we found out the claims index over here, when this equaled 1, the claims index on the 15 and 20-year term was, for any vintage from 03 to 07 through the housing crisis, was 0.1 or 0.2. So in other words, the 30-year fixed rates, 100 LTVs went down at a 50 to 100, 5 to 10 times greater rate. So on an absolute basis, as we looked at the 15 and the 20-year term loans and the 100 LTV category, on an absolute basis, it was a risk we thought we could accept. And so we decided to create a pilot and started to promote this pilot earlier this spring. I think May is when we really got going in terms of getting approvals from various states for our premium rates that we filed in relationship to the program. And we started engaging lenders in earnest in May, and we did our first, we insured our first loan in August, I believe. So by now you know the premise is you finance 100%, you use the amount of money that would be put towards a down payment to buy down the interest rate. You shorten that amortization term, and now you have a wealth creating machine that will really help renters make that move, we feel, into home ownership, because now there's a value proposition for them. We really think it is a prudent way to do 100% financing, and something else as I get into this I'll talk about. It's also in some regards a perfect fit for mortgage insurance under the framework of the Homeowners Protection Act in the mindset of the borrower. Because if you think about the mindset of the borrower, it's, I don't want to have mortgage insurance forever. Well, you get to the 78% auto termination threshold under the Homeowners Protection Act in 4 to 5 years. So the mortgage insurance falls off, and the mortgagor's payment drops. So that's if it's a borrower-paid mortgage insurance premium. So we'll get into more detail. We'll get into that as we can. Oops, I went the wrong way. There we go. Okay, so just to talk a little bit more about the concept of forced savings through home ownership. If you've taken a look at the Fed survey of consumer finances, it continues to show that the net worth, or I should say the equity that households have once you net out the residential mortgage debt from the residential mortgage value, continues to be the largest non-financial contributor to wealth on the balance sheet, and second only to the retirement assets. So the people who own homes have that component going for them. This chart is from National Association of Realtors, and really what it does is it illustrates that renters don't have that home equity component working for their overall wealth. So who have we targeted it to? And I just have to pause for a moment because we actually haven't targeted it. We go out, we talk with lenders, and lenders get creative about where to take the product. So as we've talked with lenders, they've really identified 3 audiences, and I think I've kind of ranked them in order. The first is they really view it as a way to sort of unlock the millennial potential. And I do agree with Sam, who was up here earlier, and he commented that he didn't think that student debt is that much of a barrier for those individuals who have completed their college education and are employed in their area of study, that those people will have the sort of income to support their debt obligations, including a mortgage. But why aren't they moving? And I think one of the reasons that millennials are staying put has something to do with a disconnect between the value of home ownership. You've always heard about the Great Depression generation and how they huddled around a nickel. Okay, well that I think is what's happening with the millennial generation. Is they're looking at the outcome of what happened to in terms of foreclosures, displaced families, and they're saying, why do I need to be in a rush to get into that? What's in it for me? I think the wealth building home loan gives us something of value that we can show them. The old saying, a home without equity is a rental with debt. And I think that's the mindset of some millennials. They don't feel that buying a home is necessarily going to be wealth creative for them. The second group that I think is out there is the low to mod income borrower. And as both Ed and Joe have shown, there is some modest loss of purchasing power. Less with a 20-year, a little more with a 15-year. And typically, we have, as an industry, approached the low to mod income market by trying to maximize purchasing power, under the assumption that these borrowers are working off a lower income basis. So, boy, we really need to have a mortgage loan product that's going to maximize their ability to afford the home they want to with the income they have. And I think that I was actually kind of surprised because I came into it thinking the LMI borrower will not be a target audience, but we've had many lenders get creative around how to target this to the low to mod income home buyer. Lender credits is a perfect example, helping overcome the cash to close, further buying down the interest rate, getting closer with that purchasing power, and then going to the nonprofit that counsels home buyers and telling that story. And now that nonprofit is not focused on purchasing power, they're looking at wealth creation. And so it's an alignment of the channel, if you will. The other is the wealth niche. So you go from the low to mod income to the wealth niche, and so many community banks and credit unions that I've walked into have said, this would be a great program for our doctors and dentists, because they're located in a geography that has a lot of, as a hospital nearby or a Mayo Clinic, for example. So you're seeing this as a wealth niche, particularly for young doctors who are dealing with substantial student debt, and yet they can finance 100%, and we know that they're going to have substantial growth in income in the coming years. So as we get into it, I usually lead my discussion off with a lender by saying, suppose you're sitting in front, you're a loan officer, and you're sitting in front of a borrower. And you were to say to that borrower, would you be interested in me showing you a loan where you're going to pay about $56 more per month? You're going to put down about $2,000 less, though. And oh, by the way, you're going to pack away another $320 a month in equity. Does that sound like a good value proposition? And of course, everybody says, well, of course it does, because now you're focusing on $56 less, $2,000 less down, and $320 more a month towards equity. Tell me about this. Well, what we have here, and I'll give you the backdrop for this analysis, is the blue is, this is the monthly payment comparison. The baseline here is it's a $200,000 purchase price. We used a borrower with a 720 credit score. We have 3% being paid by the borrower for the conventional 97, which is the blue bar. And we have zero down payment in the other two loans. But we have 2% discount points being paid by the borrower to lower the interest rate in the red, which is the 20-year wealth builder, and the green, which is the 15-year wealth builder. And the loan is a 7-year ARM, which is kind of irrelevant because we don't assume any adjustments in the financing costs over time. I did this scenario back in September. The bond market was crazy, so I forget which day I used for the pricing proxy. But what I came out with is interest rates were 4% on the conventional, 3.5% on the 20-year, and 3.125 on the 15-year. And for mortgage insurance is a cost that's factored into this analysis. On the blue bar, I used the agency requirement of 35% coverage on a 97 LTV. And for a borrower with a 720 credit score, that's 110 basis points annually. And for the other two loans, I used the coverage that most of our pilot lenders are defaulting to, which is 20% cover, reducing their exposure to their entry point to 80. And I used an LPMI single, which is financed into the rate, so there's no additional monthly factor. And that single premium is, for this credit score borrower, is 2.5% one time, and it's factored into the rate on a revenue factor of 5, so half percent a year. So that's the basis for the following slides, and as I go forward here, here's the lower cash to close. So you've put 3% down in the 97 and 0 in the other two, but you've paid 2 discount points in the wealth builder options and none in the conventional 97, so the net benefit to the borrower is about $1,880 less cash to close, assuming all other closing costs are the same. And what does that lead to? That leads to, again, a variation of the charts you've already seen, that the paid-in equity comparison is pretty substantial. So there is a crossover, a point at which the equity in the wealth building options catches up to the conventional 97. For the 15-year, it happens in month 10. Okay, so you put 0 down, and by month 10, you've caught up to the conventional 97. From that point on, you're going past it. For the 20-year, it occurs in month 21. And just picking a point on the chart here, 5 years, let's say 60 months into it, the wealth builder, the red bar, the wealth builder 20-year term has 54% more paid in equity than the conventional 97. The wealth builder 15 has an astounding 131% more paid in equity than the conventional 97. So really, what's the key? The key is getting lenders and realtors to sell ownership and to have ownership be, if you will, the capstone of the American dream. From a borrower's standpoint, it's really helping them to see the wisdom. You used that word earlier, Tom, helping them see the wisdom of this and not be complicit in their own demise. Let's move on and talk very briefly about what's going on with the pilot program. Okay, so these are some of the common products we've seen in the pilots. Because it's community banks and credit unions, we're really looking at variable rate products. And they range from 5/1 ARMs with varying caps to 7/1 ARMs. The 7/1 ARM, these are sort of ranked in order of preeminence. And then, of course, the stepped rate mortgage, we're working with Joe towards a 7/13 step rate 20-year structure. And I wanted to talk very briefly about that step rate structure. By the time it steps in year 7, the mortgage insurance is gone. So we're not really looking at that step rate structure as a risk factor, but we are looking at it from a payment shock factor and will the borrower be in a position to be able to absorb that payment shock? And under Joe's program, where you use BPMI, remember the BPMI is going to fall off before the step. So there's a trade-off. Discount points, lenders are generally paying 2. Sometimes they're doing 3. There are QM considerations to discount points. Your first 2 discount points are excluded from the points and fees cap if they are bona fide according to the CFPB's guidance. That third discount point would account towards the cap. However, we've had a number of community banks put forth an interpretation that if it's being paid by the seller, that it's not. So we've seen seller-funded discount points. Just to kind of move forward into the eligibility really quickly, we do provide an option for lenders to proxy approval based on DU, Fannie Mae's desktop underwriter, or Freddie Mac's loan prospector. Our own data shows that in the non-GSE market, when loans aren't being sold to Fannie and Freddie, that lenders anywhere between depending on the time period, 65 and 75% of the time, are using DU and LP as a proxy for the risk they're willing to write a loan on. And therefore, we do allow them to use that as a proxy here. The overlays, of course, are that it would be a max 100 LTV, a max 105 combined loan-to-value ratio. So we do allow some assistance. A minimum 680 credit score, and then they have to follow the findings of the feedback report to fully underwrite the loan. Manual underwriting, we have our own set of guidelines, which are, you're not going to be able to see this up here, but it has the same overlays as a DULP, the 680 FICO and the 105 LTV, CLTV. We do eliminate some of the loan type risk by requiring any ARM to have an initial fixed payment for 5 years. So somebody couldn't do this on a 1/1 ARM. We do require a minimum of 3% of the borrower's own funds. Now, however, that can be met by prepaids, required reserves, discount points, closing costs. So it's not necessarily down payment. It is money they have in the transaction. And most of the instances, borrowers will have that. And we do have a maximum total debt to income ratio of 43% on the program. From a premium rate standpoint, we do allow this to be done on a lender-paid or borrower-paid mortgage insurance basis. And under those 2 types of mortgage insurance, they could do a single one-time premium or a monthly annualized premium, which is the most common form of mortgage insurance. It's where it's collected as part of the monthly mortgage payment, placed in escrow, and ultimately remitted to the mortgage insurer. Coverage levels range from 12 to 42%, and we tell the lender that they can pick the coverage level. Obviously, if a secondary market were to evolve for this type of product, the investor would come in and dictate coverage levels. And just a visual on our premiums, again, I've highlighted the yellow bar, which is the most common coverage selected. These are the single premiums. They are risk-based priced according to credit score. And then you get into our monthly premiums, again, ranging from 1/2 to 7/8, depending on the credit score. So with that, the slide everybody likes to see, questions, because they know that we're now into that free-form portion. Thank you for your time.
Gentlemen, nice job, all three of you. Great presentations. You can now see why I use the term wisdom with this mortgage. I mean, the rapid equity buildup, the lower start rate, the slower prepayments associated with these mortgages, and really the near perfect fit to the life cycle, I think are all factors that should promote and promulgate this product over time. A couple of questions for the panelists before I turn it over to the audience. Ed, in terms of promoting the program, how are you going about that? How are we getting the word out in terms of the wisdom of this program?
So the program had an initial substantial flurry of coverage in the media in the first 3 or 4 months. That's died down some. And so in the meantime, what we've been focusing on is continuing the development of the market-based programs through Andescrogan and other lenders, working with MGIC, who, as I said, has been the most active in customizing their mortgage insurance for the wealth-building home loan with all of these specialized premiums and approaches. We've been talking to federal home loan banks. We've been talking to state housing finance agencies. We've been talking to other lenders. We're talking to CRA lenders. Any lender that's in the room, anyone who knows a lender, whether in the room or not, have them, hunt down Steve or myself. We'd love to talk to you. I know there's some in the room that we've talked to in the past. We're just trying to get traction wherever and whenever, and and again, our hats are off to Andescrogan and MGIC for really taking this and running with it, because we put it out there. There's been a lot of creativity around it, all of it positive, and it has to be something that the marketplace accepts, and we need to get traction. And so anything anyone can do to advance that, we're all ears.
Joe, a question for you as well. Relative to the profile of the borrowers, what can you tell us about the borrowers? Have they been predominantly low and moderate income? Are they first-time borrowers? What kind of input are you?
Well, that's a good question. So the assumption I believe that Ed and others had, I know I did, going into this, is that we would be going for the low mod borrower, the underserved type. Well, our overall portfolio at the bank has an average credit score of 744, and the median is 757, with a range of 643 to 820. For the wealth builder, the average credit score is 741. The median is 740, with a range of 677 to 817. So what we're seeing is that we're getting high credit quality. Some of that credit quality is with borrowers that might be in the low to mod bucket, but savvy, experienced buyers, or just first-time buyers that are coming into the market are seeing the value of this program. That's what we're finding.
Okay. Thank you. With that,
Jeff, do you have some of the same kind of metrics?
As
a smaller,
as Joe is talking about that, I was just thinking we haven't really looked at that yet. As I mentioned, we insured our first loan in August. We have about 16 pilot lenders right now, but our pipeline looks similar. I would say that some of the early adopters of the program do view it more as a CRA program, and as a result, we've seen smaller loan amounts, and I would say probably smaller loan amounts is the characteristic that I've seen with some of the early adopters.
With that, let's turn it over to the audience. Questions? Morris, you're right in front.
This is a question for Joe, really. Do you have a sense for what ultimately the return on equity is going to be for the bank from these mortgages? And the reason I ask is there is risk of a refi at year 8. And the question is how much of the total return to the bank requires people staying in the mortgage past year 8?
Well, if you look at the, I was concerned about that, so I ran some models, okay, based on today's numbers, today's rates. In year 8, okay, the borrower has 8 years to go to pay that house off. What's he going to refinance into? Another 15-year? He's going to have to pay closing costs. And how much is that going to save him? At the end of the day, it's not a palatable move for the borrower to make. The more likely scenario would be that they pay off early. And believe me, if you're paying me 3 points, I want you to pay off very early. Or that there's a life event, a divorce, they have to move, they sell the property, something like that. With regards to the divorce even, what I believe is a very real possibility, you know, now under the 30-year model, couple gets married, 4 years from now they realize that it wasn't a smart move, and there's not much equity in the house, and nobody wants it. Of course, they're calling the bank saying, hey, I'm getting divorced from this guy. Can you make me, get me free from the loan, make it obligated to him? Which you can't do. Now, with the 15-year, 4 or 5 years in, there's some equity there. They want to keep the property, or if they can't, they just can't come to a resolution. There's enough equity there where they can put it on the market, the realtor comes in, pay the 6% commission, they can still walk away whole. So I looked at that. Payment stream-wise, as far as full term, if you run the numbers, it will generate as much interest income as your 15-year mortgage at 3,125.
So is the bottom line that after 7 years, if the loans all pay off, you're still happy with what you got?
I'm still happy
Yeah.
because
If you
along with
return-
that, you know, we're a community bank, okay? So I'm getting into your checking account, I'm getting your auto loan, I'm getting your business loan. It's a whole holistic way to lend and serve our customers.
Tom, if I could add on that. It's interesting you went to that, Morris, because I've talked with Joe about that quite a bit. Because one of the things we go into community banks, they say, boy, I like the idea. I love the program. I don't know that I can make the yield work. But this concept of looking at it in 2 loans, where however you get there, whether it's a step up or whether it's an arm that adjusts to underlying cost of funds changes, if the second part of that loan is priced to the market, then the first part is all between the points and what you can do with those points once they're in the bank at the closing table, and of course the interest that you're getting off of it. So we put together a little spreadsheet to kind of help lenders think about that, where they can toss in various variables, and it's actually helped, I think, because lenders don't often, we were a little surprised by this, not every lender is really looking at things from the standpoint of a return on equity. Some are looking at it like a return on average assets, for example, for a bank. So the whole ROE model is not always part of the way they're looking at pricing. And they also don't tend to use discount points much in portfolio products. They use that regularly with agency products, where you're going to go out and you're going to look at the grid and you're going to figure out, gee, what a point gets you here, and so on, and then they're going to go with that price. So I think the whole concept of discount points on portfolio products has been a little foreign to some of the lenders we've gone into, and it's required elevating that discussion from, you know, the mortgage manager into the finance department, and then them taking a holistic approach to it. But then the discussion goes, geez, this is more than a mortgage product. This is, to what you said earlier, this is wealth creative. What if what if, by the 5th year, we call these people back up and we see if we can get them to move some of the money out into an investment and start to diversify their assets. So, their household balance sheet isn't just net worth in the house, which, as we've learned from this conference, is a very fungible asset. But they now have it in something that maybe is a little more stable and that they can count on. So it's really interesting to hear how community banks and credit unions have really tried to think holistically about solving the problem once they dig into it.
Yes, sir. You had a question?
A question for Ed. There's some aspects of this that look desirable for lenders. My guess is that people who select these, there may be some selection bias, even given all the other statistics about them, their credit score and their income and so forth. Given those factors, they may be people who are more likely to pay off. That's just a guess on my part. But if you really try and make this a general program replacing FHA 30, then you lose that. And an interesting question, I wonder if you thought about, in a really bad market like 2008, 2009, 2007, initially the equity position is actually worse. If house prices are decreasing very rapidly, are the early payment defaults, have you tried to figure out how that might affect early payment defaults in such a market, and what the trade-off is on that with respect to the other obvious benefits?
A great question, Pat. So there are sort of two answers to that. One is we are assuming that these are well underwritten loans. One shouldn't have to assume that. That should be the standard. However, we got away from that. We have gotten back to it in some respects. We now verify income, which we stopped doing in large measure. And number two, I think, again, residual income would be a big step forward in general. But even in a financial crisis, if there are well underwritten loans, the early payment defaults shouldn't be what we saw last time. They were poorly underwritten loans, but we're going to say, hey, these are well underwritten loans. So a loan shouldn't default, even under distress, much in the first couple of years. It takes time for people to wake up and say, hey, my house really is, cratered and yada, yada, yada. And even the unemployment and all that stuff to develop. We did do a stress test in Prince George's County, and we talked about Prince George's County this morning, and that's one of the reasons we selected it. And we actually took every house in Prince George's County, starting in 1998, I think it was, 1997, and we said, okay, there are 112,000 properties, and we're going to give each of them an FHA loan, and we're going to give each of them a wealth-building home loan, and it was a 15 versus a 30, and we're going to do a 0 down, yada, yada, yada. And we're going to take the interest rate of the day, whatever it is, we're going to do everything. We are going to see where they were in terms of underwater. And needless to say, the ones that were done in 96 or 97, after 7 years, did okay in general because house prices soared. Now, I'm not sure one can rely on that experience again, hopefully not, although stranger things have happened, as I mentioned this morning. But once you got to, and I forget what year it was, 2003 or so, 2004, once you got to 2004 book and 5 and 6 and 7 and 8, those things started cratering in the 30-year. And the 15-year wasn't completely immune, but the percent that were underwater, I think averaged 10% were more than 10% underwater, something like that, versus 50 or 60% on the 30-year loan. And again, we were taking house prices, individual house prices, and tracking. So we actually had a house price index for each of the 112,000 houses. So we actually could mimic as if these things were real in the marketplace, based on all taking out this single type of loan versus the other loan. And the depth of the negative was much, much less. So even when it was the 10% that were underwater, it wasn't underwater by much. And so we concluded from that this provided a lot of protection. I think Steve coined the term, you're really self-insuring yourself for this, because with the faster amortization, you end up covering the risk of loss by building up the equity. And so I think that answers both parts of your question.
Gentleman in the white shirt, striped tie.
Yes, Joe, I'd love to be part of that $200 million next year. And as a banker who pays taxes, I hate to think that a credit union is the only institution in Oklahoma that's doing it. But nonetheless, quick question for each of you. First, Joe, what have you encountered any concerns of that from your regulators as far as a capital standpoint or anything about having 100% loan to value? Then Jeff, does MGIC offer any sort of dual underwriting of this product for the MI policy? And then lastly, Ed, what is out there right now? What can banks or the banking advocacy, such as the American Bankers Association, what can we do to help get this out more and also advocate either with the Federal Home Loan Banks or that for developing a secondary market on this?
All right. Well, to answer your question, we are permitted to have a certain percentage of loans exceeding 90% LTV. So we figured out what our dollar cap is on that. And that's also a reason why I did speak to Jeff regarding an MI component, which we're working on. But so far, it's all good.
You are a bank.
And we are a bank.
Not a credit.
Yes, that's true.
From the underwriting standpoint, a number of lenders who are participating in the pilot, we have a contract underwriting relationship for them, and even though they are the investor, they're having us underwrite the loan through the contract. Whether there's a contract underwriting relationship or not, a lender could have a delegated or a data-only approval, or they could.
So I just wonder if we can do something really meaningful to really protect consumer, to really inform consumer. You do have a choice of a lot of options that you just mentioned. So unless we have this, I think we just send up consumer as victims.
So I think two things. One is, as we've discussed here, the wealth building home loan is all about focusing on sustainable lending and reliable wealth building, which is a very different focus than government programs and other programs, so-called affordable housing programs have had over the last decades. Secondly, the next panel is going to be talking about informing the consumer. And so, for example, Ralph McLaughlin from Trulia is going to be talking about renting versus owning and how to evaluate that. Joanne's going to be talking about FICO credit scores and what's going on there. And Jack Horton's going to be talking about walkability in neighborhoods and how that differentiates neighborhoods. We'll be talking also about how in the next year's conference, we hope to have a lot more about what I call know before you owe, and it's not the kind of know before you owe that the CFPB does, but real know before you owe, because the CFPB doesn't look at things like risk. They just look at a lot of disclosures of information that tends to confuse rather than illuminate the borrower. So.
Another question? We're in the back of the room.
So, despite the fact that the FHA has reduced their ongoing mortgage insurance premiums, I guess in the last year, they're still sort of quite high by their historical standards, I guess notwithstanding the financial crisis. And I was wondering, how much do the economics of this product depend upon, like in terms of the cash flow? Do they depend upon the FHA rates being what they are today?
Well, that's a great question. You might also throw in interest rates. And so to answer the first question, if FHA's historical number was closer to 50 basis points, I'm on record as saying that if the Fed raises their interest rates, I don't know, I doubt if it'll be tomorrow, but sometime next year, let's say, I think FHA will take the opportunity to lower their premiums again. That'll have some impact, probably not as much as the 50 basis point drop. And if, in fact, interest rates are going up at the same time, one of the interesting things about this product, and it kind of gets back to the payment shock, we've now put ourselves in a position with this 30-year loan, and Rick talked about it this morning. If you go from a 4% rate to a 6% rate, you actually have a lot of payment shock that occurs, because of that, in terms of buying buying the same house at the the higher rate. The shock in going from a 3.25% 20-year or 15-year to 5.25% 15 or 20-year is actually a lot less, for the same reason that the payment shock going from 1.75 to 5 is not that great, because so much of that payment at the 3.25% was going towards principal. And so when the interest rate goes up, the principal component doesn't change much. It actually goes down a tad, but it doesn't change much. And the interest component doesn't go up by as much as a proportion, because it was a small proportion to begin with. It goes back to those percentages. On a 15-year, it was the 78% principal, and on the 30-year, it was 67% interest. Well, if you raise the interest rate, you don't have as much payment shock impact on the wealth-building home loan. You have a lot on the 30-year. So I think they end up probably canceling each other out, is I guess the long and the short of it.
Sam, you have a question? Thank you. Quick comment on Pat Lawler's question to Ed. So we haven't done that analysis, but we've looked at the performance of negative equity mortgages, and the default rate monotonically increases as someone goes upside down. So when they go 5% upside down, 10, 15%, the kink in the curve is at about 25 to 30%. That's when you get a big spike in default. So my gut tells me that you need very aggressive home. You're never going to get there. Yeah. So that's a comment. And a question for Steve and Ed. Have you guys thought about approaching builders that are looking at sort of middle income starter or who are trying to build middle income starter homes as a potential client, or the lenders that they work with? So I'm thinking of LGI in Texas. Ryan Homes is doing that in North Carolina. There's one other builder I'm missing that's doing that in Texas as well. So the idea is to work with the builders, not just the lenders. So the supply side, not just the demand side.
Steve from the Home Builders is sitting there across the way from you. So Steve, can we talk about that? Working on it. Good.
And actually, to that point, that $200 million that I was talking about that I know I could do easily, I'm thinking about the builders. You know, I'm way up in the Northeast, a little piece of Maine. If I had broader tentacles, greater wings, you know, who was talking about this could be, what, 25% or so of the mortgage industry? That's legit. That is legit. You know, when Jeff was talking that for $50, $60, $70 more a month, you own your house in 20 years instead of 30, and it's as much or less cost, cash to close, to get in. The borrower that doesn't take that deal is not the borrower I want to lend to.
So back to the home builders, the interesting thing, and Steve presented this morning, if you're a low-income home buyer, low or moderate income home buyer, and you're in a low land price area before the boom, you end up speculating in land, big time. If you're a higher income buyer, and tomorrow I'll talk about Bethesda, a home in Bethesda, and where the land share is 50 or 60 or 70%, whatever, I forget what it was, 70%, you're still investing in land largely. You're not speculating quite as much because it can't go up. You know, it can't go up to 100%. I mean, it does become a teardown at some point, but but you really you're investing a lot in land if you're low income and the share goes up. You're investing a lot in land if you're relatively high income and the share starts out high. And you end up, if it's gentrifying, you end up investing in a lot of land that started out low, but the gentrification makes the utility, for whatever the reason that it's gentrifying, the utility's improving, which makes the land value more. So it's this land issue. The builders, you know, live and die on that, and they make a lot of their money speculating in land, buying the land cheap, building things out, and then selling that cheap land at a much higher markup. That's a brutal business because it's very cyclical, and the ones that don't do it well or do it on average tend to get hurt a lot as that cycle changes. This is an opportunity to get a situation where that speculation process is much reduced, because you end up having a lot more equity against what is actually a pretty volatile asset, namely land.
I just wanted to add that one of our most recent pilot entrants is a mortgage company that is affiliated with a builder in the Midwest, and they're selling their production to it's a mortgage company that's owned by a bank. They're selling their production up to the bank. So somebody's made that connection already.
There's another question here. Yes, sir.
Yes. I guess this question is addressed to Joe because of your existing experience. As a realtor that sold hundreds of foreclosures with my buddy over here, in the past crisis, one of the concerns that we had and we saw all the time in the registry was when the fake equity existed during the ramp up, people were equity stripping their house. Every few months I'd see another mortgage. Is there any provision within your mortgage, within this WBHL mortgage, that keeps that from happening, or at least not exceeding the 80% threshold?
Yeah, the 3 points. They don't, I mean, if you're paying 3 points to get a loan, you got a refi to pull out, you're going to pay another 3 points or something. It doesn't add up. The numbers just don't work.
And the second mortgage issue, again, back to there's nothing new in mortgage finance. You can also look at that same 1934 hearing, and they talk about the evils of second mortgages and the equity stripping that took place. And we never learned these lessons. In fact, we, to some extent, codified it back in the early 80s when interest rates were very high. And something called the Mortgage Equity Something or Other Act of Garn St. Germain basically said lenders can make second mortgages regardless of what the first mortgage document said, because that we want to free up the equity. And we want to let them keep the first in place and allow them to tap that equity for a new mortgage. That was when rates were 16. Last time I checked, they were no longer 16%, but Congress has not revisited that provision since they passed it in 1982. So we'd love, and we think in the low mod area, and NACA put some provisions on this. They actually make a loan, I forget the amount that they put on there, and they say, the NACA program provides a subsidy, and we put a value of that subsidy of, and I'm just going to make up a number, $15,000. Therefore, we're going to record a second mortgage that you don't have to pay anything on it, but has a $15,000 value. That basically means if you want to go get another second mortgage or take out a refinance, you have to go get their permission, because they, in effect, can block what's going on. That's a way to get around this legislation that Congress, in its wisdom, passed 30 years ago.
Any other questions? Otherwise, please join me in thanking the panelists
We're actually a little ahead of schedule, so why don't we take a break and reconvene at 3:30 for our last panel today, Housing Markets Informing the Consumers.
Good job. Good job. Appreciate that.
Joe Cater, how are you? Good to meet you. We've been
Joe.
looking at your program.
Yes. Good to see you.
Most of our explanation.
we'll get ready to turn to panel 4. And this panel is standing between you and cocktail hour. So the sooner you sit down,
Enviable place to be.
that's your incentive. The sooner you sit down, the sooner we can get started. Let's see, who's talking over there? Tom Lamalfa? Tom Lamalfa? Tom Lamalfa? Take a seat. Joe? Steve? Okay, coming to order. As I indicated a little bit in the last panel, this informing the consumer, this is a first for us in terms of trying to focus on this in the conference on housing risk. We think it's very important, and that's why we wanted to highlight it at this conference. And as I said, we hope to expand appreciably in the future. In the consumer area, there are many disclosures. You can buy a refrigerator, and it tells you the energy savings or energy usage. A washing machine, a car, and its crash rating. You buy an item of food, and it tells you the caloric and nutritional information. We are on a scale of 1 to 10. We're at like 1 on mortgages. I already mentioned the Know Before You Owe initiative of the Consumer Financial Protection Bureau. Doesn't even scratch the surface of giving any kind of information that is really useful to consumers on what they're facing when they buy a home or consider buying a home. And so today we've got Ralph McLaughlin from Trulia talking about rent versus own and what some of the trends are in renting. And how you make that decision. We have Joanne Gaskin from FICO talking about credit scores and what's going on there. We have Jack Horton, who's in addition to your agenda, who will be talking about the change in demand related to things like walkability and other transportation aspects. We think that there's a lot more that can be done. We're going to be working on some of this ourselves. We're going to be trying to get others that we can bring next year that might be looking at this. How do loans perform under stress? We do a lot of that today, but we think that could be gotten down to a consumer-facing solution. We have all the data. We could provide that. We think that the volatility in a market at a very low geography level could be provided to consumers. None of that's even thought about today. And all of these things we think would have a large impact on truly informing consumers about the decision to buy or rent and the decision of where and how to buy, the risk of the mortgage, et cetera. So with that, I will turn it over to Ralph from Trulia.
Thank you, Ed. Is this on? You hear me? Okay. My presentation is actually quite concise, so I'm going to start off with a couple of stories, like I do many of my presentations. First, thank you, Ed, for the invitation. First story is it was perhaps the most unique invitation I've ever had. Most of the time you get emails from folks saying, hey, we like your work. Would you like to come and present? And you say yes or no. This was actually a phone call right after I got done doing one of the first rent versus buy reports from Ed. I'd not met Ed before, and it was 30 minutes of picking apart the rent versus buy model in a lot of detail, and so there's a lot of good back and forth about this model. And the whole time I'm thinking, what the heck? Is he just called me to pick apart this model for 30 minutes? And then after 30 minutes, he goes, that said, I really like it. I'd like you to come out and talk about it at the Fourth International Housing Risk Conference. So I said, okay, I'm sold. Second story is that the rent versus buy report and the rent versus buy calculator that we have at Trulia actually came out of a Innovation Week project. We have Innovation Week at Trulia, which is basically 1 week a quarter, where all employees can stop what they're doing and just start doing any sort of innovative work they think that would be valuable for the company. And so the moral of that story is it's amazing how productive your employees can be when you don't let work get in their way. Second story here. Okay, obligatory corporate slide here. If I can get this to, this worked earlier when we. Batteries have probably run out now. One more story. Okay, one more story. Here we go. I am part of the Trulia brand. Actually, this refers to the next slide, which is the obligatory corporate slide. I am an economist with the Trulia brand. We were acquired by Zillow back in February is when the deal closed. We do operate independently in many regards, specifically when it comes to economics research. We do have two separate economics teams. We do share some underlying data. But the work that we do is very much independent of one another. We all are part of the Zillow group. Again, we have several well-known consumer brands that you may have heard of. Zillow, the most popular, followed by Trulia and Street Easy and Hot Pads. Street Easy tends to be New York only focus, and Hot Pads is more rental focused. We do have some other business brands that you may not have heard of, including Diverse Solutions, Moretech, Retzley, and most recently we acquired a company called Dotloop. Dotloop is basically DocuSign for real estate agents, and we're sort of chomping at the bit to get access to their data because it's just another interesting source of data on real estate transactions. Okay, so let's talk about our rent versus buy models. At Trulia, we have two rent versus buy models. The first is a general model that drives our biannual rent versus buy report, and I'll talk a little bit about both models. The second is a consumer model that drives our customizable rent versus buy calculator. And so the first model is really designed more as a housing market metric report, akin to other reports that both Trulia and other online real estate firms conduct. But again, general models require pretty static assumptions in order to keep the report parsimonious and simple. That said, every household is unique and different, and so we felt there was an even better value added to a product that was customizable for a household, where a household can essentially go to our website, open up the calculator, and customize the inputs that go into that model. And so let me talk a little bit about the inputs that do go into both models. Both models are driven by the same algorithm, the same underlying framework. The inputs include prices and rents, interest rates, the time that a household anticipates that they will stay in the home, the tax bracket, the amount of down payment that they put down, maintenance, insurance costs, and taxes, amongst a few other things, which I'll show you at the end of the presentation. The output, because we are a consumer-facing brand, we like to keep the output very, very simple and easy to understand. And the output in both models is the percent cost differential between renting and buying over that particular year that a household, over the particular time that a household stays in the home. Again, like I mentioned, we do have a certain set of assumptions we have to make, especially for the general model. Traditionally, our assumptions have been that a household will stay in their home for 7 years and they will put 20% down. As we have heard from Ed and other presenters, in fact, this is one of the things we went back and forth during our conversation, during the invite. That doesn't necessarily hold in a lot of circumstances, and particularly because we are a website and we are focused on all consumers, but a number of our consumers tend to be on the younger end, millennials, 25 to 34. For this most recent edition of our report, we wanted to change those assumptions to better meet that cohort of consumers. And from looking at the most recent ACS data on how often this cohort moves, instead of moving every 7 years, years. They tend to move about every 5 years, which does play a role. And also, depending on where you get your data source, I think Ed said something about households now putting on average, was it 7%, 5%?
70% have 5% or less.
70%, 5% or less, right.
Which is what we're talking about.
Right. So we conducted a Harris survey a couple weeks ago, actually, and we just asked households, if you were to buy a house now, how much could you put down? And 65% said they could put 10% down or less. So we did go a little bit, conservative, at least towards the upper end, and assumed for this particular edition of the rent versus buy model that they move every 5 years and they put 10% down. Again, those are general assumptions that don't fit every household, and so we do have our consumer calculator here, where a household can change the inputs and thus change the assumptions that go into the model. So let me just briefly talk about the 5-step method that we use, and this is a very simplified explanation. First is that we estimate the price and rent for the median value home in each metro. So I'm going to go through an example through each of these 5 steps for the DC area. Now, I just want to be clear here that these are not median sales prices and median observed rents, and the reason being is that becomes problematic because the distribution of homes that are occupied by owner-occupiers tend to be quite different than the distribution of homes that are occupied by renters. So what we do is actually we take Zillow's home value estimate and rent estimate for the median home. So we take the estimated value and rent that home could garner on the market to do comparison. So it's more of an apples to apples comparison about prices and rents in a given market. Second is that we determine the initial monthly cost of owning and renting, taking into account things such as PITI or principal insurance, principal interest taxes and insurance, but also in this particular case, because we are assuming that households are putting 10% down, that they do have to pay mortgage insurance. And then we also have our standard assumptions about average renovation and maintenance costs, and also what the rental cost would be, when also factoring in renter's insurance, which not all renters get, but some do. So again, we wanted to be sort of as conservative as possible about what the expenses would be. And then for utilities, we do just assume a $100 premium for utilities in an owner-occupied household, primarily to take into account things such as owner households tend to have children that use up more utilities, more energy, so on and so forth. Third step is then to project the future total monthly cost of owning and renting. This primarily applies to rent. We do estimate home value appreciation based on the 20-year FHFA annualized rate. And again, this is probably one of the biggest caveats of our model is predicting what prices and rents are going to do. We do, since we do over a 20-year period, that does take into account at least the last downturn. But again, this is something that can be customizable for every household who's interested in using the calculator. Fourth step is that we factor in one-time costs and proceeds, and primarily these include the upfront down payment, the sales proceeds after selling the home after 5 years, any sort of closing costs associated with buying or selling a home, the initial rental deposit and the return of that deposit, and then any sort of appreciation rate that we apply to the sales proceeds. And the last step is to then calculate the net present value of all these costs using a discount rate. Again, another assumption here that can be tweaked. And as you can see on the right side of this chart here is what the final output is. So in this particular edition of rent versus buy, assuming these assumptions that in the DC metropolitan area, it is roughly 18% cheaper to buy a home than to rent a home over 5 years. I am going to go through an example at the end using the calculator where I tweak some of these assumptions to show you exactly how sensitive rent versus buying can be, the rent versus buy metric can be for a particular household, where changing just a few inputs can have a drastic effect on the differential in cost between renting and buying. Just an example of what some of the products are that come out of both models. This is our rent versus buy report map that allows a user to look across the largest 100 metropolitan areas and actually determine how the rent versus buy metric varies across the landscape. And it also allows some pre-specified assumptions that you can alter here, such as the interest rate, such as the tax bracket that you're in, how often you move, and whether or not you have to pay HOA fees, which was actually the theme of our last rent versus buy report. On the consumer side, this is what our rent versus buy calculator looks like here, and this is just a national average taking into account the median home value and rent. In the U.S., as you can see, this is actually assuming some of our old assumptions here, that if a household stays in their home for 7 years and puts 20% down, that buying is approximately 37% cheaper than renting over that 7-year period. So now I'd just like to talk about the findings from our latest report that we just released last week. The major findings here are that buying is still cheaper than renting. Assuming our classic model nationally, it is 36% cheaper to buy versus rent across the 100 largest metros. However, when we change our assumptions to better mimic young households, young home buyers, that metric actually goes down quite a bit, goes down by 13 percentage points down to 23% cheaper nationally. So there is some sensitivity, amongst the cohort who may be interested in buying or renting a house. The second finding is that some markets are actually quite sensitive to price and rent fluctuations. I would say at least over the last 3 years, which is what we also did in this report, interest rates would have come into play last year and the year before, but interest rates now at least are roughly on par with 2012, which is when we first did the report. But some markets, despite the fact that interest rates haven't changed a whole lot, are quite sensitive to changes in price, movements in prices and rents. And last, what we wanted to do, because there's been a lot of discussion about where interest rates are headed. In fact, I just saw earlier that the Fed announced that they are not changing rates, at least in this particular month, but still leaving it open for the rest of the year. We wanted to see what the break-even point would be of interest rates that would essentially set the rent versus buy metric to zero, basically a stress test with interest rates in certain markets for this particular cohort. And what we found is that Western metros, many of the metros that Rick talked about earlier in the West, but also a few out here east, are actually quite sensitive to changes in interest rates, where actually a mortgage rate increase of 25 to 50 basis points would actually make the decision to rent versus buy for these households a wash. And so that was particularly, a particularly surprising finding from our report. So just to briefly go through places where buying is a tough call. Using our assumptions for the general model, what we found actually was that there are 2 markets in the U.S. where buying is actually more expensive than renting, and no surprise, they tend to be in places where the price to rent ratio is quite high. So those 2 markets are Honolulu and San Jose, and Honolulu is actually 5% more expensive to buy a home than to rent over a 5-year period if you put 10% down. In San Jose, that is 2% more expensive to buy versus rent over that same time period. However, there are a few other markets where the decision is a lot closer, particularly in Orange County, San Francisco, and Oakland. And I think what's particularly interesting here is that each one of the Bay Area markets, which Rick identified as being white hot, are actually getting very close to the cusp for young households about whether or not it's a better deal to buy or rent. There are many markets where actually buying is an easier choice, of course, assuming that a household is in the situation to actually have a down payment ready to go. So Houston, Texas is the market in the country where it is the best. There's the best advantage to buy versus renting. It's about 46% cheaper to buy than to rent. But also other southern markets make that list: Baton Rouge, Fort Lauderdale, and Miami, where it's all somewhere in the low 40% range, where it's approximately 40% cheaper to buy than to rent over that 5-year period. In fact, the only non-southern metro to make that list is Syracuse, New York, where it's about 44% cheaper to buy than to rent over that time period. Now I want to talk a little bit about some of the volatility that I mentioned earlier. Actually, surprisingly, we found that there are, of the 100 largest markets in the country, there are actually 10 where buying is actually a better deal today than it was 3 years ago, back in 2012. Houston, San Antonio, Greenville, Akron, Albuquerque, Long Island, New York are actually slightly a better deal to buy today than they were 3 years ago. And that's primarily because, at least in some of these markets, either prices have remained relatively flat, so particularly in places like Akron and Kansas City and Birmingham, or in other places where rents have actually outpaced price growth. And those markets include places like New York and Long Island. However, there are many more markets where buying is less of a better deal today than it was 3 years ago. And in fact, if you compare the 10 markets that have seen the biggest change in where it's getting cheaper to buy compared to the 10 markets where it's getting more expensive, the change is quite drastic. The magnitude of change is quite drastic. And if you look at the right-hand side of this chart here, and it's a little blurry to see, but many of these markets that have seen the biggest drop in whether it's cheaper to buy versus rent tend to be in places actually that were hit quite hard during the recession as far as prices, where prices dropped quite substantially. So these places include Bakersfield, Phoenix, Fresno, Riverside, Las Vegas, Ventura. You can see sort of a pattern here about what happened with prices during the recession. In many of these markets, prices have actually started to rebound quite strongly, and in each one of these markets, the ratio of prices to rents over that period is actually increased, and that's primarily what's driving that change in these 10 markets where it's more expensive to buy than to rent. This is the mortgage rate tipping point, break-even point that I discussed earlier. In fact, in places like Orange County, San Francisco, and Oakland, if mortgage rates were to rise up to around 4.4, 4.5, 4.6%, our break-even, our rent versus buy metric would essentially be zero, which means it would be a wash. There would be no advantage to buying or renting in those particular markets. So those are markets that we're seeing as being the most vulnerable to interest rates changes, particularly for the potential home buyer. There are a few other markets, Sacramento and Ventura, that are within about 100 basis point increase as far as being vulnerable. But these top three are certainly at risk for homeowners who are thinking about buying maybe in the next year, especially if interest rates increase. So the last thing I want to talk about is just give you sort of a demo here of our rent versus buy calculator. I do have to apologize. When I put this PowerPoint together, we hadn't quite released our report yet, so these numbers are not current. These are actually based on our last rent versus buy report. But the spirit of what I'm going to explain will stay the same. So if we look at median rents and median home values in Washington, D.C., we assume a household stays in their home for 7 years, puts 20% down, gets a mortgage at 3.85%. It is 31% cheaper to buy versus rent. And these are the standard assumptions. Oop, I should advance that so you can see it. There we go. These are standard assumptions that a household can log on, get onto our website, use the calculator, use these slider bars to best suit their particular household needs. However, that is quite simplistic. There are only 5 categories that we have here. It's tough to see, but if you look at the bottom left of our rent versus buy calculator, we have an option that says show advanced settings, and this is where we start to get into the nitty-gritty of being able to alter the assumptions to better suit a particular consumer's needs. So let's take this example here, and what I did actually to demonstrate how sensitive the rent versus buy math can be is I then changed the assumption, tough to see here, from 20% down payment to 10% down payment. And you can see just doing that kicks down the rent versus buy equation from being 31% cheaper to buy to only 25% cheaper. Excuse me. And you can see other mortgage assumptions here that are customizable. Such as FHA loan, a VA loan, mortgage terms. You can change the buy and closing cost, long-term capital gains tax, selling closing costs, etc. We also allow the consumer to change their assumptions of ongoing costs here. And so what I did for this particular metric was actually, or for these particular inputs, I increased the utility cost for a homeowner by a few $100s. So instead of $100 more a month, it's $300 a month. And factoring in actually homeowner fees, HOA fees, which I think many households, especially young first-time home buyers, don't necessarily take into account when they're thinking about buying a home. So $300 in some markets is actually about the median HOA fee, maybe a little bit below, depending on where you live, especially San Francisco and New York. They tend to be a bit higher. But here, just entering that in, so increasing utility cost to $300. Increasing HOA fees from 0 to 300 actually has a very, very big effect, and that's because these are ongoing costs, and actually kicks down the rent versus buy metric down to being only about 2% cheaper to buy than to rent in DC. And the last bit of assumption that we allow users to change our economic assumptions. So these are things such as rent appreciation or price appreciation, the discount rate, inflation, and so on and so forth. What I did here was basically knock down the home price appreciation to be a little bit more conservative from 2.5% down to 1%. And you can see that actually also has a big effect because part of the advantage of buying is building equity, having home price appreciation, and having that left over when you sell your house to reinvest. If we kick that down to 1%, it actually has quite a big effect here and actually makes it 14% more expensive 14% cheaper. This should actually be 14% more expensive. But you get the gist about how sensitive these inputs can be. And so, aside from our report, which we publish on the Truly Trends page for market insight, we think perhaps this has much more value added to the consumer because it allows them to customize the assumptions and better suit their need. So just a few takeaways here, just to summarize. Rent versus buy model has dual purpose, one that's a general model, one for the consumer. In general, first-time home buyers or millennials, if you want to say, are better off buying, but that the decision is actually quite sensitive to the inputs, as you may have suspected. And so that was the last example that I went through. So thank you so much.
Good afternoon, everyone. I'm Joanne Gaskin with FICO, and so I want to also thank Ed for inviting me to participate. For those of you who I haven't met before, I'm responsible for our mortgage and regulatory practice at FICO. So what does that mean? I spend most of my time with mortgage risk executives and the agencies here in DC to make certain that we are helping support our clients. And I have a lot of fun, right? Yes. So the most important thing that I wanted to convey today in terms of the conversation that we were going to have is specifically talking about what we see in terms of FICO's role in the topic that we've discussed so far today, which I think is incredibly important, in the sustainability of homeownership. And so in terms of sustainability of homeownership, there's, I think, two prongs that I wanted to talk with you about that FICO has underway, one of which is to make certain that we're providing the most predictive score that we possibly can in the marketplace. And so I want to spend a little bit of time talking about what we've done with FICO Score 9 and some of the research associated with building that score with you. And the next is really talking about consumer transparency, or the work that we're doing specifically reaching out to consumers through education, which we think is also of critical import to sustainable homeownership. So with that, let's first talk a little bit about FICO Score 9, if we could. So that is our latest score that's out in marketplace. We started releasing that at the latter part of last year, and we are thrilled to say that that it has reached the greatest level of interest at the fastest pace that we've seen historically. So at this point in time, we have lenders who comprise about 85% of the lending origination volumes in testing phases with us. So we're very excited about that, and I'd like to explain to you why I think that they are excited about what we're doing. So the first, and many of you might be very comfortable with this, but we normally start with talking about what drives the FICO score. And so there's the 5 information zones within the credit report to begin with. And so the first we talk about is the personal identifiable information. That is not used within the FICO score, but it's of course very important for matching for the data contributors to the CRA. The next zones are used, so public record information, which tends to be derogatory in nature, collection items, also derogatory in nature, trade line information, so very important. This is where we're going to find our bank card, auto loans, mortgage information. In terms of what's open, what's being paid as agreed, and what's available in terms of credit. And the last but not least, credit inquiries, or that pursuit of credit. And that's for hard credit inquiry. So we want to make certain that we're not confusing that with a consumer looking to check their credit report or their credit score. That's not a hard inquiry and has no impact. So what's really interesting to learn is that, from the study we've done, is that you have, based upon the different bureaus, you would find 170 to 200 million consumers have sufficient information at the 3 CRAs today in order to generate a FICO score. Now, our minimum FICO score, it's important to understand in terms of having to get to that number. So the first I'll put out there, which tends not to be particularly controversial, is that the file can't say that you're deceased. Okay. So if we move on from that, yes, everyone seems to agree on that one. Then we say, well, we need to have at least a single trade line open, and it must have been open for at least 6 months time period, and also updated within the last 6 months. So what that means is you could have a credit card open for a period of 6 months, and you automatically get a credit score. Okay. Now, the interesting thing is 28 million consumers actually lack this information in their credit file at all, so they do show up at the credit repositories, but they don't have sufficient information, and we're going to drill into that a little bit further in order to get a credit score. And then there's another 25 million consumers that are frankly just credit invisible, meaning that they have nothing at all at the credit repositories in order for us to score them, and we're going to talk about that a little bit in some additional detail as well. The others we'd just like to point out is, there's a lot of talk about alternative credit data, and so when FICO talks about that alternative credit data, we mean data that does not reside within the 3 primary CRAs. There are other FCRA compliant data sources that are out there, but what we're talking about is that which does not reside at the 3 CRAs. So let's take a moment and take a look at how does that non-scorable population break down. So let's take first the 28 million that have data at the credit repositories, but they just aren't scorable today. And so the largest section of that we refer to is the involuntary inactive credit segment, or that's almost 40% of that population. What it means is that these are folk that at some point in time had a derogatory event happen in their life. Perhaps they went bankrupt, there was a foreclosure, for some reason there was a negative event and they've walked away from using mainstream credit. The average age for this population is 43 years of age, and the median time since something was updated on the credit repository for them was 3 years ago. Okay. The next group we call the involuntary inactive credit, right? This is our parents' parents or our parents, but it is the median age is 71 of this population. Most of them have everything paid off as agreed. There's nothing derogatory on the file, and they frankly have just stopped using credit. So in this case, the median age or median time period since someone has last seen an update on their credit file is over 4 years ago. The next group, which we say is the new to credit group, is pretty persistent out there over time. It's the group that has some traditional credit on file. They just haven't gotten to the 6 months necessary to get a credit report yet, or a credit score, and that's roughly about 2 million consumers. And then the last group are the group that just simply has collection and public record data only out there. Average age on this group is 43 years of age, and nothing's been updated close to 3 years on the credit file. And so when we take a look at that population, and there's been a lot of discussion around, gee, should we expand access to credit by scoring more people with the data that's at the credit repositories? We'd say, well, likely, probably not. I mean, looking at this population segment, these are people that have either walked away from credit or have a derogatory reference that's very old in time period. And so that's probably not the fair thing to do for this consumer, is to score them on something that happened in a derogatory fashion 4+ years ago. We probably want to go look at alternative type of data for them. Similarly, if we take a look at the other group, which is the 25 million for no traditional credit report on file, again, alternative data is the avenue we believe to go. And so from an analytic perspective, you want to take that next step and say, well, with the information that we typically have to build a score, what does that look like, and what does it look like if we were to try to build off of these stale files that we talked about? And so there's this question that we always say, is there a sufficient representative performance on which to build a robust score? And so if we take a look at the current FICO scoreable universe, which is off to the far left-hand side, you'd say when we take a snapshot to build a score, we look at our performance over a 24-month time period. And you want to make certain that the consumers during that you're using in that population segment have performance reported during that time period in order to have something we call classifiable performance. And what we'd see is when a traditional FICO score, using our minimum score criteria, 85% of that population has classifiable performance. So we feel pretty good to say that if we've got 85% of the population behaving in a given way, that it's simply representative to model the rest of the population accordingly. If we move to the stale file segment, so that group that we said, there's no credit score out there today, and we look at that same type of 24-month time period, we'd say, do any of these people actually get credit during that time period? And what we'd say is actually what we found is 4.6% do. And so the question is, if you had 4.6% sample, do you believe it's appropriate to assume that 4.6 is going to be representative of the remainder? So, I was thinking a long time about coming up with a business example of this. And I scratched my head and I thought, there is no good example. No one would ever assume that less than a 5% data sample actually is a good example of what's going to happen for the rest of the population, right? So this is one of the reasons why we say that it's not a good idea to take the population that has such a small amount of credit access that are stale and make an assumption that we can use that information in building a model that is going to be robust. So what you'll see out of us and for next to come is instead we've said, instead of using the traditional credit file for this population, we're going to look outside of the credit repositories and look for alternative data. So we're not going to cover it today, but for those of you who are interested, we've created an alternative data score. We call it FICO XD, and it is in pilot with the 12 largest bank card issuers right now. And so not ready for mortgage, but we're very excited about the prospects of using additional data outside of the credit repositories to help this population segment. So talking about, FICO Score 9 has gotten a fair amount of press because I think it, covers some of what we would consider to be more consumer-friendly features. And so I thought we'd just talk a little bit about some of the advantages of FICO Score 9 for you really quickly. So the first is, it covers all the data in the credit repository. There's been a lot of discussion about, how much rental data, how much utility data actually resides in the credit repositories, and do you include it? And so FICO Score 9 does include that information. I will tell you that rental and utility combined represent 0.02% of the information that currently is at the credit repositories. So it is an incredibly small percentage of data that resides there. We are using it, and obviously we would be advocates for additional positive and rental data coming in, but it just doesn't frankly move the needle much in terms of being able to score additional consumers. We've changed our treatment of collections, which we'll talk about in a few moments, but the most important that's caught headlines is we're ignoring paid collections, as well as we're changing the weighting for medical collections. So we'll talk about that. And then lastly, using multifaceted modeling approach to improve origination performance. And that matters because a lender who has a more predictive score is in a position to typically originate more loans, right? So if we move to, just real quickly, then the next slide, which would talk about the revised treatment of collection agency accounts. This is important to understand. So this is about third-party collection accounts. So it doesn't mean an account that is in collections at the lender at this point in time. But so a loan that has gone delinquent and moved to a third-party collection, if they pay off that collection, it's going to be bypassed by the credit score, FICO score 9, and it'll have no derogatory impact. Unpaid medical collection accounts will be assessed now differently than unpaid non-medical collection accounts. And I know that we all have internally, probably within family, et cetera, anecdotal evidence within our own lives of why maybe there is a differential there because of the collection process associated with medical collections. Well, we found some hard data to support why you would want to do some differentiation. So the slide that we have up here for you to see right now is we look at bad rate on the x-axis and over time on the y-axis. And so the benchmark, the little blue line at the bottom, is saying this would be the typical default rate or bad rate for someone who has no derogatory information on file, so less than 4%. But if we look at files with unpaid medical or unpaid non-medical, you can see that they represent significantly more risk. However, what you will notice is that those with medical represent less risk than those with non-medical, and so thus the reason why we have a differentiated treatment now within FICO score 9 for those folks. So someone who has a medical collection would see less of a negative impact on their score. I'm very excited about something we call multifaceted modeling, and I'm not going to tell you guys all about it today because I know I'm between you and cocktails. So, but what I will tell you, it is groundbreaking work. It's the first time that this type of technology has been used in a broad-based score, and most importantly, this facet 2 is bringing into effect looking at multiple goals technology, meaning that we are focusing not on just performance across origination, account management, and so forth, but we also have a secondary goal specifically around originations. And so what that's done is be able to provide additional predictive lift, again, for our originators. What that means, you know, a lot of people talk about score distribution. The more predictive score you have, the wider the distribution you're going to see because you want to separate goods from bads. And so what we do see is a movement with FICO score 9 a little bit further to the tails, and we do see additional consumers scoring in that 800 and up range, so in the highest level. So what we would find are more consumers able to qualify for credit as well as maybe getting better terms. And the best way to look at that, and I heard people talking about, you know, default rates at a given score range earlier. So maybe this swap odds table would help give you a picture of what that really means. And the way to read this is we start with a FICO score range off on the far left. We're going to see in the first two columns what percentage of the population scores above or below that score range using FICO score 5, which is a score that's used by the GSEs today. And then we're going to compare that. If we swapped in FICO score 9, what was the percentage of consumers that would swap now above that or below? And so if we can look at the 660 across, we can see 2.7% of the population now move above, 1.6 below. So we have a net positive gain of consumers moving above. But most importantly is taking a look at what the odds are. And so we represent odds in a good to bad ratio, meaning we've got 41.2 good payers for every one that would go bad at a 660. Right? And those swapping below at a 24.5. So 24.5 good payers for every one that would go delinquent. So across the score spectrum, you know, what you see are better performing records moving up, which is what you want to see for a more predictive score. Most importantly, this is the type of information that our mortgage lenders, you know, look at to say, is there an ability for us to grow origination volumes using the new score? So. Moving into consumer transparency real quickly. How many of you are getting your free FICO score right now from your credit card company? Right. Okay. Some of you are. That's great. So we were able to announce this past week that now over 100 million consumers have access to their free FICO score. And so just to tell you about the initiative, we thought it was incredibly important to have transparency between the lender and the consumer so that the consumer understood how does my lender perceive my credit, how are they managing it, and what can I do to improve it if I want to. And so the program was first launched, Discover, they really made a big splash. We had no idea that they'd take out national advertising, but a wonderful way to get your score on a monthly basis, track it, to make certain you understand where you are, your top 2 reason codes, so you can think about how could I improve my score and look at trending information as well. So we think this is one of the great advantages to consumer transparency to help consumers. There's a nice report that was just done by the Philadelphia Fed that specifically outlines the performance for the Barclaycard portfolio subsequent to rolling out FICO Score Open Access. So what we intuitively thought is true, the consumers who are educated and have the information actually perform better. So it's a very, very great story. So the other that we've done is, and it happened out of lots of conversation with lenders over the years and, loan officers, and they said, a consumer comes in, they've pulled a credit score and then they tell me what it is, and I pull in my system, and it's something entirely different. And how do we help educate people that there's multiple score versions in market, and maybe a consumer could have more than one score? And so I would just share with you that from the MyFICO side, which is our consumer side of the business, what we're doing now is if a consumer comes in and acquires their FICO score, we're giving them every last version. So you can say, guess what, I'm a 780 and I'm a general score, but now I know that if the auto lender is pulling an auto-specific score, what does that translate to? The bank card score or the score that maybe it's being used in the mortgage lending industry. So this just gives you a quick mock-up of what we're doing in terms of being able to provide that level of additional transparency to consumers. Also on the site, it will give the information around for consumers who don't understand, how scoring works, what does that score mean? Am I above average? Am I in the middle? How does my lender perceive that information? What are the top things that I can do to improve it? And also provides a simulator so they can understand if I pay down that credit card, what happens to my score? If I close an account, what happens? So trying to eliminate all the numbers of myths that are out there in the space so that consumers really have good information to make sound decisions. So with that, I think it's my turn to turn the machine over to my friend here. So thanks.
I am sitting here having what I call old guy flashbacks. How do I work this?
It's right here.
I'm old guy.
And point it up there, like by the
Okay.
clock. Yeah, there you go. Okay, keep going because I want
all right.
One more.
One more.
Oh, one more.
There we go.
Okay.
My background's technology, and I had the privilege of being on the team that created the first consumer portal for real estate. You know it as Realtor.com. About 3 years later, we did the system called EID Verifier that allows those 100 million consumers to access credit information. Did that at Equifax. These were 2 examples of what I call necessary new stuff. And the Places project that my partners and I have been working on for 6 years now is another example of that. What we're really trying to do is create the things that we're missing that would have made a difference. In March of 2009, I was summoned to Fannie Mae to talk to them about some of my experiences with other industries that had fallen in the ditch. How do we pick up the pieces? What I described to them, I said, your situation is you're having a Rumsfeld moment. And if you know the story, in 2005, as Iraq was coming undone, Rumsfeld turned to his senior staff and he said, we don't have the metrics for this. And the deficit that the Secretary was describing is really a consequence of calamities. This happens all the time. They invalidate the old norms, they reveal false assumptions, and they expose the flaws in our shared intuition about risk. But the first order problem, and I lived this firsthand with the chemical industry after Bhopal, was that it takes many years before you can really figure out what's been changed and what you should do about it. And as I said to him, your analytic framework just blew up the world, okay? And it's going to take us 5 years before we figure out what should we do differently. And that's just been the case. Now, our subsequent work identified 3 new dimensions, or what we call drivers, that help us to create what we call a post-crisis understanding of the risk associated with assets, financial assets, associated with housing. And oh, by the way, we believe that this work is going to have a great deal of consumer appeal. Certainly hope so. The first is that what I call the suburban dynamic that has driven housing for 50 years, folks, it's not just over, but it is in full reverse. Okay? This is a secular shift in demand. And Ralph, I'll help you with your model, okay, for a moment. We'll talk about Washington here for a second. There are 55 highly walkable urban places in Washington, D.C. They have a 60% 4 square foot price premium to the rest of the region. 80% of the commercial development is occurring within about a half a mile of a metro station. It's been driving the market for 3 years, and if you're not investing in one of those 55, you're flat. Okay? By the way, it's the same everywhere else. Okay, and we'll talk a little bit about that. The second is that one of the things that made this one different is distressed properties. And unfortunately, it's not just about distressed properties, it's about the execution of distressed properties. That has extended the pain, but worse, it has concentrated it in very specific neighborhoods. And you have to know where those are. You have to have visibility into it. Third, finally, and this is really kind of the key takeaway, you can stop listening after this, is that if you want to understand what happened through the crisis, what's going on right now, and more importantly, predict what's going to happen, you have to view this through a lens of neighborhoods, land type, and land use. These guys are geniuses, okay? You have to understand the land use piece. And most importantly, you have to understand the central factor of jobs, the importance and the role that jobs played in this. Okay, are you still with me? Have you tuned out? Okay. The question that I always ask, drives my realtor friends crazy, is a very simple one. See, the disaster that struck many communities is beyond the theory of actuarial models or metrics that are based on history. Folks, let me tell you, history broke in 2006, okay? In that sense, it's a little bit like 1989 when the Berlin Wall came down. The context completely changed, okay? James Galbraith describes these events as the end of normal. Well, 2006 marked the end of normal. And in Las Vegas, very good example. The first leg down in home price depreciation conformed to the accepted narrative of loss of market discipline. Okay, we had overbuilding, we had easy money, and we had defective underwriting. No debate, it was there. But let me ask you, why did home prices go down 62% in Las Vegas? Well, you can read the chart. Okay, it's really about jobs. Okay, and by the way, that's the way it is in the rest of the country too. This is all about jobs. Okay. See, the story in Las Vegas is that in the second quarter of 2006, as home prices around the country started to plateau, folks stopped taking money out of their homes and going to Las Vegas. They just stopped. Okay? The largest employer in town, Harrah's, which is now Caesars, over the next 18 months went from 87,000 to 69,000 jobs. What do you think happened to incomes in Las Vegas? Okay, it kicked off a deflationary asset spiral. Okay, it didn't just crush Las Vegas. It crushed places like Lowell, Massachusetts, and thousands of other neighborhoods and communities that are a whole long distance removed from the Sand States. You see, the thing that we learned in this, and again, I'm a former senior vice president of Equifax, okay, and I got a pass from Joanne to talk about this. Payment history and patterns, they matter. But the predictor that matters most, and mattered most through the crisis, was really very simple. It was a borrower's reemployability if they lost their job. If you're a security guard in South Boston, you lose your job, what's the likelihood that you can find another one nearby and keep your home? That's it. That's the list. Now, this thing called big data has helped a lot. But the question that we were really asking, particularly given what happened in Dodd-Frank and other events, is that what are we really trying to accomplish here? Okay? And as we talk to firms like MI companies, we say, listen, the objective here is to bound your lower risk. Okay? That's what you're trying to do. Okay? And the way you bound your lower risk is you have a very granular understanding of job types and location types and land use. And we'll talk a little bit more about that right now. But here we are, we're 7 years into this. And in Rumsfeld fashion, the housing sector still doesn't have the metrics for this. You see, big data asks very inconvenient questions of old systems. This is the question that we asked at Fannie Mae, by the way, in 2009. Took us 3 years to answer it. It took a while. But I would highly recommend to you the book by Milan and Sufi, House of Debt. Anybody here read it? Oh, no, he's read it. Okay. What they documented was the simple fact that if you have a local serving job, a job that serves the local economy, as opposed to a job that is tied to the national or the international economy, you are a lot safer. If you were selling cars at the Saturn dealership in Knoxville, Tennessee, you could pay your mortgage. But if you were building them at the plant out at Spring Hill, you're hating life. Okay? It's really no tougher than that. So as you think about this notion of how do we bound our downside risk, okay, well, what happens if China implodes? What happens if Putin or the Saudis come unhinged? Okay, these things have job effects in the United States, and that's what's going to drive your performance going forward. So this thing called big data has allowed us to really quantify for 140 job types, 30,000 zip codes going back 15 years, the controlling impact of location and job type on the propensity to default. We know what that is. And oh, by the way, yes, it's really good to be a nurse or a first responder or a teacher in Dallas, Texas, but not if you want a mortgage, because we don't have the metrics for that. Now, we know that underwriting was defective, but the execution of REO was and is dreadful. In Florida, starting in 2009, it took 3 years to move a judgment through the judicial process. The execution difference between the best servicer and the poorest servicer was 1 year. Now, folks, 40% of these homes are vacant, and there's something in Florida called mold. Okay? What do you think happened? They're teardowns. Okay? Who gets hurt? Everybody. So the thing that we also found, that, are there any lawyers here? Okay. Good, I'll say it. Okay. There was only a very, shall we say, casual relationship between the data that the law firms were reporting to the banks and what the actual system of record showed, which is a county court docket. Okay? You have to be able to see all the county court dockets in every judicial state to really understand what's going on with foreclosures locally. Okay? That system took 2 years, by the way. Now, FHA executed, and that is the proper term, 103,000 REO transactions in fiscal year 2012. They dumped properties at over 50% of their appraised value 35% of the time. In states, anybody here from Maryland? Okay. Well, the two worst states were Maryland and Virginia, interestingly enough. Yeah. In states like Maryland, entire neighborhoods were pulled underwater and they were rendered completely unfinanceable. Completely. Now, I'm not talking about West Baltimore. I'm talking about Gaithersburg and I'm talking about Aberdeen. Okay. Now, foreclosures are an example of how negative feedback or spillover effects, as well as bubbles, occur at the neighborhood level. But we don't have the metrics for this. Now, developers see the world and they view demand through a neighborhood lens. And what they will all tell you, and if you just simply follow the money, you will see how different today is than yesterday. Today, you see a lot of trade press discussion about the resurgence of Detroit. Have you seen those articles? Well, folks, 3 years ago, Dan Gilbert bought up 95 properties downtown and he moved 10,000 jobs downtown. Okay, and then he put his shoulder behind surface rail. What do you think's going to happen? Okay, we said this 3 years ago. Watch Detroit. It's number 6. Okay, it's coming. Okay, I'm going to have some fun with my friends at Magic. Okay, Ted, you can look out your window in Milwaukee and you can see this happening, can't you? Okay, the activity around the new arena. Okay, the surface rail. Okay, this is what's driving the market in Milwaukee. You go west to Madison, you go south to Racine, you go further south to Evanston. Big article in Politico, by the way, 2 days ago on this subject, okay, about how basically cars have disappeared from Evanston. Okay, then keep going to Chicago. There's a discussion of Chicago recently. It really all depends on where. Now, in Atlanta, which was the poster child for sprawl, well, Atlanta was crushed by the crisis, wasn't it? But there are 27 what are called walk-up neighborhoods that were bulletproof. What's a walk-up neighborhood? Well, anybody here familiar with the walk score? Okay. There are a lot of different variants out there. Okay, but the key threshold is 70. This designation of a walk-up neighborhood. If you've got a walk score of at least 70 or above, and you're adjacent to 300,000 square foot of retail and or office, okay, that's a walk-up neighborhood. And these mixed-use, higher density neighborhoods were bulletproof anywhere you look. Okay, that is a secular shift in demand. Now, in Atlanta, since 2009, 62% of the investment capital, commercial investment capital, has gone into less than 1% of the land. Same thing, by the way, here in Washington. Okay? A little different in Boston. Okay? But here's the thing. On a per square foot basis, the residential properties in those 27 neighborhoods have a 121% price premium to the rest of the region. You have to look at the price premiums. You have to look at what's happening with commercial in our major metros, because that will give you your sign on what's going to happen to residential. So if you look at things like multifamily starts, put them into this context. When you see shopping malls being repurposed, put them into this context. When you see absolutely suburban office parks, okay, it's for a reason. It's because employers can't get millennials and others in the creative class to work there. Okay. By the way, when was the last time we built a regional shopping mall in the United States? Anybody know? Pop quiz. It's 2006. Okay, it's been 8 years since we built a shopping mall in the United States. Okay, now the art of the possible has changed. It's changed a lot, and our thesis going in was that with the improvements in technology, the 3 to 5 year, what I call intermediate trajectory of individual neighborhoods was knowable. Now, these are 4 of the 133 neighborhoods in Middlesex County, Massachusetts. Anybody here from Harvard? We love to show Middlesex because it pisses off the Harvard people. Really does. Okay. But for those of you who can't see, Maplewood at the top is a suburban neighborhood northeast of Everett. They got a distressed property problem that is going to depress prices there going forward for some period of time. Also, the residents, as you look at job type, income, and education, have far less capacity to deal with an income event. And if you look at a whole series of indicators that will tell you a lot about supply and demand, demand is lagging way behind supply in Maplewood. It's also doing the same thing in Woburn, North Woburn, which is northwest on the way to Lowell, on the way to New Hampshire. Okay, not as big a distress problem, a little more capacity. What do you think is going to happen to the prices in those 2 neighborhoods? I got a lot of economists in this room. Okay, well, we'll talk about that in a moment. You go south of North Woburn, you come to a place called Newton Center. Anybody here know it? Okay. High capacity Newton Center. And you know what? Everybody wants to live there. And there's no supply. What do you think is going to happen to the prices in Newton Center? Now, West Cambridge, many of you probably know. Okay. West Cambridge is a walk-up. A lot of capacity, very little in the way of distressed. Everybody wants to live there, but here's the deal. There's a ton of supply coming on stream. Okay? Supply and demand are in balance. Okay? And these things you can see. Okay? The mass datafication of localities allows us to see this stuff. Now, these kinds of new metrics are recreating industries from football to pharma. And the fact that I have to say neighborhood supply, I'm right on, neighborhood supply and demand and capacity are new metrics, kind of tells you the problem, doesn't it? Okay. So you peel this back and everybody here knows that macro averages, I'm just going to be very blunt, and I'll probably annoy some people, but a metro home price index in my world is called a Mordor for you Hobbit fans, okay? These are metrics of rapidly diminishing operational relevance, okay? They don't tell you anything, okay, or very little, okay? Because if you look at the actuals, what occurred in Middlesex County, the Case-Shiller index for Boston was down 20 points. Middlesex was down 12. The 35 walk-ups, bulletproof. They were down 5, a lot of them went up, and then they quickly bounced back. The hard-hit neighborhoods, and these are 50 neighborhoods in the suburbs, were down 26 points. Now, by 2014, everybody had bounced back. But here's the thing. The walk-ups were up 46% peak to peak. In 2006, on a median sold price basis, they had an 8-point deficit to the drivable suburban neighborhoods. By the time we got to 2014, it was a 16-point premium. That's a 24-point swing in 8 years. Okay? Now, the last point I just want to make about this is that what we see going forward, and you'll see a 2018 indicator on there, is really what we were looking to accomplish. We want to understand the future, and we've said it's knowable. And we put these things into categories, into buckets, and there are 30 neighborhoods we think are just going to continue to scream. Some are in the neighborhoods, some are in walk-ups, but there are 30 that are going the other way. And those indicators you can see now. Okay, you can see how out of balance capacity, distress, supply, and demand are. It's visible. Now, there's a great book called Lee Gallagher called The End of the Suburbs that talks about this. Our friends at George Washington call this the new urbanism. Columbia University calls it the great reordering. Meredith Whitney talks about the suburbs being caught in the negative feedback loop from hell. Okay? But we call it the great divergence. And there was a nice lady over here who asked a question this morning about this thing is going bipolar. Okay? It's starting to look like a dumbbell. And it's not just Boston, it's just about everywhere else. So, the last thing, and I will go real quick because Mr. Pinto is going to hold me to this. The art of the possible and the art of the practical for the first time in this industry are aligning. This thing called TRID is a game changer. If you're going to fix a broken system, you got to fix it at the front. Okay? TRID takes 26 unaware supply chain points and turns them into a functional network. A functional network that can certify the documents, the data, and the dollars. Okay? Folks, this is happening now. Okay? It's happening today. Okay? You have technology now that can take the current status of a loan or an entire portfolio, and it can verify the contents, it can compare them, it can monitor them, and it can report it on demand in near real time. And we think that the future trajectory of collateral and credit risk at a neighborhood level is absolutely knowable. Now, I know that many of you are wondering, what's the weather like on his planet? But I would tell you that this, what we refer to as the next generation trust model for housing finance, isn't aspirational. See, American innovators have done what they always do when they're faced with a national interest need, which is they fill it. And all of the components of this next generation platform are under the non-QM tree this year. Okay? It's happened. Okay? Now, maybe it will change the economics, maybe it'll create some policy options, I don't know. That's stay tuned. But I appreciate your kind attention, and on behalf of my partners, we thank Ed and AEI for this opportunity, and we look forward to your questions.
Okay, we'll open up for questions in just one moment. I would, as food for thought, so we have this suburban apocalypse that's outlined, and so what's HUD doing is affirmatively furthering whatever, I can't remember the rest of what they call it, and they're trying to move people out into the suburbs, which seems like they're basically going to make it so that these areas that are actually going to be the stable, improving areas in terms of wealth get depopulated for people who are lower income and minorities. So think about that. Tom?
Yes, sir.
One comment is kind of to your model, actually. I've read about the same things, but in one question on the model was the average age of people getting married, and that a great part of the model was influenced by the fact that the families aren't having kids anymore. At 25, it's 35. And how will this affect the models in New York? And this is actually underway, being looked at by some people in New York.
Absolutely.
But the other comment is totally different. We've always known neighborhoods make the difference.
Yeah.
We weren't allowed to use them.
Right.
We're even less allowed to use them now. I had to serve every neighborhood in America with the multifamily programs that Fannie Mae. I found ways to do that safely, primarily through calling for an improvement in the properties so you had a good living environment. That cost increase meant that so many of the properties weren't feasible until we brought in the subsidy programs. So I didn't get the risk from that. But many of the people in this room probably have different federal restrictions on them in terms of being able to use this, because I can invert some of those and tell you some neighborhoods without doing anything. I once bought a property up in Massachusetts in a town that only had one zoned site for multifamily, and I bought it from a major developer, offshoot of Trammell Crow, and I bought it in 5 minutes, okay, because I knew the town, I knew what it meant, and I didn't even have to underwrite the thing. We later underwrote it to fill in the blanks. But this isn't new.
No.
But it's hard to use because of the kind of restrictions we have.
Yeah. No, we are facing what we refer to as the mother of all asset arbitrage opportunities. Okay? Because of what we call the Dodd-Frank dilemma. You have an entire sector that has been chained by legislation, by past practice and structure to weak analytics. Okay, so what's going to happen is that the smart money is going to do what happened in REO. They're going to steal the taxpayers' lunch money. Okay, and that's just what's going to happen.
Question over here. Yeah.
Thank you. I'm just curious what you think with the decline of oil prices by 50% in the last year and 60% in the last 2 years. What does this bode for states like Texas, Oklahoma, Louisiana? Are we going to see the same fleeing from the suburbs back towards more urbanization in some of those areas?
Texas is a unique case. If you look at the top 30 metros, and particularly this trend that I outlined, it ain't happening in Texas. Okay, of the top 30, San Antonio's number 30, where our HUD secretary comes from. Okay, Dallas is 25. Houston just built their third beltway. Okay, there are fundamentally different land use models in a lot of our cities, and Houston and Seattle are nothing alike.
Any questions over here?
Oh, no.
Just changing gears slightly, I had a question for Ralph.
Good.
Jackson, you're later. So Nancy Wallace at Berkeley in 1990 wrote a paper called "Should I Sell My House in San Francisco?"
In 1990.
In 1990. And that got published in a fairly famous journal, and the answer was a borderline yes, no. And it was exactly the same kind of calculations that Trulia and Zillow are doing. And basically, when we look at that, of course, the answer now, in retrospect, would have been, no, don't sell your house. You would have made a ton of money if you held on to it, which you did. So what I think we learned from that is that the rent versus buy decision, something has to be priced relative to an option. So there's actually two options when you buy that you're not pricing in the current calculator. The first option is on inflation. If there's any kind of inflation, the real balance of your mortgage falls because the nominal debt's fixed. The second option is that if house prices increase, you get all of that. And I think the value of those options shows up in the fact that average price-rent ratios vary across the country. So do you want to talk about this? Is Trulia really comfortable telling people that they shouldn't buy in high optionality markets?
We are, if we give households an option to customize their inputs. You may make the argument that some households may not be properly informed to do so, but that at the end of the day, it's the best we can do. The framework is solid, like any models. The inputs are often what make the difference. And so, looking ahead, 1990, looking ahead 10, 20 years. Is it gamble looking ahead 10, 20 years in any sort of market? It's very difficult to take into account. In the general report, we can certainly change up many of those assumptions in many different ways to try to give alternative views about what the world might look like in 10 or 20 years. But ultimately, the goal was to allow the consumer, particularly knowledgeable consumers, to be able to change those inputs. So I don't know exactly what went into the input in 1990 in this particular model, but having known then what we know now, about what prices would have done, I suspect that model, if it's based like ours, would have probably accurately predicted, the right decision, which would be to have held on to your house. So again, it's this dichotomy between, is there a structural flaw in the framework of your model, or is it have to do with, your predictability of what's going to happen 10, 20 years down the road?
One comment I'd like to make is we had built some extra time into the afternoon before the cocktail hour. And so if you have any questions on any of the panels that we've had today, we'll try to get those answered if that's feasible. Otherwise, we can continue taking answers on this panel. Yes.
Yeah, my name is Li Yang. Thanks for your presentation. It's very interesting. And I would like to explore even more. I think Mr. Horton is really mentioning a variety of variables affect our society. And you mentioned Maryland is the worst. And I have been meeting on the road, somebody said, are we living in a living hell? So, and then what you say, mention all those variables is really true in Maryland. In Maryland, you cannot go to court to see review the court file. And those physicians are good, but their accounting employees are bad because they can send all the false information to credit bureau.
Can you get to a question, please?
So my question is, can you explain more why Maryland is worse and what can we do about it?
Let me tell you how bad Maryland is. Properties were dumped 80% of the time at greater than 50% below their appraised value, and on average flipped in 12 days, and then flipped again. There was a massive private gain at public expense.
Flopped and flipped.
Flopped and, yeah, absolutely. Maryland was the worst. Okay. people made fortunes, and we went into the courts and we saw who was involved. And it's a national scandal, and it'll make your blood boil.
I think, as I recall, what happened was that those then become the comps, which then drive down the prices everywhere, particularly if it's a townhouse or condominium. Where
I can show you a very homogeneous set of 160 units out in Montgomery Village, Gaithersburg, where the servicers just drove the comps from 258 down to, let's see, HUD came in and dumped one at 18, and then it was flipped in the next week for 135. That's what happens when the market can't see what's occurring. Back to Ed's and Steve's basic premise, which is 100% right on. If the market can't see the signals, this is what happens. Okay, so that 160 units was completely unfinanceable from that point on. Okay, and the people who owned those units just got crushed. And I'll show you some Freddie examples of that too, by the way. They did it too. Okay, but it's not getting any better.
Question over here.
Several of you have indicated that the current linear decision process doesn't work. I heard the term big data, and that most of our problems are black swan events rather than continuous events that are done by scores. How close are we to fixing that problem and accounting for some of these big data or game theoretic models?
We're there.
Who's using them?
Well, we spent most of last Thursday up with the Stern School at NYU. It's the #1 data science school in the country. It was the first data science school in the country. Basically to have them go through the data and validate the data science of it. We feel pretty good about it. Particularly the jobs-related default risk has been validated against 12 million loans. So we feel pretty good about that.
Yeah, it's a good question, at least from the rent versus buy side, at least in our model. And I think this also sort of addresses a little bit further the question earlier, as at least in our model, it's fairly straightforward. If we look back at the cyclical nature of housing prices, we do assume now a linear appreciation rate, but it's not terribly difficult now with big data to go back and estimate the nonlinearity and build that into a year-by-year model of appreciation, whereby maybe in the first couple of years there's appreciation, flattens out towards the middle of 10-year, and then drops off at the end. You can model it in many different ways, and I think that's a fantastic suggestion that I think we'd love to look into going forward, the rent versus buy model.
So Jack mentioned Atlanta, and we have some data. I think it was in one of the presentations that the Atlanta city proper, if you look at house prices from 1996 to 2014 with Zillow data, and you basically stack the zip codes, the median house price and the zip codes, and then just start with and count the number of housing units, single-family housing units, and then just start stacking them, the bottom third, the middle third, the top third, and then you look what happened over that 18 or 19-year period. The bottom third, the zip codes that represent the bottom third of the market in terms of prices, had 0 nominal house price appreciation cumulatively over 18 years, 0. And in the city, it was better, at the high end, not tremendous. Memphis was another one that had 0 over 18 or 19 years. And so, where you live, we have this idea that, as I said, 3% price increase, 5%, whatever it is, that everybody thinks that, oh, that's what my house is doing. There is an immense amount of volatility within metros, among metros, between metros, and there's a huge amount of volatility within the metro that is based on the dispersion around those averages based on location, location, location. I mean, the realtors got it right, years ago. It's location, location, location. And we have drummed that out of the process, as Tom kind of indicated. And we need to get back to how do we, and I view it as a consumer protection item. How do we inform consumers about this so they don't go, headlong into, a horrible solution? And right now, we just sort of close our eyes and say, let's apply more leverage and hope for the best.
The theme that some of my partners and I have been on for a long time, since the topic of this panel is consumers, is when are we going to start treating consumers like co-investors? Stop treating them like sides in a transaction. And that's really a challenge to lenders, okay? Because most lenders don't know who their customer is, okay? They think it's Fannie and Freddie, okay? They think it's the investor that they're selling the loan to, not.
Partly the nationalization of the market.
Roger that.
I have a question over here.
In your research regarding the jobs and geographical,
Yes.
did you ever see any kind of correlation in the delinquency tied to how much equity they had in there, regardless of unemployment?
Yeah, if you take, a lot of research was done on this, and particularly from a strategic default standpoint, came up with a very different set of numbers than, shall we say, the conventional sources.
And can you speak to the strategic default and how it kind of shaped what we're seeing today and how borrowers behave now versus maybe, say, 10 years ago?
I'm going to defer to Joanne on the ins and outs of that, other than to say the reason that people default is, and believe me, when I got into this, I had a strong bias. I said, this is an LTV thing. Okay, so this is an LTV thing. Well, it wasn't. It was a jobs thing. Because the reason that people defaulted was they lost their jobs, they had an income event, they had some other life event. Okay, they were in a place that was hit hard by negative externalities like distressed properties. Okay, and they gave up and walked away.
Right.
Yeah, so within FICO, we have a research consortium that we actually tackled this problem because lender came and asked us, and MJC happens to participate in those types of discussions with us as well, to understand, is there ability to separate that defaulter strategic versus non-strategic? And so within the data, what we found was that LTV unto itself wasn't exactly predictive, but what you did find was that the velocity of the decline in the value of the property, as well as in the forecast for the recovery within the next ensuing 12 months in time period, was very, very indicative. To the point as well, what you understood, if you further profiled within that population, those who had professions that were able to pick up and move, so a transient, much more likely to pull the plug than somebody who was wed to the community. Yep. Presence of children in the home. There's all sorts of other different types of factors that came into play. Yep.
I would say one other factor to add, there are probably a number, but one to add to what Jack just said is if you were talking about outlying areas, and let's talk about Riverside, San Bernardino, I learned this from Penny Reed, who left a few minutes ago. Price of gas went up, it tripled from 2004, 3, somewhere around there, to 2006 or 7. And one of the things we don't take into account in underwriting is the commute expense. And if the price of gas triples and you're driving 50 miles each way and you've got 2 people in the household, that's 200 miles a day at $10 a gallon. If it goes up $3, which is what happens when it triples from $1.50 to $4.50, you're talking about a lot of money every day multiplied by 250 days. That's a lot of money. And all of a sudden, you're making that calculation. I can't afford to put the gas in the car and keep the payments up on this house out in the middle of nowhere.
The annual difference for someone who lives in a walk-up in their gas payments versus someone who doesn't is about $4,500 a year.
And we don't, not only don't we underwrite for it, so the person who's in the close-in thing can't buy as much house because they're getting, in the PITI, you don't, and the debt-to-income ratio, again, you don't take into account the fact that you have to pay, $200 a month or whatever it is, $300 a month in gas payments. And so they can buy the more, drive up the price over here, and they don't get any credit for buying the house close in. It's just we do everything backwards in the way the underwriting works, and again, it's just not productive. We had some more questions? Yeah.
One has to be a little careful, I think, about assigning causality, especially with the outlying areas. One of the things we noticed with Fannie and Freddie, their Alt-A loans, which were a disaster, were not very well correlated with income. They didn't help them on their housing loans, and in general, they hurt them on their housing loans, but they bought gobs of securities backed by Alt-A loans. But what it was associated with was outlying areas. And these are the areas that were growing fastest and had the easiest credit terms for people of all types. And it's hard to disentangle some of the factors about outlying areas you're describing and the credit financing.
Well, I think as Steve indicated this morning, that's one of our next areas to look at. I would just add that, Sam, I glancingly referenced it this morning. Sam Cater did an excellent piece of work, of detective work on low-doc, no-doc loans, and Fannie and Freddie were huge participants in that, and it wasn't just the securitization, but huge participants starting in 2003 in that market. They were really the market leaders. But what Sam found was that I guess it's this difference in differences type of approach. He said, okay, if I have a documented income, and I know it's documented, and incomes are going up 3% a year or whatever, and I look at what happened in 2000, 2001, 2002, 2003, and I've documented incomes, I'd expect that the incomes each year would go up by about 3% if that's what incomes are doing. And he found, yes, incomes went up because they were documented. And you would expect that. And then he said, okay, that's my baseline. I would expect a 3% increase in incomes each year. Now I'm going to look at low-doc, no-doc. And I'm going to look at low-doc, and I'm going to look at no-doc. And he found, well, back in, I think I mentioned this morning, back in 2000, 2001, there was some deviation, but it wasn't huge. By the time he got to 2003, it was starting to widen out. I forget the exact numbers. I have it on one of my postings. By the time he got to 2004, 2005, we were looking at low-doc overstating income by something like 25%, and no-doc overstating by like 50%. This was just out-and-out fraud perpetrated by somebody, including the borrowers, and at a point where DTIs were actually going up. So this is against a DTI that was going up, a verified DTI that was going up. You had this gap growing and growing in the undocumented income that was just feeding it. And of course, as we see in the land values, where was that needed presumably the most? And hopefully we'll be able to demonstrate this. Well, you needed it to drive up these huge speculations in what became land, which was in the outlying areas in Riverside, San Bernardino, et cetera. So I think we have another question over here.
Yeah, thanks. This is to the whole panel, but particularly to Jackson, I think, with reference to the impact of jobs on the housing market. I read somewhere recently that this kind of temporary project-based employment, particularly for millennials, it's doubled since '89. I think like 36% of the workforce now gets at least some of their income from this kind of gig-based economy.
Right.
I imagine there's a heavy amount of crossover to those people seeking walk-up communities as well. So just kind of curious if that's particularly challenging for underwriting. And then from a policy perspective, you see the DOL potentially changing the 1099 rules that a lot of these independent contractors, may not be classified as such in the next year.
I'm going to punt on the question of underwriting for this reason. Absolutely nothing that we have talked about or that we have worked on for the last 6 years will work in the origination process for QM loans. Okay, the regulatory brain damage is just much too high. Okay, it just we don't even go there. Okay, but from the standpoint of capital markets. Okay, people want to figure out what was really the central question of the crisis that was posed by Ben Bernanke, which is, what is this stuff worth? Okay, it really does apply there. And yes, the gig economy is absolutely real. And from a data standpoint, it does create some challenges. Absolutely.
So this issue of, let's say called self-employment or partial self-employment. And all I know is every time we've tried to address the self-employment issue through creative approaches, it has crashed and burned. 1985, Citibank developed Mortgage Power. You sort of can tell where this is going. And it was to help self-employeds get loans that they couldn't document the income properly. Part of it is, well, excuse me, where is it on your tax return? Well, mumble, 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 but a lot of different issues. And so they came up with low doc, no doc. It was called Mortgage Power. That crashed and burned. I have the article from the Wall Street Journal, 1990, big banks lose hundreds of millions of dollars, back when that was actually a real number, on low doc, no doc loans. Then we had it happen again. I just referred to it. Actually really started kicking off big time in 03, 04, 05, 06. By 06, it was a huge percentage, relatively speaking, of the mortgage market. And it crashed and burned. And we're getting the same siren call today, which is, and I heard it at the MBA last week, how do we deal with this gig economy? How do we deal with the self-employeds? How do we deal with, I mentioned the border income this morning. These are not new issues. We have, wrestled with these issues for a long time. It's very difficult to document and verify self-employment income, full stop, end of discussion. It's just difficult. We'll take the last question, and then we're going to have our well-deserved cocktail break.
So I'm from Detroit, so you probably guess who I'm going to ask this question to. So Detroit's fascinating. 60 years ago was the wealthiest city in the world, and now 1.85 million, and luckily, if you count them and bring some friends in, it's 650,000 maybe. And it's 147 square miles. You can fit Boston.
Hurry up with a question.
Mercantilism. Isn't that, basically, if it's all about jobs, and Detroit was basically wiped out because of its international exposure. On one hand, the AEI concept that free market will solve everything, but, the world is not run by God. So would it be crazy to say that maybe we should think about mercantilism as a more appropriate, more realistic about how the world works to, protect our interests?
Well, to pivot off of that a little bit, the fundamental strategy that is being employed by developers in Detroit and every other city in this country is time-tested. It's what built the suburbs here in Washington, D.C., and it's called value capture. Okay? There used to be a train that ran through Rock Creek Park, okay, that was funded by developers. Okay? The railroads, that was all value capture. How do I make money once I put down this transportation infrastructure, once I invest in this thing, how do I make money on the real estate that surrounds it? The whole H Street thing here in town is an example of that, and the same thing's going on in Detroit. Okay, there is a nexus here between residential demand for highly walkable urban places, and we just did Detroit, by the way, as well as Ann Arbor, Kalamazoo, several other places. It's the nexus between that demand, between transportation, and where does the jobs? Okay, is there a avenue to employ the creative class? It's not just the millennials. Okay, if I can just give you here just a quick anecdote.
Better make it quick.
Real quick.
Into our cocktail.
Okay, I'm in the boardroom of a strategically important financial institution in New York, talking about this subject. Chief sustainability officer of this corporation that shall go nameless, Citibank. looks at me and says, you know, you're describing me. I just sold 2 homes in the suburbs, and I moved into town, and we're really trying to figure out what the hell's going on in Tribeca. Okay? Now, okay. But there's something going on here, and what it is pretty clear. And the environmental, the energy, the health, and the investor and the tax benefits are profound. It's one of the best things that is happening in Detroit and everywhere else. And capital markets and credit markets can't see it. Isn't that a shock?
So we're going to adjourn for today. We're going to reconvene tomorrow morning. Registration and coffee is at 7:40. So you've already registered. That's for anyone who hasn't, who's not here. 8 o'clock, we'll pick up with panel 5. And we will then complete the rest of the program tomorrow. Thank you very much, and cocktails and hors d'oeuvres in the foyer.
Glad you called. Sir?
Thank you. Appreciate it. Thanks, sir. Thanks. Yeah, absolutely.
Thanks, Ralph. Thank you for making those changes.